Hello, everybody. Welcome to day 2 of the Traders Summit. The summit is sponsored by IG, which gives you another choice here in the U.S. If you're here in the U.S., we only had a couple. Consider IG for an account. You only know if you have a good racehorse when you run it against another, and there's no law that it's illegal to have more than one account. I know many traders have a day trading account, scalping, swing position accounts, different accounts for different purposes. We're also being co-sponsored by Forest Park FX. You could give Trent and Justin a call, and they're going to help you as well. So I want to welcome all our viewers from investing.com as well to today. You may want to stick around longer than the usual hour. We'll post the registration link for you to come and join us for the rest of the day. We have another great lineup. Okay, so what we're doing today is providing, just like yesterday, providing you with great content of excellent elite people in the industry so that perhaps you find a home or someone that you're interested that you could learn from. Because I'm going to tell you something right now, and you could tell by looking at my face, you can't learn experience. Okay, it only happens with the passing of time and living through stuff, and here I'm talking screen time, living through adversity and persevering. And it's really a good idea to invest in your trading career. Don't think of it as you're paying somebody, you're investing in yourself. And you may want to consider Forex analytics. So have your questions ready. This could be interactive near the end of each presentation. We're going to ask the questions for you to our speakers. And that's it for now. Let's do our special face edition, which as usual starts off with me with a couple of comments and things that I'm looking at. I want to talk about the S&Ps here. So the S&Ps, when we were down here, and I was talking 3,100, because if you believe in the theory of wedges don't retrace 38, 50, 61.8. They retrace 100%. So I have it anchored up here 3,100. When I was talking about it down here, it seemed, especially in the environment we were in, it seemed like, wow, what's stale smoking? Well, you guys know medical. So anyway, we're looking up here, and as of yesterday, we surpassed the 61.8 level. So I know we have a lot of viewers on investing.com, and I'm not going to make, even though I'm taking a shot at a short up here, because even though we may not see a new low, I think from wherever the high comes in, the 2640 is a viable target, which would be a nice trade from last night's highs or even up around the 3,000 level. But let me coach you here. If during this advance, the issues that you're in did not keep pace, and I'm saying this because I know there's a lot of sectors and shares that did not recover this much. A lot of it led by what got us there up here, the Amazons, the Microsofts. What I would say is if you're in laggard stocks that instead of retracing 61.8, maybe only through all of this are 38% back of this, you may want to consider pairing those now. You're going to get better prices than you would have if you panicked at the low and you gave it a chance to see how it could recover with the market. And if the recovery is anemic, there's a market tell and message in that. You may want to consider raising cash. And if you still like those shares and we get a pullback towards this level, your shares most likely will as well get cheaper. So that's a look at the S&Ps. A big day in the dollar. Okay, dollar's threatening right here, this moving average. If we could start taking out this level at 99.40, this is the bigger level at 98.27. This is going to set up quite a wave of selling. We have the ECB today, so I think that's really going to be the key. So here's a look at the euro. This is the daily. Really doesn't look that terrible, right? I mean, we keep putting in higher lows. maybe we get a third drive down here, but we start cracking 109. I think 110.50 is viable, and you can't rule out that the dollar is peaking along with what's happening to our economy. And here in the U.S., we're probably, well, we are, uh, as far as having the largest pandemic on the globe, it's happening here in the U.S. So there might be some confidence, a confidence crisis due to this with elections in November. It's not as one-sided with as many bulls in the dollar as we've had before, so we'll see. This is really going to be a key. And I actually think that a weaker dollar is constructive for the market because you get the nominal gains and you could get a lift in commodity prices as well. So I hope everyone enjoys themselves today and gets into the habit of looking for people that they respect their work and collaborating, masterminding. You could do it with us in our members chat room every day. We have it for an hour and a half an hour of an interview that we have every day, and that's it. And plenty happens after those sessions are completed, and we all move into members chat to collaborate. So you could be asking Blake and Steve and all the members who trade for a living in there what they're doing. One of the things I teach is surround yourselves with traders better than you. I did that 3 years ago when I joined Forex Analytics. So with that being said, I'm going to pass it over to my colleague, Blake Morrow, and Blake's going to be presenting a little later on in the day. So Blake, ECB, what are you thinking in here, brother?
Well, damn it.
That's what you're thinking.
Yeah.
Okay.
It's a question that I don't want to answer because of
it's your presentation.
presentation today. So
okay, buddy.
But
let's talk about IBM.
Yeah, let's talk about IBM.
All right.
No, let me.
Good morning, Blake. Good morning, Dale. Good morning to everybody else.
Steve.
Good morning, Steve.
A fast interjection. CMT is also one of our sponsors, and we're going to have Tyler with us a little bit later today to explain to people that might not know what the CMT is, the CMT Association. You might be interested in participating in that. We have our media partner, which is FX Street. I just wanted to add.
Oh, thank you, I mean, while you're mentioning it, Steve, just before I go into like my analysis on the euro and kind of remember, this is month end, so this is a pretty this could end up being a pretty volatile day. Some of the moves may or may not make sense to you based on what I'm reading. But let me just first of all tell everybody. Well, let me start off by saying, Steve, this event that the team is specifically you, because I know you spearheaded this whole event, has done a fantastic job. I think everybody really got so much out of yesterday. All I read, was just positive comments on how great the speaker groups were and how smoothly everything went. We're not, this that you're listening to on a daily basis is the FACE webinar. It's free. Of course, we, tell you who our sponsors are, and, we'll tell you a little bit about Forex Analytics, but, we try to give you actionable ideas, and that's like the basis of this this Trader Summit is giving you some really good ideas moving forward. And I hope that today my presentation will be able to give you guys some ideas about the currency market and how I'm thinking near term, because I'm a trader. So I think on terms of days versus months. So when I have to look out at that view in months terms, it's a completely different view on what I'm doing on a day-by-day basis. But I always want to mention our sponsors, because Forest Park FX, you heard Justin yesterday. He's the founder of Forest Park FX, and I've had lunch with him a couple of times. He's in Florida. He's just a wonderful, wonderful person, and him and his company has done great things for our community of traders, and they've helped hundreds of Forex analytics traders that to find like, hey, wow, I can get a cashback rebate. Wow, I can be part of Forex analytics for free. It's awesome. You know, IG Markets, who just entered the U.S. Fold, you know, from a currency standpoint recently. They're another one of our sponsors, which I don't trade with a retail broker, but if I did, I'd be really interested to see what they do, because I know exactly what Gain does, and I know exactly what Saxo does, and I'd love to see IG's platform and how they operate. The CMT Association, if I had more than 24 hours in a day, if I could tack on another 8 hours a day for a couple of years, I would love to go get my CMT designation. It's one of those things that if I just had the time, you know, being a parent and obviously trading and Forex analytics, but the CMT is the, you know, ultimate designation as a trader to have. It's like having your doctorate degree, if you will. So I think they're really a great sponsor to have, and I hope you get an opportunity to listen into them today. And then obviously I have to mention our media partner, FX Street. FX Street has been, since I started in the currency market, I bridged the gap from equities in 2001 to currencies, but almost exclusively. And FX Street, there was one of the websites that I used to go to initially, and I still do to this day. I mean, I'm just saying they've been around that long. So
you were interviewed on FX Street a few times, weren't you, Blake?
What? Yeah, I've been. Yeah, well, I've had my articles there, and you know, yeah. I mean, but I'm just saying that I've been using their website for basically 20 years, and they're still around, and they're still put out great content. So
I just remember that guy Pinkert interviewing you.
I don't know that.
In Lar.
What's his name? Dodd Pinkerson, something like that.
The Pinkerton Detective Agency.
Pinkerton Detective. We got a great lineup today, guys. So I don't want to take a lot of time talking about all that. Let's actually talk about the market really quick. So and again, I can't really talk too much about the ECB and what they're doing, because it's going to kind of factor into what I'm talking about in just a few hours time. But the euro dollar, let's keep in mind that this is month end. Now, month end rebalancing, we are expecting the equity markets to be weak today, which, you know, it coincides with this big 618 retracement. You guys know that I think this is going to be a huge battle zone around here, especially as we head into May. You know, we got the 200-day just above us, and you know, this area right here, big battle zone where you're going to see bulls and bears fighting it out every single day, probably for the next week or two. And then I think we're going to get the sell in May go away. And I believe that the stock market's going to come down from here, and then, you know, find some, you guys know my attitude is we're going to probably consolidate somewhere down here through the summer. But anyway, it is month end, and we are expecting equity market selling because of the rise that we've seen in equities this month. I think it's been about a 10% rise this month, so you should see some selling in the month end. Now, with the euro dollar, we are expecting dollar weakness, and so now, in regards to the euro, we have this inverted head and shoulder pattern set up. It's been here pretty much all week, and I think you can probably just look at this as more of a wedge at the moment. And you can say, all right, well, you know, as long as we stay above the 108.50, then, you know, think that we're going to break this 109, and then the inverted head and shoulder pattern should take us back up towards 110. I mean, and then, you know, if you're a dollar bull and you're just like, well, I just want to buy dollars. Well, why don't you try waiting a little bit, because this is a bullish setup. So if we do, let's say we do get at the fix some dollar selling coming in, and that becomes the theme throughout the course of the day, you might get an opportunity to sell the euro dollar a little higher. Now, obviously, if you break below, you know, 109 or 108.50, then you have to say, well, the fix was wrong. You know, what the estimates from all these brokers right now is wrong, which could be. I mean, you know, I've seen month-end estimates completely get turned on end. So I'm not going to sit here and go, well, the market or these banks tell me that it's aggressive dollar selling, so I'm just going to buy the euro right now and hope for the best. No, I have to wait for it before trying to take advantage of it. But I think that's what the euro's setting up for today. I think you got a nice little, you got a good setup technically. All right. Now the cable's squeezing a little bit too, and we're above the 618 retracement. I actually sold the 125 level earlier this week, made some money, and now that we're here again, knowing what I know about what's happening in the month end, I'm not so comfortable shorting it up here. I'm just not. I mean, the risk, I think, in the cables, we might run to 126. I think that's entirely possible. So now there's obviously other things happening in the market, but I don't want to talk too long because we have, if you guys don't know, and especially those of you that are new, we have new to listening to our daily webinar. We have a pretty stout team of traders that are analysts with us, and I wanted to bring in Andre today, and Paul Franco, I believe, is going to come in and say hello. But I'm thinking Amanda might actually be able to say hello this morning. Do you know if Andy doesn't, or if Amanda's going to say hello this morning, guys? Do you know? Steve?
I hope so. Not sure yet.
Well, she says I can say hello, so let's see if she can say hello. Can you find her and unmute her?
Absolutely.
I just want people to hear her voice. I mean, everybody else here in Forex Analytics can hear her voice every time you turn on Forex Analytics and it says welcome back. That's Amanda's voice. So let's see if we can actually hear her voice, because this is what
I've unmuted her.
Amanda?
Okay, can you hear me?
Hey!
Hello, I am real. I do exist.
we're now look, I promised you we weren't going to ask you to show your face or give us analysis. We just really wanted to hear your voice, so people that are in our community, that are in our chat rooms, that see you every single day and they chat with you, they wanted to hear. So what do you have to say to the people listening in today?
Good afternoon, everybody. I hope you're well and enjoying the Trader Summit. What a great last 24 hours it was. Yeah, you can find me in the chat room where I do most of my typing and my talking and my charts and my trading. We have a great community. So yeah, all is good.
Well, thank you, Amanda,
for
you know what? We really, really appreciate you coming in and saying hello. And I'll let you get back to muting your mic. But thanks for joining us this morning. And this way, everybody that's in our chat room, which here I'm going to pull up our chat room right now. You can hear and see all the comments from people as they're really excited to hear your voice. So thanks for joining us, Amanda. All right. So awesome. Okay. Well, next I wanted to bring in Andre, who is if you guys don't know who Andre is, if you use Forex Analytics and you click on the harmonic tabs, you're going to see his work. His work is beautiful. The way he can visualize things, and I wanted to turn it over to Dale and Andre and let Andre show you some of the work that he's doing on Forex Analytics and in the markets. Let me see if he's...
I'm here. Hello, everyone.
Oh, you're here. Good morning.
I'm here already. Good morning, everyone, and good afternoon for those who are at the other side. I'm not sure if Dale is here already. Thank you for your introduction, Blake. It's an honor for me to be part of this amazing community, as always, and I hope you enjoy my insights inside the market. So Dale, I don't know if you have something to say before I start. Can I?
You know, I don't, Dale might have stepped away from the mic for a few minutes, but let me just reiterate that Andre is just he's a valuable part of our team because he offers the harmonic analysis in the market. And those are the, you know, Elliott wave and harmonic analysis is something that I definitely don't excel in, and I'm not super proficient. So it's nice having team members like yourself that are really professionals at being able to identify these patterns that develop, and this way you get to share them with the Forex analytics community. So I'm going to go ahead and let you take over the charts, and then you can.
Thank you very much.
You can talk a little bit, and I think Paul Franco is going to join us in probably about 10 or 15 minutes.
Okay, I will try to be fast.
Yeah, because Andre, just letting you know, we have at the bottom of the hour, we have data, initial jobless claims, personal income, etc. I'm going to let you know.
Okay. Can you see my Dixie weekly chart?
Yes, we can.
Okay. Dixie weekly chart, we are now threatening the monthly support. I shared this bearish shark pattern before. At 99.50, the market has found some support at 38% fib, actually also supported with the 200 moving average. But then later it has extended to the 127 extension, and that opens the door to form later another bullish cipher pattern at 91.39. So that requires obviously the breakout below the monthly and the weekly fractal support. So this is a weekly chart. It will take some time to form those patterns. If you go into a lower time frame, in a 4 hours time frame chart, we are now threatening also an ascending trend line, support trend line. We are also we still threatening below that monthly fractal position at 99.67. So I will not be surprised to see an internal, let's call it an internal bullish crab pattern printed around actually right above the monthly fractal support, 96.62. But that requires, first of all, the breakout below the daily fractal support. So at this point, I'm a little bit bearish, but not confirmed yet. I need to see the breakout of that daily fractal. And because we have started with the S&P, I also believe this is the right place for those who are searching for opportunities to go short. That golden fib can actually offer some, it's actually offering some resistance there. We are trading a few points above the previous daily fractal, so I will not be surprised to see synced with that same Dixie perspective. I will not be surprised to see S&P also falling below that, or at least a retest of the monthly fractal. This is a monthly fractal support from let me try to see, from January, I believe it's from January. So I will not be surprised to see a retest of that monthly and the daily fractal also in the lower time frame. So just to show you some other charts on a weekly, and to be fast enough, we'll try to be fast enough to show you other Forex pairs. This is IBEX, so this is the Spanish index. Also finding some support at 127 extension, forming the bullish Gartley pattern, actually the bullish butterfly pattern, I'm sorry. So that requires a 38% Fibonacci retracement. So that should be synced with some more bullish momentum in general for all the index. Actually, UK, it's also trading the 38% Fib also actually after printing the bullish output pattern. And this is the PSI 20, this is the Portuguese index also trading already the 38% Fib. So two options, obviously. One of them is a retest of the previous structure lows for UK, IBEX and PSI 20 as an example, which should be synced with more bullish momentum for S&P. At this point, I'm not expecting that to happen based on and supported by that golden Fibonacci, which is actually the second target for this bullish cipher pattern that I published before the Forex Analytics. So this is the second target for that bullish cipher pattern. So let's jump into some of I already talked about the Dixie. Let me go into some of those measures. As Blake has mentioned, we are now facing the potential inverted head and shoulders for euro versus dollar. That requires, and as Blake mentioned it before, I believe, when things turn clear and it's an obvious edge and shoulders formation or inverted edge and shoulders formation, when things start to turn obvious, they tend to fail, obviously, and they fail because people start to engage the market before the market confirms the pattern. And if that happens in a huge proportion, eventually the market will fall below. And it will reject the edge and shoulders formation. It will not trigger the pattern. So we need to wait for the trigger of the pattern, and we need to assume that as a confirmation. If that fails, I published it before, that eventual bullish Gartley pattern also at 106.62. So the cable, actually inside the one ascending channel, we are also reinforcing one potential ascending structure trend line. Also the golden fib right above. I published it before, these bearish patterns, one of them in a lower time frame offering a nice fall below. So at this point I'm also expecting at least a retest of the weekly support, the weekly resistance. I will not be surprised, so a few points above. Let's see what we have for cable. Nothing clear at this point in terms of patterns in a lower time frame. So this is a HOSI. I published it before this pattern. This orange at 88% fib, this is the bearish pattern. We are actually trading that territory, so we are facing multiple bearish situations here. A lower time frame bearish sharp pattern at 224 extension. We are approaching that level, and 88% fib for this major or higher degree event that requires a breakout of this most recent ascending trend line. If that happens, eventually we will see the pullback or a retracement as expected, as a default target for the pattern back to the 38% fib. The daily support also a few points above. Then we have the Kiwi. The Kiwi also, and let me push the charts here. I published this chart before, expecting these edge and shoulders to trigger above this previous structural resistance. At that point, we never know what will happen next, so obviously, but we expect something to happen when the market prints a pattern, and that's how I trade. I trade based, always supported by one advanced pattern or a basic pattern. I need something to identify my risk and to identify my targets. So we are also approaching, actually we are trading the 224% fib, but it's acting as a support level at this point. So if that fails, if this lower time frame bearish sharp pattern fails here, which it seems to be happening at this point, I will not be surprised to see Kiwi retesting the monthly fractal support at 62.03. So that is a 161 extension, and it is also the bearish shark pattern territory, another bearish shark pattern territory. For euro versus the cable, I'm expecting more bearish momentum without ignoring the potential, the eventual bounce from this zone. I'm not expecting that to happen, but we should not ignore it. I still believe there's more bearish momentum for the cable, for euro versus the cable. And I think there's also, well, let's see. I don't want to predict what will happen next. I need a pattern to trade. As you can see, I shared this before. Alt pattern at 113%, actually a type 2 bullish alt pattern, retested twice that completion point.
Andre,
we are at the end, no?
Thank you.
You need to finish? Okay.
Yeah, we have data coming in
okay. We talk tomorrow.
Thank you very much, mate. Thank you very much for your outlook. Absolutely.
Okay. Thank you.
Andre is an artist with his harmonics.
Indeed.
Thank you very much.
Some of the most beautiful charts. Yeah.
Thank you, buddy.
So all eyes on initial jobless claims, really. We have some
another 3.5 million predicted for this week.
I filed.
Yeah.
Okay.
Let's see. So here's data flash. 3.8 million. I think, Stelio, that takes the total number of unemployed people to 30 million?
Yeah, just under 30, I think, yeah. The revision
I mean,
slightly higher, but yeah, I mean, in the grand
yeah,
scheme.
give or take a few, I think we're at 30 million unemployed in 6 weeks.
Yeah.
I think the number
Yeah.
is...
It
took 3 years in 2008.
I mean, yeah, exactly. I mean, the main view is that a big chunk of these people are going to get re-employed pretty quickly. I hope it's right. I don't think it will be this way, but I do hope it turns out this way. And I think this is one of the main reasons why the market remains optimistic on the speed of recovery, basically. So we also had Canadian GDP that came in at 0%, slightly lower than expected, but really nobody's...
Yeah, but that's backwards. Yeah, okay. Actually, to be honest, yeah, it's the month on month.
It's for February.
Yeah,
so,
it should be somewhat affected. We also got personal income month on month, which was worse than expected at -2%. That's for the US versus 1.5 expected. US consumption obviously tanked, but it was worse than expected. So let's have a look at what happened to USD CAD since we had both US dollar and Canadian data. By the way, so far I don't see any of the markets really responding to the data. To be honest, they were not very far away from expectations, so somebody can say the market was pricing it in. Now, especially having to do with the stock markets, I have no idea how can somebody claim that this stock market is pricing in anything negative, because valuations are probably at the highest they have ever been in history, since earnings have been tumbling, earning expectations have been tumbling, and now prices like, if what is it, like 10% away from the all-time highs. Let's have a look at USD CAD. USD CAD has spent a period of consolidation, testing the previous lows. Here we can see it. I still think that we might have more upside here. I mean, we had a big bullish consolidation. We were talking about it and the expectations that it might explode higher. It did so. So far, the move lower seems corrective to me. I think that as long as we trade above 138, it looks like we can have at least another reset of the 147 area. Stelio, I know that we have the ECB pressure that is probably starting as we speak,
yes,
right?
It is, yes.
Yeah, so anything that comes through, that's of importance or should be moving the market, feel free to interrupt me or whoever else, goes after to let us know.
Especially if you could tell me, Stel, what Christine is wearing today.
I'm going to guess Hermes. Anyway, actually, I do have just a couple of quick things.
Yes, I know. I was about to ask you what we had overnight and so far today from the ECB.
So we had some, first of all, we had some data, Q1 GDPs starting to look weak out of Europe. We had minus 5.8% France, minus 5.2 Spain, minus 4.7 Italy. And remember, this is Q1, so it only has a part of March, which really was obviously bad. Q2, I think, is going to be way worse. Let's see how that goes on. Surprisingly, and I ask anybody who can actually explain this to me, Italian unemployment dropped to an 8-year low to 8.4%. This is last month's reading, which makes zero sense to me.
They were in lockdown the whole month. How the hell is that possible?
Yeah, very good question. I personally don't get it. And really, I mean, we were readings at 9 and 10% before, and now dropped to 8.4.
The only thing I can think of, Stelio, is that if their bureaucracy is as slow and excruciating as the Greek bureaucracy is, the only thing I can consider is that if they need to physically declare at some kind of an agency and claim unemployment, they were unable to do so. That's the only thing I can think of.
That's what our friend Dillian is actually saying. They couldn't file for unemployment from home.
That's the only thing I can think of. I mean, nothing else makes sense.
But still, that would mean that unemployment remains the same. Why would it drop? But anyway, it is what it is. and the market cheered that number. We also had German unemployment claims. These have been relatively flat in terms of change on a monthly basis, and they came in at minus 373,000, which actually, positive unemployment claims, so more people claiming unemployment, which actually is not a terrible number if you consider, the population and what percentage that represents. Data-wise, that was it. We had the ECB, who basically announced a few more measures, more easing. They dropped the TLTRO, the targeted longer-term refinancing operations, to deposit rate minus 50 basis points. So that's now at minus 1%. They announced a new, lots of acronyms here, PELTRO program, which supports liquidity operations, basically aimed at banks. That's at refi minus 25 basis points.
I think the trick, Stelio, is that they've been creating, not only the ECB, I mean, Fed is number one, they've already created 10 of them. The plan here is for them to create so many special purpose vehicles, SPVs, that it's going to be extremely hard to track what they're buying, who they're buying it from, what is eligible, etc., etc.
Yeah. It is. It's definitely confusing, I tell you that. So there's a few more programs, APP, PPP, all these. Basically,
we'll need an encyclopedia soon enough.
Yeah, the take-home message is they're increasing their liquidity measures, and they're making things easier for banks, for pretty much everybody. So they're doing the best they can. Will this fix the current problem? Hard to say, but they're doing what they can with the instruments they have. But equities.
Fixing economic problems with monetary policy is not something they will do. What they try to do is push the problem further down in the future. We'll see for how long that can work, actually.
Yes. And, the overall picture, even though the market likes to think that there's going to be a V-shaped recovery and things are going to be fine in 6 months from now, unfortunately, I doubt that. You see layoffs by the millions. You see Shell today suspended dividends for the first time since World War II. So, this is a pretty big deal, I think. And unfortunately...
did it suspend? I thought it cut 3/4 of it. Or am I mistaken, Stelio?
Actually, I'll need to check. But anyway, okay. They cut it. You're right. They cut it by
and I also think they guided that this is probably not temporary. So in essence, they admit that this is not something that's going to come back on the table as soon as we see the first rebound in crude oil.
Yeah, and that makes sense. And thank you, guys. They did actually cut it by 3/4. Thank you. I probably read the headline too quickly. But overall, my view is this will take a while to go back to anywhere near normal levels in terms of global economic output and the economies in general. So, so now we Gard is already speaking. Let's see if she says anything extra compared to the statement with the ECB decision.
Okay.
And,
perfect. Still, you interrupt whenever. By the way, we have Nick. He might be from Italy. Says Italy took on delivery guys at lockdown and no sackings cause whole country furloughed. So in essence, extra hiring, could show in the system, but people that got fired could not, declare the fact that they were unemployed. So probably that's an explanation that more or less makes sense. Stelio.
Yep.
Okay. I'm going to cover very fast a couple of instruments because, today we want to give a little bit of time for more team members to be here. For those of you that, don't know the team and are unaware of their analysis. So Paul is going to be with us and Joe is going to be with us. Joe has been representing Forex Analytics among else on Bloomberg. So if you go to our Forex Analytics YouTube channel, you'll see that there is a whole section with Joe and his appearances on Bloomberg. There it is. Here's Joe. That is Joe. So very fast, I'm going to go through a couple of questions that we have. And I'm going to try to tie it up, and then I'm going to pass it on to Paulie, and then we can close with Joe before we start getting today's presenters. So first of all, for those that are Forex Analytics members and in the chat room, they know that I was long the S&P from 2420. I took profits at 28.55, and I reversed my position by starting being only 1 quarter short yesterday at 29.55. I actually added another quarter, so my cost average is just above 2,900, just half of a position still. I still believe that this move, even if we've seen the low 23rd of March at that spike low in, during that day, I still think that we're getting extremely overbought in the short term, and sentiment has been changing rapidly. So I do think that we should be seeing at least a retest. My target is actually 26.30, 26.40, that area. So I've started building a short position, looking for a risk to sour at least for a short period of time. That means at the same time that most probably when that happens, I expect the dollar to spike higher once again. I'm paying close attention to the dollar here. I have two likely interpretations. One of them, we're clearly seeing the dollar is coiling. One of them is that we might see another leg lower before higher, and ultimately lower, because my long-term thesis for the dollar is short. I repeat my long-term thesis, right? Or we might actually find support once again, roughly at 98.80, 99, 98.90, in which case I would expect another high before moving to the downside. At the same time, since we had a question about the Euro-Aussie, we know very well that, for example, USD yen's correlation with risk might have broken down, but the same does not apply to currency pairs like the Euro-Aussie, the Euro-Kiwi, etc. So we've seen Euro-Aussie benefit much from the route we had in risk assets and stock markets, obviously, and we've seen, the strong pullback since. But I do believe it has been now testing the 200 daily moving average. I do believe that once we see a risk turn off again, even if that's for a short period of time, that Euro-Aussie, knowing how volatile it is, it can actually produce a very decent rebound. And in this case, 500 pips for such a pair is easily achievable. So I wouldn't be surprised. I mean, we're currently testing at trading at 166.30. Earlier today, we were actually trading at 164.25, so we're already 100 pips higher on the day. I wouldn't be surprised to see this rebound extend even to 173. I mean, even 1,000 pips to the upside is...
A lot of pressure in gold here during the ECB. Steve, thought I'd let the crowd know, and
thank you very much, Coach. Let's have a fast look, and then I'm going to pass it to Paulie. Yeah, I mean, under pressure, yes. Broken? No. I mean, a lot of divergences, and we've talked about that in the short term, gold seems to be running out of steam here. No secret, my long-term thesis remains higher for both metals, both gold and silver. But in the short term, a lot of divergences here, a decent risk for at least a very decent pullback. A lot of people have been trying to join the bullish party late in the game, and we know that if the market is good at doing something, it is at shaking out weak hands before it can, move in the direction it wants after getting rid of people that were late in the game. So that might happen once again. Keep in mind that as long as I don't very much like inverted head and shoulders or head and shoulder formations as continuation patterns, but sometimes you see them working. So as long as we stay above this neckline, I wouldn't be betting against gold even in the short term. So, that's all. We might see another consolidation, which we are seeing now. I wouldn't be surprised to see another push to the upside towards 1820 before we can see a more decent correction. But in any case, if we do drop below 1660, then we should also start looking for lower levels that would be attractive to buy the metal once again. So as we said before, and we've put the link in, phase, which is the part you're seeing now for the event, is a daily free webinar that we do in Forex Analytics. Roughly 1,000 people watch it every day. If you have not registered for it, it's free. Go ahead and follow that link and register. Coach, let's pass the ball to Polly. Yeah. Let me find Polly.
Go ahead.
There he is. So Polly, if you're ready, mate. Okay, unmute yourself and...
People are asking for the link to the daily webinar too, Steve.
Stelio, if you're still here, can you put the link again?
I put it already. I'll put it again. Yes.
Thank you.
Thank you,
Thank you, mate. Thank you.
How are you doing, Paulie?
Polly?
Can you hear me?
Yeah,
Yes,
we
now.
can hear you now, mate.
Okay, great. Let me go in and try and
I'm going to
take
stop
over the
sharing my screen so you can grab the screen yourself. For those of you that don't know, Polly is also conducting another daily webinar for Forex Analytics. That's not a free webinar, it's members only. Every morning, Polly is a short-term trader. He's more of a scalper and he's pretty damn good in what he does. So Polly, what are you currently watching in the markets?
well, we've
What are
been,
you currently trading?
actually I was up throughout most of the night trading the SPOOs. I was looking for a reversal in the SPOOs. I shared quite a bit on Twitter, but of course, obviously, I'm in the chat room sharing the information. I was posting the charts here with the SPOOs, and I was looking for a reversal here. And we've seen just about that right here. I can give you a quick look here. If you look here on the 2-hour chart, we'd had a nice little short-term gravestone doji. But as I mentioned yesterday, what has been driving the bus has been the Russell. And let me try and change the screen here. Bear with me. And we actually, in the Russell, and this is the Russell right here, you can see we've completely fallen apart. One of the levels that I was looking at was on the daily was 1372 as a stretch target. And we actually hit that overnight, actually in Asia. And it's hard to see from this vantage point here, but we kept trying to jump up here into this 1372 area here. And finally, the market just rolled over. And we had also seen the same thing happen with the gravestone doji in the Dow futures. So to me, what I try and do is I incorporate I'll use the Fibonacci, I'll use the levels that we're looking at, and also use a program for the short-term scalp trading. But I do try and look at an overall outlook. And one of the things that I was mentioning, I think also on Twitter and in the chat room, was that we had already pushed quite a bit. I think the only thing we had left today, I mean, not the only thing, but people are focusing on that Amazon earnings. But I thought yesterday we probably ran a lot of shorts out of the room at that point. And my thoughts were, how much further can this market actually go? And we did go in and stretch some pretty good key levels here, whether it was in the Dow futures or obviously in the NASDAQ, the Russell coming back. And at this point, I think we pretty much set our move in place. And one of the things that we were looking at for was fading this market basically since Asia. And I'll go in and jump into the SPOOs. I know that Joe's going to be coming up, so I don't want to run into too much of his time. But one of the things I was looking at, and I'd mentioned before, and we're looking at the 2-hour chart, which I use quite a bit. I use a 2-hour chart primarily as most people would use a 4-hour chart. But one of the things I focused on, you can see here, and really in this area here, in this area, and here, I'd mentioned the 2934. I mentioned 32 also in Asia, but 2 handles is not going to make a difference. But the 2934 was going to be the pivot. And if we got below that thing with 2 consecutive closes, this rally is over. It's over. It's done with. We can now rotate lower. And yesterday we stretched up. We stretched up probably about as far as you can go in, and I wouldn't say as far as you can go and stretch up, but one of the levels we were looking at, this was, I shared with in the chat room, shared on Twitter, 2972 was solid, very, very solid level coming up in here, and maybe we could stretch up a little bit higher. But not only did we get above the 61%, looked like we're going to really start to take off. My thoughts were, as I was coming into Europe, I was still up trading during European hours. Some people were asking me, well, don't you think this can go higher? And my take was, hey, look, the only thing realistically left is Amazon at the end of the month. and look how far we've come. Do you want to be left holding the bag? Because I don't want to be left holding the bag. And as a short-term scalper, one of the things a lot of us in the chat room now have focused on trading SPOOs or trading the Russell. Got a lot of great traders who share ideas, in the chat room, like Greg and quite a few others. But Nitish and Chi, and once again, like I said, I was looking for this market to go on and run out of gas, and certainly we saw it overnight. And if you see it across the board, and I told people, look, just focus on the chart patterns. That's going to go on and give you all the information that you need. And you can see here that we had a beautiful gravestone doji as this market tried to do one more attack, and we ran out of gas here with gravestone dojis in the SPOOs, in the NAS, and the Dow futures.
Do you think this is a reversal that's more than short term? I mean, do you think that that's a medium term high that we found there?
Yeah,
I know that you focus more on the short term, but
exactly. I do focus on the short term. My primary, forte is going to be scalping, but I have to look at the overall perspective. I think I mentioned I was on a interview with Anthony Crudelli this weekend on Futures Radio, and we were talking about drawdowns. And I think it was right in here, somewhere in here, where I took a short on a Sunday and I loaded up some more. And ultimately, I was almost to break even. I didn't get out, and I ended up getting, snockered pretty good that next morning, on Monday morning. But the thing is, even if you're scalping, you have to have a perspective that you look at to know where you're at. So as this market kept going higher and higher and people were just getting rolled over, I have to look at the broader picture. And one of the things I looked at is, as I mentioned, I was thinking, okay, I think we've gone about as far as we can go. The old saying, sell in May and go away. We're at the end of April, end of month, and the last bang or last hurrah, I think, was going to be the Amazon. But right now, people are saying, you know what? I'm getting the out of Dodge before this market comes apart. And that's what you're seeing here. You're seeing here in the momentums that the market all of a sudden started falling apart. We actually started gapping. You may not be able to see it as clearly here, but we actually, in Asia, you can see right here, we just started gapping because the Russell was the one that was driving the bus. So although I focus on scalping and short-term momentum, you can see I'll look at the NASDAQ and I'll look at and also the Russell. And as I mentioned before, the Russell's been driving the bus. And so as the Russell dragged the SPOOs up higher and the NASDAQ
the Russell especially, Paulie, we had made that observation here on the webinar several times, was the only index that had not followed the rest of the indices to new all-time highs. So it was the one that was showing the road lower by diverging for so long, and it's been leading lower now that we've rolled over once again, which makes you think, because the thesis that the U.S. economy is overperforming the rest of the economies should have been pointing to a totally different picture. I mean, if that was the case, the Russell that is consisted by only local companies, more or less, should have been overperforming the S&P and the NASDAQ and the Dow, and not the opposite.
Okay. Well, right now, I want to point out, for anybody that's scalping right now, 1325 is at 23%. And you can see here, we're rolling right into that here in the Russell. Markets always get overdone. And 2909 is key in the SPOOs. So if you're short, you should be looking potentially to definitely go and look to cover. We may go and see a bounce back, but you can see this market has really come apart all the way across the board. I think everybody's just getting the hell out of Dodge, for lack of a better phrase. And those that were long, and like I said, you have to look at the moving perspective. I mean, obviously from the heights that we've rallied to, certainly the market isn't off that much. But for momentum traders, if you're day trading this or scalping it, yeah, this market, it's bye-bye. I mean, we've gone one day early.
Paul, just remember there's a lot of end of month flows, right? It was a strong, end of month selling coming in. So that will probably keep pressure on the markets all day. But in your case, and for people who are active trading, trying to sell rallies is probably the best bet at this point versus chasing it lower, right?
Exactly. And I saw your chart. You posted a great chart. I think it was just yesterday regarding the spoos. And I saw, that thing look almost vertical, the little pattern that you had in place. And I think we've come so far and we've knocked quite a few people out of the box. How much further can you go? That's what I'm saying. It's
that's up for debate. But hey, Paulie, we have just a couple minutes before our first speakers come in. We want to bring in Joe, but real quick, I've got to tell people, you were talking about the chat room regarding Forex analytics and where we're all at all day, where you're at all day. And we haven't talked about this yet, and I need to mention it to everybody because this is important. This is the Traders Summit offer that's been put together by our sponsors and us. And for those of you that want to be part of the Forex analytics community, now we do this free webinar every day. It's here daily. But if you want to be part of the Forex analytics actual community, this is a one-time offer for you guys for the Traders Summit. The link, Steve's going to put it in the chat box for all of you guys. But it's basically, you get our premium product, okay, which is normally $119 a month. You have a 75% discount for the first month, but every month that you stay on after that, you have a 25% discount every month. And that is a pretty steep offer that we've never actually offered before on a monthly basis. So so take advantage of it. This way you can be in the, like you heard Amanda earlier today. You just heard Paulie. This is all of us in the chat rooms. There's Stelios right there. We talk. You can see just like all the charts that we post and everything that we're talking about throughout the course of the day. And and that's on top of the awesome platform that we have, so you can actually see like the patterns in play. Like this is a, pattern in play that was just put on an hour ago in the Aussie yen, short at 69.80, but these are things that, we're always looking at, and that's how you can be involved with the Forex analytics community. So once again, this is a one-time offer for the Traders Summit. And we're giving you the opportunity to take advantage of it. So, Steve, did you put the link in the description or in the chat?
Stelios did.
Okay, great. All right, so I'm going to pass it back over to Dale because I think Joe's going to come in and say hello. Joe, we call him Joey Bloomberg. Is Joey Bloomberg here? Joey Bloomberg in the house? Yo, Joe. And if you guys don't know who Joe is, Steve mentioned him. I think Joe
was a catalyst for putting this whole event together.
He was. He scheduled all these interviews. You can see him in charting futures here with the Chartress.
Yeah, but no one's looking at me in those.
No one is looking at you, Joe.
I was looking at you. I don't know if that counts.
And we didn't even need to know that, Steve, honestly.
Yes, and there is a video for people to learn how to navigate around the site. It's on our YouTube channel as well. Plus, like Tim mentioned, we do have mobile.
And I know some people actually need that, but Joe, we wanted to give you an opportunity to say hello to the community, and I want to also say what a great job you and the rest of the team, but really specifically you, putting together this group of awesome experts to talk over the next couple of days. I don't know how the hell I fit in there, but thanks for including me. But really bringing in so many great experts. It was all 90% of it was you. So thank you.
I got to tell you, getting the people was the easy part. I think Steve putting all the background on the website and everything together was a lot more difficult. But everybody has been so nice. All the speakers we've had, they've been great to work with, and it's really been a pleasure doing this.
Awesome. All right. Well, Coach, I need to go shower up.
Go ahead, buddy.
I got to get ready for my presentation. I actually am going to shower and comb my mane because I have a lot of hair.
I know you're probably pretty nervous.
I'm not.
Yeah,
I do have to shower.
He's never been publicly exposed again, ever.
All right, guys. Hey,
all right.
Take care, and I'm going to pass it over to you. And Joe,
see you later, Blake.
Good to hear you. And thank you, Paulie.
Thanks, Blake.
For joining us.
So has Boris arrived?
So, Coach, speakers time. Yeah, Boris is here. Let me make him a co-host.
And
hey, Boris.
Hey, do you guys hear me?
Yes, and you should
Boris?
be able to use your camera as well.
Okay, let me, well, that's problematic. Let's see if we can start my camera.
Okay, so for day 2, which is our doubleheader, leadoff hitter Boris Schlossberg. Boris his company is BK Asset Management.
No. Sorry, bkforex.com. That's the
bkforex.com. Okay. And you've seen Boris on CNBC. He's a contributing editor there. He works with Kathy Lean, and Boris is a stalwart in the Forex community, and we understand each other because we share the same birthday, so we understand the schizophrenia that we both experience. And Boris, what a great topic today, tools that empower retail to trade like a hedge fund. So looking forward to your presentation, man.
So, I promised everybody that no PowerPoint will be made during the course of this presentation. I'm going to try and stay true to my promise. It's going to be just all charts and tools to show you some of the stuff that we've done.
You have to share your screen?
Yeah, I know. Let me share my screen. Do you want to continue this? Yes.
Hey Boris, this is Blake. I just wanted to say hello and thanks for being part of this. I haven't had an opportunity to say hello to every trader out there, and I'm trying to watch all the presentations, but I want to say thanks for being part of all this.
Hey man, how are you? By the way, here's the solution to your COVID hair. You see, this is what I'm doing.
I should put on a baseball cap too.
That's it, man. That's it.
All right.
My job.
Hey, good luck. Thank you.
No problem. All right, so let me see. I'm going to share my screen. You guys should be able to see 3 hardest things to do in trading. Hi, guys. Hi. Dale, keep me honest to my time because I can just go on forever. I am super excited to be here. I love Blake. Blake has been at my Trader Fest, so I'm super happy to come back and be at this one. This one has got just an amazing lineup of traders and analysts. And I'm going to do something today that hopefully nobody else is going to be doing with you guys, which is I'm not going to talk about the markets. I'm not going to talk about my macro views. I'm not going to talk about there's a lot smarter people with much better analytics that can do that for you. I'm going to talk to you about my failures, my disappointments, all of the things that I screw up every single day, because hopefully through my mistakes, I may be able to help you correct yours. And today, first and foremost, I wrote this column. By the way, if you guys want to get my free weekly column, I write every single week, 50,000 people. Honestly, I really write it for myself. It's basically like a self-confession diary every single week of all the sins that I do. But people seem to really like it because it's not, I don't write about the markets. I don't write about my great trades. I don't write about setups. I really write about just sort of the daily screw-ups that happen in my life and the challenges that we have every single day. Because we all know, what the gurus will tell you and what the reality of life and trading is completely opposite. And I try to be as real as possible because, unlike some people who drive Teslas and have fancy YouTube channels, I actually trade every single day. We eat our own dog food. So, the things that I experience, a lot of people experience all the time, and they're not nearly as pretty and as idealistic as people make you say.
It's all in our head, isn't it, Boris?
It is. It's both in our head and in our body.
Okay.
So the thing that's in our head, I think, is, and I'm sure many traders will confirm this. I wrote this column last week, and I think it's probably the smartest thing I've written in a long time. And I've written probably about 10,000 columns over my lifetime. 3 hardest things to do in trading. The number one thing, and this is what I struggle with all the time, so I'm sure probably you guys do too. Stupid, random, dumb ass trades. In other words, you have a setup. It's working. It back tests well. It front tests well. It real tests well. It makes you money. but it's not setting up, and the market is there, and it's flashing, and it's trying to entice you. And remember, the market is an auction system. The market. Have you guys, if any of you have ever been at an auction, charity auction or anything else, and have bought like a can opener for $5,000 because you were stupid enough to outbid some other guy, and maybe it was for charity, so it was a good cause, but you know what I mean. You never ever ever get a bargain at an auction, and the reason why is because the auction is a competitive. It's by its very definition designed to extract to make the absolute false decision at the worst time. Right? It's you competing against the crowd, and we know that humanly we are wired to essentially respond to people around us, right? We like to think we are lone wolf, contrarians, stand away, have our own way of thinking, but we're actually completely and totally manipulated by the society around us. And so the equity market, the FX market, any financial market is nothing more than the stupid charity auction at your school that you overpaid, $500 for your kid's painting, which I've done many times. It's the same process. But so what happens is we get enticed. And I would say I should make 5 trades a day and I make 50. And if that sounds familiar to you, then you kind of relate to the trials and tribulations that I do. So literally 85% of your improvement is just not doing the 45 stupid random board trades versus the 5 that you should do, right? And by the way, I don't know if there's, Dale, I don't know if you're keeping track of questions. I'm happy to answer questions as I go along because,
we'll get to them.
I want to make it a two-way thing. So the number one thing that everybody can correct, and I can speak for everybody because I am every man, and I don't think there's a human being, maybe Blake, because he's a Marine, has a discipline not to do this, but everybody else who is normal amongst us does not have a discipline to avoid random trades, stupid trades, enticing trades. And I think the number one way to improve our trading is just not to do the stupid trades that we're not supposed to do, right? Now, the second hardest thing to do in trading, and tell me if you do this. I mean, this is truly my single greatest weakness. The second hardest thing to do in trading is to stop fading. Just stop fading. For those of you who don't know what a fade is, and Dale can tell you because he's an old pit trader, fading is selling when something is rising, buying when something is falling, okay? It's super, 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 at least for me, and maybe for a lot of people, enticing to buy the bottom tick and say, see how smart I was? The market was selling off and I bought the bottom. Everybody was selling. I made bid at the bottom and then it popped right off. I'm so smart. Or it totally went up and it's so high up, I'm definitely fading this move because I want to be on the opposite side. It's basically you trying to play market maker. Except, I don't know, maybe you could succeed. I have never in my life, and I do this, I've traded for 30 years, I have never in my life succeeded trading as a market maker. What I mean by that is I have never long-term, I've maybe had temporary successes. I've had days where I felt so smart that I went against the market and I top tick and I sold the top and bought the bottom. But every trade that I really made money on, every trade that has consistently made me money, every strategy that I myself design and develop that works, that actually works in the market, really works because it's a continuation trade.
Well,
Basically,
Boris, I have to push back just for a minute, and you're not going to mind it, but
sure.
We did a webinar with you at year-end, and one of your trades for 2020 was a bearish position in the market. You thought the catalyst might be Iran. It turned out to be COVID was the pin. Yes. But you were talking about the structure of the market being vulnerable. I forgot if you were doing it with put spreads. I forgot the device, but that was a great macro call.
No, that was, and I got lucky. Okay, so yeah,
All right.
so you actually, so there's actually, I don't have a foreign here because this was in a prior column, but I'm so glad you reminded me of this. Okay, so this was me being macro analyst. It's easy to be a macro analyst. It's easy to spout opinions when, and you know, by the way, Dale, what was my number one trade? Gold, right? Gold is still great, right? Like, yeah. It's super easy for me to see the future when the future is far away. Hell, I just posted a video yesterday. I was on TV the last time we were all on camera, which was March 16th, right, on CNBC. And this is literally at the beginning. It's just absolutely at the beginning of the COVID panic, right? And you know, we're talking about COVID, and you know, and I did all these crazy policy suggestions, which actually then all became, nobody believed in me that, you know, I said we got to give money to people, we got to do PPE, all that PPP, all that stuff, and everybody thought I was crazy. And it all came true two weeks later. But that's not what I want to show you. What I said at the end was, and here's my one trading call for for the COVID trade: long Microsoft, short Apple, right? And it was obvious to me. It was so easy because, hey, I wasn't trading the position. It was so obvious to call that, right? It was so, and it was a great call. I mean, look how brilliant I looked, you know? So my point is, it's easy to be an investor. It's easy to be a macro caller, right? It's completely different when you are day trading a position. And even if you're correct long-term, you're going to be wrong short-term. When you are working against the crowd. It's very, very hard to hold a losing money position that constantly adds negative P&L to you more and more and more, especially if you're trading size in any meaningful way. So maybe you can make money as a contrarian, but not as a trader. Not as a trader. There's basically, there are really only two types of trading you can do. There's continuation and there's reversal. Literally everything from high frequency trading to the longest trend trading idea you can imagine. Everything from Warren Buffett to Citadel on one end of the scale to Warren Buffett on the other end of the scale falls into exactly two types of strategies. There's really nothing new under the sun. You either think price is going to continue or you think price is going to reverse. And depending on your time frame and your skill set and everything else, you're gonna make your bed in one of those strategies. And I guess my point, at least from my personal experience, is you will never succeed, or at least I've never been able to succeed, and nobody else in my room, and Kathy trades exactly this, sort of comes to the same conclusion. Nobody will succeed trading reversals. If you really want to trade, you got to trade continuations, okay? Which is really hard to say because everybody pays lip service to trend, but everybody actually tries to trade reversals, And then, of course, your favorite little third component of how to become a better trader, and I am so guilty of this, like 100% guilty of this. I think the only thing that keeps me alive is I start small. Is you make a dumbass trade, right? It stops you out because obviously you're trading against the market flow. The market obviously going down. You're trying to buy. You buy lower. Eventually, you build up a big position. You get stopped out. You get furious. You're like, oh, damn it! I know I'm right. You go back in with 4, 5, 6, 7 times your size just to get back the original piece that you lost, right? And then of course, 9 out of 10 times, you're not going to get that piece back, and you just dig yourself deeper into the hole. And the hardest thing to do is to make the money back in the exact same increment that you lost it. In other words, if you're trading one contract on your losing trade, you got to trade one contract on your winning trade. And if it takes you 3 winning trades to get that money back, that's what you have to do, right? Now, I will leave you with one hopeful thought. What makes a winning trader is not your ability to win. It's not your ability to win. What makes a winning trader, in my opinion, or at least me over the long run, I realized what when I finally turned the corner, is your ability to come back from losing. It's easy to win. We all have great days. We all have great weeks. It's easy to win. When you're in sync with the market, you can't lose. It's easy to win. Everybody can win. Look at all the hedge fund superstars from the early aughts. Okay, they look so smart. All the value investors, even all the great, even Paul Tudor Jones looked so intelligent because he was the golden boy in the 90s. When he actually, by the way, used to do a lot of reversal trading in the S&Ps. And then, for the last, if you look at for the last 10 years of all the great hedge fund managers, from Paulson to Tudor Jones to everything else, they haven't beaten money market fund rates. Some of them have had like consecutive years of negative rates. The only guy who makes money all the time is George Soros. Love him or hate him, he is truly a great trader. That's a guy you want to be like, because that guy knows how to come back from losses. And that's sort of like the final thing I wanted to tell you, is that you will know you have control over your trading, not when you're losing or not when you're winning, but when you can come back from your losses, when you have the confidence to know, okay, I screwed up, I did all these stupid things, but my setup is great, and I'm going to go back to my setup, I'm going to trade my setup, I'm going to bring it back to its value.
I can verify that, Boris. When I was on the floor, there was a clearing firm named RB&H.
Okay.
And the owner of the firm was Dittmer. And he had a bunch of local traders on the floor. He would let them trade into deficit because he said exactly what you're saying. It's watching how people can come back from being in the hole. And when you look for CTAs, don't look at their best performance. Look at their biggest drawdowns and what happened after that. Great point, Boris.
Thank you. I actually wrote another column like a couple of weeks back, I think, where I showed I destroyed one of my accounts. Again, revenge trading, and then I just calmed down. Oh no, this was like at the beginning of the volatility where I just I really destroyed the account because it was volatility, revenge trading, whatever. And I just calmed down, and then I went back to my system and I retraded the system, and I literally showed day by day by day by day snapshots of my account. And so I destroyed the account literally in one day. It took me 3.5 weeks to rebuild to equity equal, and then after that, it's been equity highs. And actually, that account has been making new equity highs because I stopped being a putz in that particular account. But that I think is kind of the interesting takeaway I'd like to share with you guys. Now I want to share with you a couple of setups that we trade all the time. And I want to share with you some of the tools we use to trade those setups that help me be less of an idiot. So if you don't mind, let me take you to my charts, okay? I'm going to use TradingView. And we'll give it a second because I have my browser on pause so this doesn't crash. So we do a couple of interesting things at BK. We create these visual, what you're looking at right now is, I think, can you see, let me go full screen. So I think this is Euro, right? You guys seeing this well, right? So we create these visual indicators. You see this indicator? It doesn't have a lot of squiggly lines on it. It doesn't have 10,000 MACDs and everything else. It is actually pretty mathematical underneath it. It's pretty mathematical underneath it. This is mine. I'll show you Kathy's in a little bit. And it does a lot of mathematical calculations. But what we try and do is hide all the complexity, because the human mind, it's like you ever seen a chart with 55 indicators on it? What's the point? You need fast. Remember, we aren't animals in the savannah. We still react in microsecond signals to danger and opportunity. That's what we are. We're basically no different from a biological point of view than our ancestors from 200,000 years ago. So you have to think of yourself as a hunter for trades. Hunters looked at prey and looked at danger in milliseconds. So if you have 25,000 indicators, you're going to be prey, my friend, in the marketplace. So what we've done is we kind of subsumed all of this complexity into visual indicators. This is one of those indicators. This is actually something I've been working on, and I am like a, Kathy is very funny. Kathy, my partner, some of you guys may know her. She kind of like, she develops one thing, and then she will trade it literally for a decade without deviating by 1 inch. And I am like the perpetual tinkerer. Like, I will create something, and this is probably version 5,555 of the original idea that I have, because I'm constantly tweaking it and making it this way, and ultimately I've sort of like learned from her to just leave it alone. But the bottom line is, this was something that kind of started out as a simple idea. It said, okay, so I want to buy continuation in trend, right? And how do I determine trend? Well, my original idea was, let's do just 500 SMA against 20 SMA, long-term moving average against short-term moving average. It doesn't matter. There's 100 different ways to create trend. None of them are perfect. This was just good enough. It was kind of like, let's take a long-term moving average against the short-term moving average, and run that. And I kind of did that. And the whole idea was, if something is red, it's in a downtrend. And when it's a downtrend, you only look for sell signals. And when something is green, it's in a buy trend. And when it's green, you only look for buy signals, right? So that was the original idea, right? And then I was like, well, how do we kind of create entries in trend that make sense? And I was like, well, the most common way to people trade retraces, which we want to trade retraces, because you just don't know. You want to have a trend established, you want to have a retrace, and then maybe you want to bet on continuation. Is Fibonacci, right? Fibonacci. Well, fib levels are. I see some questions. So Dale, you can hit me with levels. You can hit me with questions while I'm doing this. So fib levels, by the way, as any of you who've ever done them, are completely arbitrary. Like, where do you start a fib level? From here, where's the bottom? Here to here, here to there, here to there. Let me go on a daily chart. There'll be 500 different fib levels. Fib levels are completely dependent on whatever arbitrary starting point you start with. They're great, but they're completely arbitrary, right? So I was like, okay, fib levels are arbitrary. If fib levels are arbitrary, then hell, let's just use end of day prices. So this is end of day prices right over here. This is a white line. This was yesterday's close. That's an end of day price, right? And so why did I use that? And actually, it was almost a subconscious decision on my part, because when I first started in the business, and we traded, I was raised in FXCM. In FXCM dealing station, in FXCM dealing room, I remember walking in, and the dealers, they had like more computers than the Pentagon, but they also had this whiteboard. And on the whiteboard, they had written down weekly close, daily close, monthly close. And I never forgot that. I was thinking, that's really interesting. Like, these guys have all these tools, they have all this information, and yet these are the levels they keep their eyes on all the time. Why? Well, I then realized much later on, that of course this is what the major money central banks look at, what Microsoft Treasury is going to look at, whatever everybody's going to look at. Normally, human beings essentially organize themselves around the calendar. So if you organize yourself around the calendar, for example, right now, today's the end of the month. We see a lot of flows in the euro based upon end of the month flows, right? Stuff like that. So I said, you know what? If we're going to make arbitrary starting points, we might as well make it weekly, daily, monthly, and then we can use those reference points for our fib levels, right? And then finally, the third most important component was, okay, I got negative trend, I got a retrace, then I need a confirmation that the trend has resumed. In other words, downward price action has resumed in a downward trend. So here's confirmation. Here's my sell signal, right? Now, this is obviously, I'm showing you Eurodollar, which is the world's slowest, weakest little currency, weakest little instrument that has zero continuity. But I'll show this to you on equity indices. I'll show you this to you on futures, and you'll see how many points it picks up. This is a 16-minute chart, which might as well be a 1-second chart in the euro. That's why you're not going to get very, very strong continuity, but you still get it. Here's a sell signal, here's a sell signal, here's a sell signal, here's a buy signal, here's a buy signal, here's a buy signal. You know, not every one of them works. You obviously have to know at what time of the day the buy signal is coming in. You know, those are things that obviously require a modicum of a nuance, because, you know, nothing ever works on a purely automated basis. But this alone gives you a very, very nice, clean, intelligent entry into a possible trade, right? And like right now, for example, so we got 34 minutes to close to this candle. This is a massive, ugly ass looking sell candle, right? I don't know what Lagarde is talking about. I don't know what she's saying. Clearly, she's saying something, you know, about how she's going to print enough euros to kill the world. And maybe the euros finally started to react to the downside. So if this closes, and you see the signal candle, we make it white so it's visible in the charts. If this closes negative, right, that's going to be a pretty decent trade for us, okay? And how does this trade work? So here's the other component. This is the final component of my kind of day-to-day scalping that I do. Well, I realized that basically, since we're using pure price action, and one last thing I need to tell you, by the way, is that one of the things that I realized is since I'm using pure price action, I'm just using the information of the market in the moment the market is giving it to me to interpret and create signals, right? One of the things that I did is I actually went away from using the moving average. If I go into my settings here, and I actually...
What's the time frame of your chart, Boris?
This is
asking.
Oh, this is a 60-minute chart. This is just a 60-minute chart, right? But it's all applicable on any chart.
Right.
For FX, we trade this on an intraday. For FX intraday scalping, which is really like this is what you need. You need a 60-minute chart just to scalp FX because it's such a boring little market right now. So for FX, I use a 60-minute chart, and I actually removed the moving average filter. And now this, I can make it. Here's the moving average filter. If I click it on this and say OK, you'll see that it's laggy. It's laggy, right? It's giving you actually a lot of false signals because the moving averages are lagging on the actual trend. But if I remove this and let the filter be just above, below today's price, this is literally how simplified. I start out my strategies with incredible complexity, and I reduce them to literally the most simple components possible. And I cannot tell you how much more profitable that is. So this whole strategy has an input. Are we above today's open? Then it's a green. Are we below today's open? Then it's a red. Do we have a retrace in the red? Then it's a sell. Do we have a retrace in the green? Then it's a buy. It's literally that simple. It's literally that simple. And then we add the final trading component to this thing. We basically say to ourselves, okay, if this is a legitimate buy signal, if this is a legitimate buy signal in this particular structure, then the low of this candle should not be broken. Should not be broken, right? This should be, the end of this candle is my signal. I'm going to use the low of this candle as my stop. And what am I going to use as my target? Well, I like to trade high probability trades. High probability trades by the very definition, have to have negative risk-reward ratios. So I always trade with negative risk-reward ratios for my short-term setup scalps. In this particular case, I literally am willing to risk I'm willing to profit at 50% of my risk. So whatever is my risk, right, I will profit at 50%, right? Now, as you can imagine, this is a dynamic setup, right? Every single candle is different. One of the beautiful things is it's context sensitive. It's truly in sync with what is happening in the marketplace. If the signal, like look over here. Here's a signal, right? It's a buy signal. It reaches a little bit, but it doesn't break the lows, and then boom, 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 it does extend and gives you the highs, right? So if I want those high probability, high frequency profits, I have to only go at 50%. But I have to calculate all of this. I have to calculate all of this manually. You can imagine, how tedious and difficult that would be to do this on a manual calculation. So let me see if I can get this out of here, right? So.
Time to sharpen your pencils for questions for Boris too during this presentation for the last 10 minutes.
So let me show you the very, very cool thing that we've created to completely take all the details out of my equation, right? We have both 4 and 5 versions of this. I'm going to show you the get over here. Oh, I guess the Zoom making it a little bit hard for me to move it. So what are you guys seeing here? You're seeing essentially a copy of the MetaTrader 4 buy sell panel, right? It's like, and actually I could roll this up and it wouldn't matter because this thing would replicate it, right?
Right.
I can I can change my size. Let's say I can make let's just make it let's make it a big lot. I want to make it a big lot, right? Here's what's so cool about it. This is a tool that automatically will put a stop. If I'm going to be buying, put a stop at the low of the candle, 10 pips below, and put a take profit at 50% of my risk, right? So, and I can change all this. I can change this to 60%, 70%. It's all dynamic. This is the beautiful part of it. But the point is, all of it is completely and totally calculated for me before I begin the trade, right? So euro is kind of coming back. It's not a great short, but I'm just going to show you what would happen if I did a short over here. I'm going to sell this, and what you will see is that what's the high over here? You see the high over here, this candle, the candle prior. It puts a stop 10 pips above that high and puts a target at 50% of my risk dynamically. And it will do this on a different candle with different stops and different targets. If you want to do this on dollar Swiss, right? Let's go to dollar Swiss, and oops, come over here. And let's say I want to go long dollar Swiss, right? Because let's say if the euro is falling, then whatever. I can't move this around, but trust me, it's same kind of a thing. But let's say I'm going to do small size. I'm going to do 1/10 of a pip. So I just bought dollar Swiss, and now it put a stop right over here. And then, of course, I can move the stops, afterwards if I want to. But think about how great this is. What's the first thing we always do as traders? We do something stupid like this. We click on the dollar Swiss on the MetaTrader platform. We don't have a stop. We don't have a target attached. We say, oh, I'm going to attach a target and stop. And then your wife calls you, or your cat walks over your desk, or you forget, or you're like, I don't feel like, I'm just going to watch it. My 3 favorite words to lose money. No words have ever caused anybody to lose more money in trading than I'm just going to watch it. Statement, right? Well, the beautiful thing is, the tool eliminates 90% of your idiocy. Eliminates the idiocy is what I specialize in. So this tool, obviously, this is a great tool for FX. But I also have this on futures, right? I have the same tool working on futures. Like, look at this. Like, I can sell S&P right now on futures, right? And it automatically puts a stop and a target against the highs. And what's so cool about this, by the way, is that it knows that this is a future, not a FX. It knows that in futures I have to use ticks, not pips. And if it's a CFD, it knows that it needs to use points, not pips. Like, it's smart enough to know what instrument it's trading, how to properly put the stop in there, how to properly calculate all that stuff. Just makes your life so much easier. So this is just one out of a couple. How much time do I have, Dale, left for the presentation? Because I have another tool that I want to share with people.
About 12 minutes.
Okay, super. So I'm gonna show you some one other cool thing that we do in the room. But is there any questions right now for my scalping? So literally, just to kind of complete it, all day long, if I did nothing but use this tool with where's my chart? With this chart, right? With euro dollar, or typically I trade futures. Whenever I get a signal like this and I use this tool, if I did nothing like that, I would be a winner my whole life. That's basically what I wanted to kind of show you. Okay, show me, hit me with questions, Dale. Was there
someone asked that for them, finding the point of a retrace is the hardest part.
Correct.
So
correct. So
go ahead.
So we use. That's why we calculate. That's why I have tools to calculate everything for me. I don't allow my personal judgment, and I allow my personal judgment all the time to override my tools, and I'm an idiot. Okay, I'd be the first one to admit it. My tools are a million times better because they've been thought out. They've been properly calibrated. They've been fully tested, right? So that's why we create tools, because we as human beings, because, I'm that guy on the African savannah, and if I'm barehanded, which is what we are, we're trading just with our own wits. We're barehanded against the beasts. And it's stupid. What we should have spears and, tools and everything else to be able to defeat our enemies. And these are my tools. This is what gives me the chance to survive on the savannah, because it doesn't allow me to make stupid errors. It takes care of all the details that I typically will always forget, right? So that's how we do it. I use my trade view to find these signals. I also, by the way, I haven't shown this to you because I knew I wouldn't have time. We have all of this algorithmically. I have the EA, I have the robot, both an MT5 and MT4, that will take that signal and trade it, right? And the robot is even so smart that I can tell it to turn on and turn off. So typically I only like to trade the New York Open and New York Close. So the rest of the time when I get signals, I want to ignore those signals. The robot will come on, turn off, do all sorts of stuff. It's amazing what you can do with automation, once you're able to kind of create a crystallized, intelligent approach.
That's a good segue into Mark Randall's question. Why don't you fully automate the system in MT4 instead of semi-auto?
We have, but
okay.
But as always, I love robots, but robots are morons. Robots will just keep on buying, keep on selling without any awareness of the context, right? So my system now turns on, turns off, turns on, turns off. And honestly, if I trusted it completely, I probably would do a better job. But I'm still a human being. I still want to participate, right? And this.
Yeah, it's hard to detach 100%.
Right. Correct. And what this does is it eliminates most of the stupidity when we say I want to do it. What's the word? Proprietary, discretionary.
Oh, yeah.
Discretionary. Right.
Yeah.
I want to take the other great word to lose money. There's no greater word to lose money than I'm a discretionary trader. Oh, so that means you lose money all the time. Okay.
No, there's one better, Boris. I have a mental stop in.
Oh yeah, mental stop. I was going to say I'm just going to watch it. By the way, you see that? So I sold the euro. You guys saw it. I sold the euro. And that was like $50 in the money, and I just closed it out. Just and it's a demo account. I don't care. It's a demo account, but like it's just my mental ticks. If I was correct in that trade, I'll let it go. But this tool obviously will close it for me. I don't have to worry. If I walked away, I want to go walk my dog and it hit my target, it would do this.
How do you set up the size of your trades? How is it linked to the conviction you have of the signal?
Well, here's what I was going to say.
Carlos.
I trade same size. If I go away from same size, that's where I lose money. Okay, again, you want to win in the marketplace, you want to be disciplined, which is really, really hard, right? And a huge part of discipline, in my opinion, is straight. If the trade is good, it should be good for the same. It's a cookie cutter trade. The problem is we create great ideas, but they are boring because they work. That's the biggest problem in trading. The things that work are boring, and that's why we stop using them, So I try to stay as boring as possible, with what we do. I think that's really the key that I wanted to sort of show you. The tools,
these are pretty good questions for a segue for people to know how to get a hold of you, follow you, contact you. Is there demo versions of these tools available, and how do we get access to your tools?
Yeah, so no, sorry, there's no demo versions of these, but you can get those tools. They're completely free if you join us. And you can join us at bkforex.com. Just simply go to bkforex.com, say get trading signals. You can join us for as little as 1 month, and you'll get these tools for the rest of your life. So,
nice.
if you want to do this, these tools I will share with you. Literally anybody who comes into my room who is a month or longer subscriber, then you get these tools and you get to bang away, really, really well. So I have something really, really cool I want to show you. My last thing. Let me just do this because you guys have never seen this, and I guarantee you've never ever seen this in a. Screw this. let me kill this trade. You've never seen this in a retail environment. Okay, so this is IG. For those of you who guys are in Europe who are and by the way, this works completely with futures, and I just don't have the time to show you on the MT5. But this IG on MT4, right? This is CFDs and FX, right? So I want to show this to you on CFDs because this is really what it's designed for. Imagine you want to go long NASDAQ, short S&P, or even better, I want to go, I don't know, long NASDAQ, short the German DAX,
Russell.
right?
Oh,
okay. The German DAX. I'm just gonna throw out some crazy numbers, right?
Yeah.
It is impossible to create a pairs trade and then be able to have the whole trade be managed as a single trade, except with this tool. This is the tool that I have that will make it possible. So here's how it works. I'm going to import from my market watch all the symbols over here, right? I'm then going to find, let's do NASDAQ. I'm going to do NASDAQ. I'm going to say NASDAQ is going to be my main position, and I'm going to trade the German DAX. That's not even like a common trade that you want to do against it, right? Now, here's the thing that's very, very important. When you're trading two separate instruments, in order to make the trade viable, you have to equalize the amount of each instrument so that the notional value is equal. In other words, you're trading 10,000 of NASDAQ against 10,000 of German DAX. It's very hard to calculate that, right? Except when I got the tool. All I got to do is hit an auto ratio. Once I have this auto ratio, it tells me I'm gonna sell 0.82s of German DAX against one of NAS to make this trade. I'm going to put a stop of $100, take profit of 50, and let's say I'm going to put a protective stop of 20 on this whole thing. Right?
That would work for, say, for example, Boris, gold-silver ratio?
Anything. You name it. I can
Beautiful tool. Wow.
with any instrument, right? I'm going to place this order. Oh, and the problem is, I know what happened here. Sorry. This is a huge every broker, by the way, this is the annoying part. 0.10, I think so. Let me, because it was too big a size for this demo account. Let me see if I can do the auto ratio. Yeah, okay. I think I can do it this way. Now, okay. No? Why is this not working? Huh. NASDAQ failed. Okay. You know what? Okay, let's do this with this. And this has to do with I just simply don't have enough money because these are very, very large sizes. Let me see. Let me do the I'm going to do NASDAQ against 0.10. Let me just do hedge auto ratio. Okay, this should work, right? Actually, you know what? Let me just restart this. Let me just restart this so that we'll refresh the whole tool, and we'll do NASDAQ against Wall Street hedge. Oops.
Someone must know this tool. Anis Ahmed is saying a requote problem from IG.
Oh, you're using a requote problem? Okay. Well, guys, I was really trying to be, since IG is a sponsor, I was really trying to show you. You know what? Screw this. I really want to show you the IG. Let me show you how this works in the futures. Like show in like a real account. Okay. So here's futures. Okay, this is AMP futures. I'm going to show this to you in futures just because I want to show you the tool. Okay, so I got NASDAQ in futures main against the Dow hedge. Okay, auto ratio, right? Creates the auto ratio. It's actually 1-to-1 in this particular case. I'm going to place the order, and boom. Now this particular trade is traded as one single trade. And here's the cool part. What if I want to change the stop post-trade? I'm already in the trade, but when I'm saying, you know what, I only want a 50-point stop, right? I can do this, and the tool will now adjust dynamically after the trade is already up. It automatically calculates the P&L of this thing, and it will say, oh, if it's a 50-point stop, I'll stop you out. And then what if I want to put my take profit? Let's just see if I can do this crazy take profit of maybe $3. Oh, it's already above my take profit. So let's just do 7.0.
Okay, I'll see you at McDonald's.
It's running. It's okay. So let me just close it out. Screw it.
Right.
Close out my profit. So my point is, this tool can manage dynamically your stops, your profits, everything in real time, which is amazing. Like post trade, not pre trade, but imagine you're in trade and you want to then say, oh, I want to adjust my stop to more or to less. You can't do this with any other tool. This is like the coolest thing ever. Or you could just let it go and leave it as is in your original settings and let the whole thing work, and it will work, as you can see. I made money in futures. I always make money in my spread futures. So whole bunch of stuff I just wanted to show you. This is what we work on. This is the kind of cool stuff we make available. The ability to trade one instrument against another instrument as a single holistic trade is really my pride and joy. So I hope you guys come join us in BK, and I'll be happy to share this with you and obviously show this to you in much more greater detail in the room. I guess I have just a few seconds for questions. Go ahead. Anything?
That's it, Boris. So
that's it. I'm out.
Yeah. So I want to thank you.
And I was worried I wasn't going to have enough content for time.
Boris, I don't think you ever have to worry about that. So I want to thank you very much for leading off day 2 of the summit, and give everyone your website address again, please, Boris.
Website is BK Forex, BKFOREX.com. Just hit get trading signals, join us, and I'll share all of this with you today. All right, guys, everybody have a great day.
Thank you, my trading warrior brother.
Take care.
Appreciate it. Next up is one of my favorites, is Adam in the house. Is Adam here? Steve, are you here to bring Adam in? So our next speaker is Adam Button, and I've known Adam for quite a few years. I knew, okay, Adam's in there. I knew Adam from when he just worked at Forex Live, and this is the kind of guy he is. He saw something that he liked that was working, became available to buy it, and Adam has turned Forex Live into something bigger and greater than it was before. He's also one of the best fundy traders that I know, and every time I interview Adam, I learn from him. So you could find Adam at Forex Live. That's also their Twitter handle at Forex Live. Welcome to our summit, Adam Button.
Thank you for the very nice introduction there, Dale.
Yeah, I mean, I'm so proud of what you've accomplished since you took that over. As you know, I remember when you were an employee.
It was a great trade.
You know, the Canadian dream.
It was
find a place you work and take it over. And
you only get a trade like that. You know, it came up, and
yeah. So it was a news trade for you. One of your best long-term position trades, I would say, Adam.
It was.
So your topic looks fascinating. Looking forward to hearing your presentation and talking about, especially in this era that we're in now, Adam. You know, I haven't talked to you since COVID hit this part of the globe, and I've seen things that are unprecedented, like minus $38 crude. You know, some of the liquidity coming out of precious metals, where bid offers, there's wide spreads. The Fed had to come in and save the bond market when it locked up. So looking forward to you really, you remind me of this expression, Adam. To be there for the good times, you have to be there all the time. So you're going to talk about 8 ways.
Hey, Adam. I just wanted to say hi as well. Nice to have you here.
Hey, it's so good to be here. I got some great presentation. I got a whole presentation here, brand new one. It's like a two-parter. It's 2 presentations in one. Wow. You know, I really like what Boris said there about keeping it simple. That always resonates with me, and that is.
Wait! Before you start, Adam, I just wanted to say, thank you so much for being part of this. Really appreciate it.
Hey, there's Blake.
Thanks so much. Maybe that'll take that.
Great to have you. I'm going to let you go. I just want to say thanks for being here. You're awesome. I've followed you for years, even before Forex Live. So.
Sorry to make funny faces. Yeah, thanks so much. Listen, this is I got a great presentation for you. I'm bringing it. I think I'm bringing my A game here today. So Thanks so much. And let's
take it away, buddy.
See if I can show the, I don't want to run out of time here. Share screen.
You have a PowerPoint?
Got a PowerPoint? Doing it.
A powerful PowerPoint.
Well,
there we go.
Anyway, nobody's worried about the format. It's all about the content, right? Same as Forex Live. It's not the prettiest website in the world, but it's the best one as far as I'm concerned. All right. I don't want to waste any more time.
It's with the greatest of pride that you're announcing how humble you are.
Wait, I'm just getting started, Dale. This is the about me part. This is where I really go off. Is that you? Can you see my screen there?
We got
working about Adam.
We got
when my hair was a little shorter, when I didn't have the COVID-19 haircut there.
When you were a bachelor traveling all over the world.
Whoa, you remember those days in Panama, Dale?
Yeah, I do.
Oh, living in the Trump Hotel on the Pacific Ocean. Swimming at lunchtime every day. Better than this weather. Okay, I'm going. Okay, it's a bit about me. So Forex Live, hope to catch some new people here today. We have probably the biggest Forex Twitter handle at Forex Live. I've written over 100,000 posts. I don't know, that might even be 200,000 posts now about FX. We're in the trenches 12 hours a day, every day, 24 hours a day as a team. And we're all about staying on top of everything. And like Dale said, I forget that expression you used already, but that was a good one. Okay, so this was kind of a two-part presentation. We're going to go about the headline presentation, which is awesome, and then we've got one with some trade ideas at the end, talking about what's happening in markets now because it's so exciting. Right now, I've been using this kind of meme a lot lately. Chaos is a ladder. It's like Littlefinger from Game of Thrones. This is the chaos. Welcome to the chaos. You want to climb the ladder? You want to get rich? It's time to get into it. If you want to run away, you're missing out on a great opportunity here right now. And kind of the point is people look for a life raft sort of during this, but nobody knows anything, and it's tough to use someone else's conviction. And it's important that you get in there, but you stay in the game during this time. Right now and I'll talk about it later, there's a bubble in bubbles. There's this Wall Street Bets crowd, there's options traders. It's insane out there. I even know people who had no interest in trading. Suddenly just lost $25,000 buying put options on the SPY. So that it is changing the game a little bit. We're going to have some trade ideas at the end. So let's go fast here, pay attention to the presentation. But the first point is pay attention to what's happening. Read everything. I think that is the key to trading fundamentals and trading news. And it's really, the Warren Buffett school. And I read news. He reads 10Ks and 8Ks. And you really have to get opportunities, you have to be on the ball all the time. I mean, it's a difficult thing to do if you don't like it. I love it. Yeah. So that's what I do. And we try to bridge that gap because there's an information overload. One thing you should do is pay for news. Forex Live is 100% free. I'm not here selling anything. I'm doing this because I'm just trying to help people and because I love it. Just promoting Forex Live. But we'll say if you are paying attention, there is little edge in scheduled news. There was a time when I first started trading. If you had a Bloomberg terminal and you were watching news releases come out, like PCE came out today, or initial jobless claims, and you could sit there and you just click buy, click sell, like right when it came out, you just make money all day. It was a very brief period in my trading career, but a lot of my mentors, they got obscenely rich just doing that. Just click. Those days are over, unfortunately. Now it's more about anticipating and game planning around.
What ended that, Adam? What ended that phase?
Computers got faster than us.
Algos. Okay.
And and that was sort of the end of that. And
okay, thank you.
Just got so technology was advancing, right? There was a time you could have, an algo could have been there, but the bridge between the execution on it, you could still do it faster, man. And in a lot of cases, you still can, but it's not on scheduled news, right? Because those are numbers they're very easy to set up an algo for. So whereas they're headline scraping algos as well, but they're not as aggressive, number one, and you can outsmart them. Write things down. Another thing, if you're paying attention, I'm blessed, I feel, to work at Forex Live because we're just writing all day and it helps you clarify your thoughts. But if you are doing
NLP.
that, keep writing down. Yeah, that's how you stay in the game. But the other thing about it is you got to pay attention. You got to be prepared. So this was one of the best trades I had in a long time. Best trade this year. I don't know how many thousands of dollars I made. It was the low. I don't want to say it because it'll sound uncouth on here or whatever. I was just watching CNBC. It's like 3 weeks ago. Joe Kernan, who I despise, comes on CNBC, says, I just got a call from President Trump. He says Saudi and Russia are going to cut oil production by, 10, 15 million barrels per day. And just like, you're just ready. Yeah, you got to have your stuff up. You just buy oil. Give me all the oil, everything I had. And that was it. And then he tweeted it like 5 minutes later. Oil went up 25% or something in 15 minutes and close up position. That's all she wrote. I mean, that's your whole year right there. So you're spending 8 or 10 hours a day for those opportunities that come. You have to be fast. You have to be aggressive when something like that comes on. And there may be like 50 opportunities like that globally throughout markets, with strong fundamental trading a year, and you'd be lucky to even trade 5 of them. And you probably screw up 3 of those. But if you do it right and you're on the ball and you're paying attention, those come up. And right now we're in this period where there are far, far more of them than normal because so much is happening, so much is disconnected.
50 a week now, Adam?
Yeah, exactly. 5. I mean, in oil, like I'm going to go off about oil because it's just been crazy right now. But it's also important. I talk about being aggressive. You have to stay in the game. It just pains me. I mean, I've been at Forex Live like 10, 12 years now. Just seeing people blow up and go away. Like you feel on one hand you can't help it. Like people are going to blow up. People are going to do stupid things. But it's like my life's work to try to make it better. So talking about oil. All right. So look at this tweet. It's up on your screen. What jumps out to you about this? I use this as an example because I like Amina Baker and she's awesome. There's so many good oil journalists on Twitter that have helped me so much in trading. But what is it about that tweet? All right. He's talking about Mexico. This is like around the OPEC decision time 3 weeks ago. We're talking about a difference of 125,000 barrels per day here. And the tweet, like the volume of news at this time is just silly. And what stands out is 543 retweets on this. Look at all these, like who is reading? Like it to me was a dead giveaway. And I wrote about it the next day that this is insane. How could there be that much? Like, because it's meaningless. I mean, 125,000 barrels per day in the normal times maybe would mean something. But there's like a deficit of between 10 and 20 or even 30 million barrels per day of demand. And like it just didn't matter. And it was a dead giveaway to me that there was just dumb money. There was way too much money and interest in oil because like I'm an oil guy. I'm all over that. I would never, ever retweet something like that. To the Forex Live people because it just didn't matter at the time. So who was doing it? And it came out later that it's this bubble and bubbles thing that there's so many people suddenly trading oil. So they went from pot stocks to Beyond Meat to Tesla to whatever the heck it is, and then it was just suddenly oil was the thing. Everyone was buying, just piling in, and it turns out the headline that I wrote when I was writing about this tweet was, where are all the tourists that would be in New York and Paris right now because of the lockdown? Evidently, they're all trading. They're all in the oil market. So that's kind of
Adam, the number of retweets, that was a signal to you that of what again?
That just dumb money was flooding into oil.
Okay. That
people were in oil that shouldn't be in oil. That something at that point it was just like something is weird is going on in oil because how could some people were trying to tell, well, there were people in Mexico were really interested, but it was just an example because there were, the same day could have picked a dozen other examples of things that that didn't matter for
people really, hoping for a rally. It told you that people were hoping for a rally.
Well, yeah, it did. I didn't take it that far. I just said, wow, why this? Like, there's this, and I'm following the same people all the time. And you just suddenly everybody's on this trade. You're like, what? And they don't know what they're doing if they just got into that this week. So it was just this sudden spike of interest. And you can see it in different ways now. It's like, okay, what are they trading on Robinhood? Or, You know, even if you just look around the internet, what's the buzz in? Now, if it's something like Microsoft, well, it's not big enough to make a difference. But I guess in other things it is. And you know, you're just piling into these teams. So you got to get ahead of them. That was such an awesome opportunity. I'll like sort of skip ahead. I know I'm talking fast here too, but
no, it's good. That cartoon was good too.
We take it from there, and then it was just pull it in what I wrote about, and we figured it out. You know, it was like a few days later, we was like, what the heck is going on in oil? And it was USO. You started thinking, okay, you start to see the stuff out there, the numbers of USO. You crunch the numbers, and you say, okay, now they have 27% of the open interest in USO, and they don't know that needs to be rolled over. Like retail is just obscenely stupid over and over again. And some of those are the best tools out there that just show you like retail positioning when it gets stretched, and just go against it, like the bottom picking. I mean, we talk about it all the time. This chart showed the shares outstanding in USO, and that was it. Okay, you were trying to figure out who's watching. Oh, it really is dumb retail traders coming in, buying USO, which they don't understand what it is. And if you're in this presentation, you don't know what happened to USO. It essentially blew up, and you know, just killed trades here. So here, it seems to me that the trades to short USO or the June contract. What did I do? I shorted USO. Like that was it. It got cut in half. Thank you very much. And it was a mathematical trade. It was so obvious. Like I said, these are the value of all the oil contracts we own, which was $3.50 a share. And here's what oil's at, $4. Or here's what it's trading at. USO is trading at. And you're just like, well, this thing is trading at like a 25% premium to net asset value. It was it doesn't get any better than that. So you're paying attention. You pick up on those. And you kind of, you watch what others are watching. You figure out what's the hot ticket right now. And that, I think, is how markets are evolving. I go fast here. Sorry, it's probably a little bit over the top, but economists are stupid. You look as somebody who's reading a lot. The temptation is to read things that you want to hear and to look for some sort of orthodoxy or comfort or somebody who knows something. And you'd just be disappointed by, they're very predictable to begin with. Why hasn't there been a reckoning about 2019? It was a story in 2019 in markets. It was the U.S.-China trade war. And you had like a zillion economists, every single one of them coming out saying, this is going to kill GDP, blah, blah, blah. It didn't. It didn't. Why were you so wrong? Then you're listening to it, and I'm listening to it thinking, well, these guys, I don't know, they crunch the numbers. They were wrong. They were at like 100% wrong. You just cruise right through it. And they're just always wrong. And it is so, there's such the field right now of economics. I don't mean all economists. I just mean like the mainstream. It's just such a herd. And it goes around and be careful about following it. This is the echo chamber. And what the edge in it, because that's what this is about, is seeing things that they consistently miss on. So CapEx was a good one for the last 5 or 6 years. So it was always, growth's picking up. Now CapEx is going to pick up, which is business investment. And we're going to see it again coming out of this. Okay, where's the business investment? It was never coming because technology has changed business investment. And economists struggle with technology, right? Because it wasn't in their textbook 25 years ago when like Kenneth Rogoff was teaching them or something, and they just cling to that like it's the Bible, their old textbook. But technology changes everything. Like, what's Walmart investing in right now? Walmart used to build a store every week in the United States, probably twice a week. And you need thousands of people and millions of dollars to do that. Now, the only thing they're investing in is their website, which is an investment, but it's not at the scale, so that doesn't flow through in the same way as CapEx usually. Technology investment has changed the investment game. There's no creativity. So be careful. Moving on. Central banks are everything. And I think we learned this the last month has been the greatest example of this in history. And there's Stanley Druckenmiller, one of the great traders of all time, 30% a year for 30 years running or whatever he did up until about 10 years ago. Earnings don't move the markets, the Federal Reserve Board. There it is. this headline there is from back October 31st when Powell came out and I don't know if I have the quote here on this slide, here it is. I think we would need to see a really significant move up in inflation that's persistent before we would even consider raising rates to address inflation concerns. And it was like a dead giveaway to buy the market. And it was, the market had a nice run. I don't know what the S&P 500 was up from there, but it was 15% or something like that. It's so important. And we saw it again, March 23rd, they came out, unlimited buying. Market had a bad day that day, but it's been straight up since. And, you get, it's just the second level of it on is that second point there is that how they interpret the world is more important than reality. So if they think they're heroes, they are creating this long-term bubble, which I'm going to talk about in the trades at the end, but they enjoy their power. And one of the great things you really want to realize, I know I'm going fast here, is that really the aim of all power is to get more power. So any institution that has power wants to get more power. And any crisis is an opportunity to get more power. And that's the same chaos as a ladder. And like the Fed here is expanding its powers, combining with the Treasury. The Fed has never been more powerful. And what do they want? They want the markets to go up. And that's it. That's it. Like it's not any more difficult than that. But when you have like the ECB today that doesn't have the power, right? They can't manufacture the power without the help of all the governments in the Eurozone. So that, and different banks have different mandates and different powers. So but their aim is to make credit cheaper, right? New point, changing gears, fade fear. This to me, if you're a fundamental trader, this is the trade. This is the easiest trade. It's the easiest trade in theory that's out there, is the fade fear. So this is like a meme. I use it all the time. It's from Shaun of the Dead. And he said in the movie, let's go to the pub, wait for the whole thing to blow over. I had the Ukraine thing. So that was 2014. Nobody even remembers Ukraine. It was like World War III for a few days in markets. We're just writing. The whole thing's going to blow over. There's no World War III coming out of this. But 9 times out of 10, that fear is wrong. The problem is you feel fearful. And it's the most powerful emotion. But when you recognize that fear out there, and that is like reading a lot, and you just get the sense that people, all right, everything's going to be fine. You have to have as your core belief that everything's going to be fine. Otherwise, markets it's very difficult to win in markets if you're like a natural bear. I use the World War III trade all the time. I say, what's the trade? I ask people if there are, if you hear a report or a rumor that nuclear bombs are in the air. And people always say, well, sell everything. You say, no. You buy everything. Because if the rumor is right, we're all gone anyway. If the rumor is wrong, markets are going to bounce back. So it's kind of the trade on a lot of things that when fear is out there. Also need to remember the long arc of history is positive. And it's up and to the right. Now, I say 9 times out of 10, the fear is wrong, which means 1 times out of 10, the fear is right. So, as I talk about my process of doing things, the first thing I wrote about coronavirus was the same, you let it all blow over. Now, in the same post at the same time, it's going to get worse before it gets better. But the point of that is you can't make up your mind and keep a position. You have to keep reading. So we talk about, all the things, and sort of writing as it's going on. And you have to realize that it changes. So when let me pull up some of this is going down, you're kind of, you're out there and you're saying, okay, let's not worry too much. So this is January 21st too. And now you see what I'm writing about. Okay, let's look at some papers. Now let's compare it to SARS. Is this going to be worse than SARS? Well, how much did SARS hurt growth? Well, it cut Chinese GDP by 1 to 2%. That's significant. And then you kind of extrapolate that out, and then you're kind of working on a model. And that's the same day. And then you take a position, but you always have to challenge it. And then you see by the end of that same week, the 24th of January, saying, okay, this is real. So you realize my first instinct was wrong here. This is going to be a lot worse. They're closing things, on and on and on. It's just kind of breaking down the numbers. And and you stick with the theme until it changes. Really, it was very painful trade for a while because markets were going out, it wasn't being appreciated. But it was early March, talking about a full-scale panic, and then it happens. So it's really to challenge your beliefs. I misspell beliefs there. I apologize, and be willing to change your mind. And that's sort of a difficult thing. I'll talk about that a bit more. Finally, if you are reading a lot, don't read conspiracies. I am so sick of it. People send them to me all the time. It's a waste of your time. I mean, any kind of conspiracy. Yes, we know the government is corrupt. Yes, companies are cheating. Yes, the entire system is a sham. And it's partly true, a lot of it. But you're not going to make money doing it. If you're in this to make money, and it's like I have people I trade with, and we want to talk politics all the time. And we'll be in a good conversation about valuations or some angle. And they're just switching into politics. Let's not do that because it's not going to make us any money. And it's, because it's out there. So many people are talking about it. It is interesting, but you just avoid that rabbit hole of thinking.
Save that for over a cocktail, huh, buddy?
Yeah, well, it's it. There is free Friday night or whatever.
Yeah.
If you're in the business, just, you go on Facebook, you're like, really? Wuhan lab invented this? I don't know. I don't really care. This is it. People are dying. What's the economy doing? We'll let them sort it out later. I don't think we're ever going to get an answer. I watched this show on Waco on Netflix. Man, I always thought those people who committed suicide burned it. The government did that. It was a big conspiracy. They covered it up. But whatever. Who cares? If you're in this is not your job. Go ahead and rant on it or something, like Twitter, whatever. But don't waste my time with that.
Hey, Adam, it's funny. Ashraf put out a tweet about COVID and everything, and certain things that were terrible about it. I retweeted, yeah, Ashraf, but where do we sell the S&P?
Yeah, that's it.
Right? Isn't that it? Where do we buy it? Where do we sell it? Right, bro?
Yeah, and if it is, and I believe it is, like an 8-hour-a-day job, if you really want to make money in markets, is where you put that energy. And if you want to put it into that, fine. Put a little bit of energy into that, but don't think it's going to make you money. It's a distraction.
I'm a betting man. I bet 8 hour a day is a short day for you.
Oh yeah, all the time. It's easier when you love it, and you do waste time. So it is what it is. And this is kind of the final point. I think it brings it all together. Is that conviction meanders, and I could have told you back in January I was very, very worried. I was worrying about coronavirus. You saw it. I wrote it down.
Yeah.
But then you see the market go against you for 3 weeks, and then you're out. You're out writing things that this doesn't even make sense. How is this? You need to see some of the things I write. It's just
Adam, I don't know if you mind if I bring a couple of the viewer questions to you during your presentation, but
yeah,
Rolando,
okay, we're kind of between the two parts here, so yeah.
Okay, Rolando is asking, what is your number one thing you see to trade fundamentals?
What is the number one?
Number one thing.
To trade fundamentals?
Yeah, for trading fundamentals.
Well, forexlive.com. What else is there?
That's okay. That's a good answer.
Okay, but the number one thing is, I would actually go back and just say, probably maybe it's because it's on my mind, is that you have to have a positive long-term view of humanity, because there's this balance where most news is negative, but the arc of human history is positive. Wow. And that divergence will lead you to making bad decisions more often than not if you don't have a core fundamental belief that things are getting better.
Yeah, it costs me to be negative.
Well, it's tough when you're fighting the Fed, right? This would have been a heyday, and it was for shorts. And I was there too. But man, I'm not going to talk about coronavirus and what the trade is here, because nobody knows. It's crazy. But that's all I want to say about that.
Okay, so thank you, buddy.
Very negative in January, early February. And then I'm just writing it. Fundamentals are dead. This cheap money is out of control. I kept writing that if China is to contain this, it would be the greatest public health victory of all time. And you think about the technology, they came pretty close. But, it was tough. It was tough to be negative. So conviction meanders. And here's another example. So you see this chart here, and this got a lot. It was one of the things I wrote that got the most views ever. was in March 17th. You see there, oil $28, and I'm saying this goes to zero because people they don't really understand. And then you can see the responses. They're impossible. You make yourself look ridiculous, and it was just it was a fundamental trade and just a misunderstanding of really how oil works. If you think of it like other assets or even other commodities, oil is a negative yielding asset. So it's valuable in the ground and it's valuable once it's in your car or going into your car, other end products of petrochemicals. But in between is a huge liability to store it, to move it, to refine it. And the whole system only works because they can do it so quickly. But once you back it up and there's no end demand, it just becomes worthless and a burden, especially if you're pumping more and more out of the ground. And that's when people were saying 125,000 barrels a day, we're tweeting about that. You're like, it's stupid. What you have an excess of oil is a burden. So, but as you're doing that, and when you're right, it's tremendously right in something like that, it's easy to be right. I could tell you 100 examples of when I've been right, a million, but it's hard to stay right. And that is the real art of it. And it's, to me, the key, the magic is getting the position size right. So you can talk about, listen, I wrote about oil. I could be on a beach somewhere. If I had gone all in on this, I could make realistically, $100 million on that trade. But conviction matters. It's hard to lose money and maintain your conviction. And that's what position sizing is so important. You got to compound the gains, stay in the game, and you eventually get rich. And but you can't, people can do it overnight. And different people are different. Some people can tolerate more risk. I'm a fairly risk averse person, even when I have a ton of conviction in something. Because I don't need to make 100% tomorrow. I like what I do. I like doing it.
You have a ballpark percentage of position sizing compared to your account and average risk that you'll take on these trades, Adam?
Like something like oil. I mean, I have if I think it was 10%, somewhere between 5 and 10% at various times, okay. And then upwards of more at 25%. But never more than that. I mean, even on Kernan, giving a dead giveaway on oil, because there's always something you can miss. I mean, you just don't blow up. And then kind of along with that, is just know the time on your trade. But in terms of position size, it depends on who you are. I mean, God bless someone if they saw this and bought some puts or puts on futures. Or just sold the futures. I mean, the upside was insane on that. I mean, nobody saw negative 35, but I did see zero. And anyway, so that's that. Give me another question, Dale, because we're into the second part here. So I got some stuff to shake up here now. Any questions? All right.
Does this mean that day trader, long-term trader, or different session trade? I'd call you a scalper. What do you think, Adam?
Well, I disagree with that a little bit, Dale.
Okay.
Yeah. It's all of them. It's all of them. I mean,
okay.
there are things you need to have. They play out, and some of the ones I'm going to talk about will play out over years. And other ones, but really what we're doing on the kind of the intraday basis is fine, and it is Forex Live is valuable for that. It's finding out what's happening right now, what it means, and what the opportunity is, if there is one. And 9 times out of 10 there isn't, but you got to be ready. So that I guess that's what I'd say to that. And then I guess just the final point on this point, I almost forgot it, is listen, if you want to trade, it's tough. The greatest path to prosperity is buy and hold investing. If you just want to go long stocks, forget about it, probably do pretty well. The history of it's pretty good. I mean, you compound 10% a year for 20 years. It's a big number. So, consider that. But there are other ways to make money, leverage money, compound that. And I mean, you're obviously here to trade. So just keep that in mind, because I just hate to see people blow up. All right, let's talk about, you can pepper some questions in whenever you want, Dale.
Okay, buddy.
this is part 2 of the presentation. I only have 10 minutes left. Is just sell oil. This trade isn't over yet. Oil, like boom and bust, is the heart of commodities. Is every oil? Nothing has changed under the sun. As oil booms, they invest a ton of money in bringing more oil online because there's a 3 to 5 year lag in a big oil project to get it up and running. And we're still in that. And now, so it's a massive overproduction, and it hasn't changed. And it breaks my heart to see, I explained some of this already, so many people long oil right now. And we're back up, I think, around $20, $18, $20 in the front month. That's the time to bet against oil. And I just don't even think this is close. And we're getting closer to expiration. But you know what you're trading, know how it works. In the long-term history of the oil market, 1 to 2% imbalances have led to huge overshoots and undershoots in price. Right now, we're somewhere around 25% oversupply. It's unprecedented. There's nowhere for the oil to go. Tanker rates are insane right now. It takes time to slow production. And then I think coming out of this is the big trade, is the then buy part, is that shale is dead. Shale was a massive lie. This is fracking. It was supposed to be $20 oil, unlimited oil. Nobody made money last year at $55 oil. Nobody in shale.
Adam, I assume that somebody has to tell the US government because they're about to bail out an industry that is indeed dead.
Yeah, well, they're bailing out a lot of dead industries right now. And you're right. I don't know how far this bailout is going to go. And it might have to go through Congress. And, they're giving away space in the SPR here. But it's just delaying the inevitable. It's dead, though. Nobody will lend money to shit. Anybody who, this was going to be the trade of the year before coronavirus happened, was on the other side of shale because it was going down.
We had Mark Yusko yesterday here, and if I remember right, he said that the industry has burned something like $50 to $60 billion.
Yeah, and it was, it was this dream. It was one of the great sales jobs of all time, but it was out and out fraud. Every part of it was fraud. And, in a proper world, someone would go to jail. We don't live in a proper world, and what's going to happen is, it's busting. That production's never going to come back. And if the boom and bust cycle of oil is nobody is investing right now. Nobody will invest in shale ever again.
The banks certainly will not finance that again. And you talked about it several months ago about all the bad debt that had to be rolled over in shale, and that's before things fell apart.
Yeah, I almost lament that the trade didn't play out. Obviously, it did.
Dale, don't be 100% sure about the banks not financing it, because as long as the debt will be guaranteed by the government,
that's true.
They might as well finance it, right?
You have to make money.
I keep forgetting about Uncle Sam.
Yeah, you see.
Uncle Sam's pockets are really deep, aren't they?
It does. But
you mean the printing press is really deep.
Change the rules of the game. But at the same point, it's not just shale right now, right? There's no investment going into anything. If you read any oil company report, even this week, the amount of CapEx they're cutting is unreal. And that's all for oil that's going to come online in 3 to 5 years. And a lot of the major fields are running off in that time. So there's a question about how much demand really comes back. And that is very uncertain right now. But I'm sure that the demand to come back is going to exceed the easily accessible or online supply. And I don't think that's a trade for at least 6 months, and maybe not as much as 18 months. But buying oil and oil companies is going to be a sensational trade because the majors and bigger companies, they're going to pick up assets that are so cheap when these companies go bankrupt that you can't help but make money. I believe that as sure as the sun will rise, it will be back to $80 oil in 3 years. But again, it's like every trade. Timing is everything. Okay. Trade 2 these are the 2 words that are going to define the 2020s. Debt monetization. So, and you can argue it's been going on for a long time, but I don't know if I should play this video, but I'll play the start of it. I don't know if it'll run through. Has anyone tried to play a YouTube video through this before?
Yeah, I don't think it works in Zoom. I'm not sure, but
no, you can actually do it, but you first need to, if it has sound, you need to also share your computer audio.
Okay. Well, there it is. Anyway, or I'll just read out what he's saying. She asked about debt demonetization. That's the leader of the Reserve Bank of New Zealand. He says he's open-minded about it. I'll give you the link after. Which is just an insane thing for central banks to say. I feel like it gets back to the core of what central banks are. And if you look at the history of central banks, one of the big roles is like the protector of money. And that morphed into an inflation mandate. But beneath the inflation mandate and it is in a lot of central bank mandates, like the Bank of Canada's protect the currency. Australia has a similar sort of mandate. And then other mandates sort of got perverted into inflation, because inflation is kind of the second round effect of devaluing money, obviously. But their role is to separate governments in a way from the money. So you can be like Italy, right? Italy's government is broke. And yet Italians are on median wealth is higher than Germans, which is a rich government in comparison. And one of the reasons why is because the money is separated from the government. And you can have a government in our system that can spend unlimited deficits, but you get rid of them every 4 years or whatever your election is. And central banks are that kind of independent wall to make sure that they can't get their hands on the, printing indefinitely. So QE was a little bit of a backdoor into that, right? But outright debt monetization allows you to spend at unlimited amounts. And that's where we're headed, is really where we are headed. The deficits don't matter. And the U.S. is the winner in this. What was the great weapon of the United States in the Second World War? It was the nuclear bomb. But what was the greater weapon coming out? It's the U.S. dollar as the reserve currency of the world.
Yeah.
And it's far, far, far more powerful than anything else. And what happens is the U.S. is going to build everything and the rest of the world is going to pay for it, is one of the things. So your central bank, wherever you are, has massive U.S. dollar reserves. The whole system functions on U.S. dollars. Half the U.S. dollars in the world are outside of the U.S. And by monetizing, essentially, the rest of the world is paying half of it, because you're devaluing the dollar is how you're paying for all this. This is an unbelievable trade-off for the Americans to spend. And it works the same with other large reserve currencies. And my belief is that it will go on for a long time. We know how it ends. In that clip of Orr, he talks about it. There's a lot of risks around debt monetization, inflation, blah, blah, blah. And we know that if you look at, well, you can't really see on my wall behind me, but there's Zimbucks on it. It's like a chart of the Zimbabwe dollar going from $1 to $100 trillion as they printed and printed. But I believe, and for the next decade at least, that it will go far. Like we're going to have a $5 trillion deficit in the U.S. this year. And I think that's going to be par for the course. I mean, maybe they get it down to 3 or 4, but $1 trillion used to be obscene. And we're just going to see how far we can take this, because the deficit taps are wide open. And, history has proven this to be the end of empires over and over again, but we're going to do it again.
Besides gold, Adam, is there a fiat you prefer during this scenario that you're talking about?
I think about that a lot. And you'd think, well, some places, they don't really have kind of the same system, but they could change the rules. Indonesia on Tuesday became the first country to directly do it. So there's the QE, that the end around is you sell debt at an auction and then you buy it in the open market. Whereas Indonesia on Tuesday just bought it directly from the central bank. So, it's kind of on the next slide here a little bit that I think this will play into it, at least in the short term, but we're talking about a decade-long trade. So much can change over time. And if you look at the structure of currencies, really the euro is best protected from that, because they're never going to give the Germans especially will never give the ECB that kind of power. But, I don't want to buy the euro for other reasons, namely terrible growth. So, gold, silver, I think Bitcoin is like can capture that imagination. You can't fundamentally value it, but I think there is a nice uptrend there right now. And then it's like equities actually do pretty well. And you kill growth, but you can pretend that everything's rising. That's the magic about devaluation, is the price of everything rises, but you also get more wealthy, like if you own stocks. So, even if I saw some great charts lately. It was saying gold versus the S&P 500 for 40 years, and it's down. Like gold is higher if you take out dividends. So it's, which you shouldn't really take out, but there is the case that we have been devaluing for a long time, and a lot of the wealth we've created is a bit of an illusion by technology. But the trade, and those are sort of the first two are a bit longer term, but right now it's to buy Australian and New Zealand dollar. And what's hard about that trade right now is, and what makes it, and I guess I'm out of time here, is that the old rules don't apply. Those used to be like pro-growth currencies. They used to have high rates, and that was why you bought them. And now they don't have those, but what they do have is no coronavirus or minimal coronavirus. So they can reopen, and that's going to mean growth will be still -3 to 5%, but everywhere else is going to be -5 to 10%. And there's this flood of money that's looking for somewhere to go. And
New Zealand has zero. I just saw a feature on New Zealand.
And they export soft commodities, which will still be in demand more than hard commodities. So I like them both, and there are different ways to play it. So Aussie dollar, I think, is going to 70. And I wrote about this at the start of the week, so we're kind of into the money in this already. But, they need the tourism, they need the exports, but relatively, I think it works. And you could pair it up with something like CAD if you're worried about the risk trade, or the euro, or USD if you're feeling a bit more optimistic. I'm not entirely sure what the best trade is going to be on that, but I like both of them against the rest. In this sort of long term, I believe deglobalization is coming, and the Mexican peso will be a massive winner in that. Just because they are, anyway, that's, I guess, I'll just leave the slide there. ForexLive.com. Check us out. Big education portal. Lots more like this. Some high energy stuff like this on YouTube. I hope I didn't talk too fast. I hope I entertained you.
Hey, Adam.
Adam, great presentation, buddy.
First of all, thank you for your presentation. Second of all, I think we can have a very nice debate. I agree with many of the things you said, but why don't you come by face one of these days? Coach, when do we have an opening for Adam?
Every Friday.
Okay, so Adam,
we'll work it out.
Set it up, and
okay.
I'll be happy to discuss with you a few things.
Sure. Okay. Well, thanks so much for everyone for coming. You can always ask me questions at forexlive.com, in the comments on Twitter. Hit me up there, and that's probably, we have a Telegram channel too. You can find the link on our site. I'll answer your questions there. So sorry I didn't have time for questions. Thanks so much for coming. I don't want to take anyone else's time. Thanks, Dale.
You're the best, Adam.
Thanks for the
Thank
time.
you so much.
Thank you very much, Adam. Thank you very much.
Live on Twitter and www.forexlive.com. Thank you, Adam Button. And now, I believe we have someone presenting from the Chartered Market Technician Association, CMT.
It's Tyler. Hello, Tyler.
Tyler. Tyler, nice to meet you.
Nice to meet you as well. How's the day going?
Good.
Great
How
day.
have you been?
Been great. Hopefully we'll make it through the next 15 minutes without a visit from my 5-year-old. But I've really been enjoying this conference. You guys have put on just a tremendous event. Really, really well done.
Thank you for joining us. And, I think a lot of people would be interested in the designation that your organization provides, and price is everything. And I always believe that there should be some type of accreditation for people that call themselves technicians. So
that was the idea years ago. Yeah.
Okay.
Let me see if I can share my screen with you all.
It's a green box.
Seeing
be on your drop-down menu. There you go. Okay.
Yeah, we're okay.
Yep.
Absolutely.
Excellent. Well, my name is Tyler Wood, and I'm the managing director of global business development and my good buddy Joe Perry called a few weeks ago and mentioned what you all were putting together, and we we're thrilled to take part in this. Really can't thank you guys enough for inviting us. And what you have hosted yesterday and today is exactly what the CMT Association stands for. That's our mission, and it has been a little different these days in terms of execution. I don't know about you all, but I have never worn so much flannel consistently over such a long period of time. It's well, maybe not since Nirvana and Pearl Jam were topping the charts, but this situation is pretty unprecedented. But thanks to Forex Analytics and all of the presenters, there's still a tremendous opportunity for people to come together and learn and have some thoughts and ideas shared that could help all of us navigate these volatile markets. So there's no disclaimers on this presentation. I'm not here to teach anybody how to trade or make any market calls, but instead I represent a very large, a very old organization that has been committed to advancing the discipline of technical analysis. We've been doing that since the late 1960s. So just to kind of recognize where we are in the state of play right now. This bloodbath has not been just for the debt and equity markets. We've seen U.S. and Japan, both longs and shorts, stopped out by this volatility, and it's just been an incredibly unprecedented event for people who traded through Swissy unpegging to the euro dollar. I think this volatility may have even outpaced that, and this range right here is incredibly narrow. Historically, and we're looking for a very big move out of here. Below 106.92, it's probably headed lower, and that double bottom pattern certainly increases that likelihood. But the CMT Association is not it's not in a position to tell you where to place your trade, but rather to help you develop a system of tools to understand occurrences like this. And while this volatility might be somewhat unprecedented, we've certainly seen a lot of scenarios like this in the past, and we will see it again. I just thought this chart, which was actually shared to me from one of our board of directors over in the UK, just the correlations between currencies and the S&P are just tremendous right now. So for everybody, the thousands of people who've registered for this event, and for everybody around the world trying to make sense of a market like this, we obviously need to, band together, talk to folks with expertise, with history of trading through multiple market cycles, and find out what has worked for them, what their approach is, their philosophy, and their discipline. And that's really all that the CMT Association, stands for, and that's why we exist. So I mentioned it's a very old organization. We got started in New York City in the late 1960s. It actually began with a number of sell-side equity research analysts, names that you might know, like Ralph Acampora, Bob Farrell, and Art Merrill from Merrill Lynch, just helping the organization get started and recognizing that technical analysis, a discipline much like fundamentals, really needed its own designation, its own place for meeting and sharing collegial ideas and exchange of what was working and what wasn't working. And
those guys updated their charts by hand, huh, Tyler?
That's exactly right. I don't have enough gray in my beard to remember those days, but you mentioned it right, Dale. It wasn't just a New York phenomenon. Technical analysis is the oldest game in town. Folks in Japan and the rice markets getting things started hundreds of years before that. But that's just a shot from the Fidelity chart room. And the largest and greatest mutual fund portfolio managers also use technical analysis. You can see the technicians with rulers and pencils. In fact, we have in our library about a decade worth of hand-drawn charts from the Prudential folks. These were Ralph Acampora and his team's charts. And when Dow broke 10,000, it actually went through the roof, as in their pencil lines had to break through the ceiling, and they folded the chart over. So the discipline has been around for a very long time, but obviously changed dramatically with computing power and really just the advent of technology in the marketplace. So you fast forward to today, our organization is global. As I mentioned, the work of John Murphy and many others helped expand the organization beyond the equities and fixed income world recognizing that technicians exist in currencies and commodities, managed futures, really any asset class can be traded using these tools. And so we've got over 35,000 folks who participate in educational content, engage in our programming and our networking over 137 countries. And really what drives our organization is this understanding that there's no silver bullet, but we know that investors need to navigate the gap between intrinsic value, or sort of your fundamental discipline, and what's happening with market price. And so the entire field of technical analysis is about addressing all of those market sentiment issues, supply and demand relationships for individual securities. And what we try to provide is a disciplined, systematic approach to understanding that market behavior and hopefully help investors change some outcomes, both in terms of their performance on a risk-adjusted basis, but also career opportunities. And as a nonprofit credentialing organization, that's the biggest driver of what we do. So I'm going to take just a couple minutes and talk about the CMT program. I know we've got thousands of folks who are committed to their own professional development and learning, who are engaged in this conference. Just a tremendous lineup of speakers. And I know I've already learned a lot tuning in yesterday to folks like Peter Bukvar and Mark Yusko, our very own Mark Newton, CMT. And so I'm really, really excited to be a part of this. But the CMT program is a globally recognized credential. It takes place over 3 exams. We offer those every year in June and December. And really what it does is it attests to a candidate's mastery of this body of knowledge. It's not one way to trade. We're not just teaching you the Wyckoff method or the work of Ralph Elliott or a particular trading style. But knowing that technical analysis works over multiple time frames, it's asset class agnostic, what we're really trying to provide candidates is a set of tools and an understanding of the discipline so that they can apply it to the way in which they trade, whether that's on a 5-minute chart or holding positions over 5 months or multiple years, as many of the asset allocators do. So the next exam is going to be in December, and certainly encourage those of you who are committed to your own professional development to think about carving out that time. I know Blake mentioned this morning it's not easy when you've got kids at home and a full-time job and a trading career, but I hopefully will provide a few things that let you know that this isn't impossible. Hey Blake, how you doing? And hopefully pretty accessible to folks on the line. Certainly everybody with that level of expertise is going to recognize a lot of the content that's in our curriculum. So what does the CMT program focus on? We develop the tools and the curriculum from a practice analysis. So we talk to hiring managers around the world, to practitioners of technical analysis and our own members, and we build the curriculum and the learning objectives off of what they say is needed in the industry, and what do they want on their next hire? What do they want that person to know in terms of knowledge, skills, and abilities? So we focus first and foremost around risk management, things like position sizing, understanding market risk, and a lot of tools around protecting capital. We do address a lot of the quantitative systems and the applications of technical tools. You do not need to learn how to code in a particular programming language, but rather understand the logic of how you would design a system, or if you were to test for signal strength, doing a lot of Monte Carlo simulations, forward and back testing, to understand if something will have relevance over time and over multiple market regimes. We center all of this around a portfolio management approach. So you're thinking about multiple assets, thinking about an investment philosophy and an approach that's going to last over the long term. And then we address a lot of applied behavioral finance. So in 2002, when Daniel Kahneman won the Nobel Prize in economics, I think the whole world was surprised that a psychologist would win a Nobel Prize in economics. But what he and Amos Tversky discovered were all these evolved traits, these heuristics that guide all of us. And they've been with us since we were cavemen. We realized that, traveling alone meant you might get eaten by a saber-toothed tiger. So we all huddle into groups. And those same heuristics play out in the stock market. So a lot of what we address in the CMT program is understanding how those psychologists might call herding behavior. We call that price momentum. They talk about the anchoring bias. We talk about levels of support and resistance. So there are statistical tools to help explain and observe and react to the behaviors of market participants. That's really what the CMT program has been able to deliver. And thanks to all of those behavioral finance experts in academia, we've had a lot more success recently with our academic partner program and a lot more education at the college and university level around technical analysis, as it's really opened investors' minds beyond just the efficient markets hypothesis. So why does anybody pursue a CMT designation? I think that's the main and most important question to answer. And it's really about an outcome-driven program. We're here to improve investment performance and then also career opportunities. So we did some survey work with recent CMT candidates that just shows what they experienced after getting the charter and the designation. Obviously, a lot of folks were promoted. They improved their salary, earnings. They may have even taken on a new job. But you'll see that note there, around 55% got more responsibility. And what that really translates into is assets under management. So the CMT credential as a globally recognized designation helps firms and clients develop some trust with their manager to know that that person has really strong risk management tools. They have a disciplined and repeatable process for investing. So for everybody who's watching this Trader Summit, thinking about expanding your own fund or bringing in client money, I highly encourage you to pursue the CMT program just as a way to get immediate recognition of your skills and that mastery of a really comprehensive body of knowledge. So what does it take to get past the CMT program? This is for you, Blake. We've got a pretty wide range in terms of recommended study hours, and obviously for those who are experienced market professionals who've been doing this for a long time, you're going to be at the very low end of those recommended study hours. But level one, it's a 630-page textbook. We've got roughly 40 to 100 hours, depending on your level of experience, in order to prepare to be successful on the exam. And that third line down, you've got the 5-year trailing average on the passing rates. The program is academically rigorous, and it's designed to be that way. This is not a gimme, but we do encourage all candidates to take it seriously, to put in the hours to study. And we've got about a 66% pass rate on average for the level 1 exam. So it's not impossible. You can do it, and if you take it seriously, you'll have a real chance at success. So we published that curriculum with our partners at John Wiley & Sons, Wiley being a large global publisher. They also produce the CFA curriculum, the FRM curriculum, the Kaya, you name it, in this world of alphabet soup. And they've been a great partner in terms of turning out a really flexible and living document. We do release new editions almost every year of the curriculum to keep pace with all of the changes in the industry. 5 years ago, nobody was really talking about Bitcoin and Ethereum and Ripple, and we've certainly seen the industry change tremendously since we've started in the late 1960s. So that link, efficientlearning.com, you'll find all of the CMT curriculum materials and the official guides. For those of you who don't already have the curriculum, they've also issued a 30% discount on all of the textbooks. For anybody who is interested, you can just type in CMT TW30, and that'll get you a better price on the textbooks. We have been growing tremendously, and certainly we find that education and credentialing tends to be counter-cyclical. Market events like this bring a ton of industry pros back to the drawing board to think about their investment process and what they're using in terms of tools to manage risk. So cyclically adjusted over the last few years, we have been growing by leaps and bounds, obviously across Asia. You're looking at 75% growth rate. So the North American region dominates our global membership, but we are growing faster outside the U.S. Than inside the U.S. And it really is a global organization now. And we host events all over the world, as I mentioned earlier, in Singapore and Hong Kong and Mumbai and everywhere in between. So we encourage you to come check it out, join us for a live event or for these online events, and get to know some folks with the charter. Ask them some questions.
Speaking of which, Tyler, you know that we have Joe with us. I mean, part of the team.
Hey,
He's
Tyler.
a CMD.
Hey, Joe. How's it going, buddy?
Good, good. Hey, I just want to say to everybody out there that although you do get the CMT designation, which is helpful, what you learn along the way as you're preparing to take the exams for the CMT designation will really help you with trading, especially the Forex markets, which relies a lot on technicals during slow times. But, you know, it really, really helps you when you're studying to learn about all the different places price may, all the inflection points or a place that price may revert, or just all these tools that you'll have at your disposal while you're going along the way. And one thing that I remember that is really different between technical and fundamental analysis when you're looking at the two is something that Ralph Akampora had said when he was going to, I don't know who he was going in front of, some board to try and get the CMT designation. And he said, you cannot restate price, you can restate earnings. And that was the one thing he said that kind of pushed the board over, or pushed the people over that he was going up in front of, and was able to get this designation.
That's a perfect segue, Joe. And in fact, the event you were talking about was December 17th, 2004. So for those in the U.S., you might be familiar with FINRA. That's our highest regulator in the land. And after Sarbanes-Oxley came out, they introduced the Series 86 and 87 exams for research analysts. Basically, their curriculum for those regulatory exams was equivalent to the CFA Level 1 curriculum. And Ralph and the board of directors from what was then the Market Technicians Association came out and argued in front of the SEC attorneys that you need to test us on our body of knowledge. And they said, well, technical analysis, you know, what isn't that voodoo? I mean, Ralph, show me one thing that's true on this chart. And as you said, Joe, Ralph made the point that price is a fact. You don't restate price. And for those in the fundamental world, you might be increasingly frustrated at how many times earnings are restated. And when that data does come through, it can often be an estimate, and it's built off of very elaborate models with a lot of assumptions built in, whereas price is the greatest truth of Mr. Market. So
price is a vote with your wallet.
That's a great saying, Dave.
Also, how many accounting gimmicks we have around, which, as you said, you know, price is what it is, right? Tyler, we have a question. It's going to be good if you can put it on the chat. Andy here is asking, what was the CMT discount code? So he didn't have time to write it down.
Sure, CMT TW30, and I'll post that in the chat as soon as we wrap up here.
Perfect. As you know, I've also given the exams for level 1, and I passed them now. I need to find a little bit of time to go through the curriculum for level 2, because as you said, it's not only technical analysis, some theory as well. So you do need to do some studying, but it's totally worth it. I can say that much.
Did you erase the answers you had written between your fingers?
Yeah, time to go back to elementary school, right?
Exactly. They take exam security pretty seriously over at Prometric. So my guess is
they do.
Own muster.
They do.
But as Joe was pointing out, the advocacy work that the organization does on an ongoing basis is really important for all of our charter holders. I spend a lot of my time talking to large mutual funds, broker-dealers, investment firms, about the value of hiring a CMT charter holder for their next open positions, and we do that advocacy work both with industry firms as well as government regulations. So we have ongoing projects right now with IROC in Canada, with SEBI in India, and regulators across the globe. And that's a really important part, I think, for our nonprofit to make sure that the longevity of professional technical analysis stays very, very strong.
We have to wrap up here, Tyler.
Absolutely. This is our last slide. we really appreciate everything that Forex Analytics, all of you have done to put this on. We exist for education, ethics awareness, and networking. And so in that spirit, invite anybody who's interested in pulling down a free white paper. We publish a lot of content, both online and in-person events. But join us, cmtassociation.org/chart summit 2020. This just came out from our Journal of Technical Analysis. It's an academic, double-blind, peer-reviewed journal. Take a look at the virtual crowd and the depth of investor sentiment. But thanks again, guys, for having me, and looking forward to the rest of the day's presentations.
Thank you, Tyler. Great presentation of CMT.
Yeah,
Thanks for joining us, Tyler. Really appreciate it.
Thank you, Tyler. Nice having you.
Yeah, thank you, Dale. Thank you, Steve. Thank you, Blake.
Nice to meet you.
Take care, Tyler.
Next on deck, Blake Morrow. Anyone ever hear of the guy?
Just before Tyler left, is Steve, you're getting your CMT designation as well.
Yeah, I told Tyler, I also told him in private, yeah, I aced level 1. Now, Blake, you need to tell my partners to find me a little bit of time to study for level 2. What do you think about that?
Yeah, it's a big commitment, but I think it's a very worthwhile commitment. I mean,
absolutely.
People, the list of people that have gone through the CMT designation is amazing, and it's one of those things that I've had aspirations to do over the years and just haven't had an opportunity. It's time is always an issue, but if somebody like you, Steve, have been able to make time to do it, I think anybody can really. Oh, hold on, we're seeing some pretty big moves here. So
dollar seems to be under pressure, yeah.
There's a lot of fixing flows going through. It's the end of month, and so it's created a lot of volatility in the FX market. We're seeing things move all over the place. Let's actually, what I can do is, let me see here. Before I get into my presentation, let's just see what's happening. We expected dollar weakness to come through the market, and you're seeing the wow, and then you're seeing yen. Look at the dollar yen, yeah. And what's crazy is stocks aren't even moving right now. Look at the spike up that you've seen in dollar yen. That's amazing. It's a big move in dollar yen, big move in the euro, bigger move in the cable, and this is all fixing end of month flows, which I knew that we were going to get some dollar weakness coming in. I did not know we would see yen weakness. And again, this has nothing to do with what's happening in the S&P. You can see the S&P is just kind of bopping around a little bit. So just a lot of really big moves in the market today. And just be careful out there. It's obviously things are moving rather quickly, and we must be coming up to the big. This is the big 11 a.m. London fix, so that's just creating a massive amount. Now, the first inclination for most traders is to just fade the market, but you have to be very careful in doing so. Now, I don't want to take away from my presentation because we've only got about a half an hour, and so I want to make sure I get to this. So let me. I have to go to a different screen. Let's see, new share, and all right, and I think this is a perfect time to talk about the dollar. And I know you guys can see I'm just kind of adjusting because I have multiple screens and I'm moving things around. And you can see this is my my Bloomberg launch pad. I got to move that out of the way, and I got to move these Bloomberg tabs out of the way. But first and foremost, before I go into the presentation, I just really want to thank you all for being here and being part of it. I know I've mentioned this about our team. Our team's done a great job. Specifically, Steve and Joe have done phenomenal jobs putting this all together. I want to thank all of our sponsors for, like Tyler, who was just on here from the CMT, for making this possible, helping making this possible. So thank you all for really being involved in this. Okay, so let's talk about, and let me see if I can, I moved everything around, so I want to figure out where's my advanced screen. You guys got to give me a second here. Okay, here we go. All right. So the discussion today was really about the dollar, and it's been quite messy. It's been a messy market, and it's been hard to make heads or tails of the dollar. And today, specifically, I mean, we were talking about the flows that were going to move the market, not so much, you know, anything else. And really, that's what's driving the market at the moment, are flows. But if you look around at what's driving the dollar and other currencies, it's just been a mess. And so what I've called it is really the quagmire of the dollar, because it's just kind of, like I said, it is a mess. So the dollar at this point in time is in a very tricky situation. And I say it's in a tricky situation because the Federal Reserve has taken so many steps, which we're going to outline them, so many steps into trying to mitigate the strength of the dollar to try to provide liquidity since COVID-19. And, you know, if you take everything that the Fed's done, which we're going to talk about, and then look at where equities are at now, you would have expected that the move higher in the stock market would have produced more of dollar weakness, which, like I said, we're seeing dollar weakness at the moment, but that doesn't necessarily mean that it's going to stay longer term. And so what I was going to do is I'm going to talk about a bunch of different things. First of all, we're going to talk about the bearish argument for the dollar, because there are great points against the dollar. We're going to talk about the bullish arguments for the dollar, which there's a lot of bullish arguments as well. And this is one of the, I think, the issues that FX traders that we have, is we can argue both points of the dollar at this stage in the game, and that's what makes it extremely difficult. Usually, when you're trading currencies or trading anything for that matter, it's much easier when you can pinpoint, these are the reasons why I want to be a dollar bear, or these are the reasons I want to be a dollar bull, and really run with it. But right now, like I said, it's there's pretty valid arguments for both. But I personally have come to more of a conclusion on how I feel about the dollar, and maybe after this, you might feel the same way, you might not, and that's what really makes a market, right? So is it really just a dollar story? And I think we all can agree that it's not just a dollar story. And we're also going to talk about what the corresponding markets are telling us, and we're going to look at what the charts are telling us. And I'm running fairly short on time, but therefore some of my charts I already started doing a little bit of work to get through it, because what I love to do is start off with a clean slate and go through the different markets and show you what I'm looking at. But I already started while Tyler was speaking. I'm like, oh, I'm running low on time. I need to go ahead and make some adjustments as we go. All right. So, and then I'm going to give you my thoughts on the dollar, my final thoughts on the dollar. So let's talk about the dollar bearish arguments. Like I mentioned just a moment ago, unprecedented move from the Federal Reserve, and this move from the Federal Reserve is going to eventually just destroy the dollar. These are the bearish arguments, right? And we really got to start with what actions have the Fed taken thus far? And this is where it gets very tricky, especially for somebody like myself. I consider myself more of a technician than a macro guy. I do trade with a firm with some of the, I think, are some of the most intelligent guys in the markets in general. I watch these guys fly through news. They look at, let me see if I can show you this. Like, this is Bloomberg, right? And this is like like hot stories that are coming through the market as they come flashing through the market. You can read up on everything, and then I have different news streams that come through Bloomberg, and the guys that I work with, they can run through that news and they can read them almost as quick, as some of the algorithms, and they could decipher it and make a decision. And that's awesome, because myself, I look at some of this news and it takes me a little bit of time to process everything. And I'm sure, you know, some of you probably feel the same way. And so what I was doing is I was going through what the Fed actions have been. And what I realized is I actually had to go through the Brookings Institute and start looking at some of these acronyms, because as Steve mentioned earlier this morning, and this was kind of funny that Steve said this, is that he thinks that some of these central banks have created all these CVPs, these or SVPs, special SPVs. Sorry, yeah, special purpose vehicles with all these different acronyms to confuse the heck out of us. Which I'll tell you, Steve, when I was going to list all of them and just say, okay, here's some of the actions that the Fed has taken. And then what happened is I started looking at all the acronyms and I see them all, and I see all of these different special purpose vehicles being built, reestablished, and I'm like, wow. So I had to just basically take all that information, put it on the presentation here, walk you guys through it, because I think it's going to be quite, I don't want to say alarming, but it's going to be quite amazing when you go through all these things and you go, wow, the Fed's really done quite a bit, and that's important. So we're going to go through them. This part's going to be a little bit boring if you know some of them, but I think some of them might be a little shocking to you as well. So first and foremost, we talk about rate cuts. Obviously, the Fed has brought rates. You think about what the Fed's done in the last several years by raising rates. They did it specifically for this environment. We're in a situation where the Fed had to bring rates back down to basically zero, and they did 2 emergency rate cuts, and that's the first time they've done that since the financial crisis, the GFC that we love to call it, and that's pretty amazing. But you realize now in hindsight why the Fed was raising rates, and you look at other central banks, they don't have that tool available to them, if you will. All right. Now also, the Fed has employed what we call forward guidance. Forward guidance, in my opinion, is probably one of the most valuable tools that the Fed has, because what they've been really good about doing, and I know there's debate on this. You don't have to agree, or you can agree or disagree with what I have to say. But the Fed is much different today than it was like the Greenspan Fed. The Greenspan Fed, we'd get surprised with rate hikes and rate cuts. Like you never knew what you were going to walk into, and it surprised the markets quite a bit. Right now, I mean, obviously the COVID-19 situation is an outlier, but generally speaking, we have a pretty good idea of what the Fed's going to do. So it doesn't surprise the markets as we move along. And I think that's important, because the Fed can really shape the way that we think. If you look at the Fed today, and the Fed, I mean, Powell basically said, we're going to keep rates low for, it seems like, what would be forever. But you have banks like Goldman Sachs a couple of weeks ago that said, hey, the Fed's going to stay on hold probably till 2023. Until inflation rises and we're back to full employment, which could be, now they might have, moved out those forecasts based on the forward guidance that the Fed has given at today's meeting. But that's important to understand, that the forward guidance it's really like storytelling for them and giving you Easter eggs along the way, so you can kind of understand where they're going and how the story is going to eventually end. And that's what forward guidance is. And I think it's one of the most important things that important tools that the Fed has. Now, what the Fed has done, though, is they have done many things to really support the functioning of financial markets. So, obviously we have, quantitative easing. And even though the Fed says what they're doing right now is not quantitative easing, everyone else is calling it quantitative easing. We're kind of calling it what it is. But the Fed has bought trillions of long-term securities, and when they cut rates to zero, they started these large-scale purchases again because of the the pandemic, right? So QE is what we're all accustomed to hearing. We're like, oh yeah, the Fed's doing QE again. But what they've also done is they've done other things like, lending to security firms through the discount window. Now in the past, these discount windows that, the dealers or the banks, them accessing funds from the discount window or the primary dealer credit facility, the PDCF as they call it. And again, these are these acronyms that we're going to start going through that you're going to go, wow, there's a lot of them. They used to, the street would see that as a sign of weakness. If banks or dealers or primary dealers were accessing the discount windows, they'd be like, oh, that's a show of weakness. But obviously, because of the pandemic, everybody is running over to the discount window, and the Fed actually, instead of making those loans overnight, they now allow them up to 90 days, which is a substantial amount of time. All right, and also, I guess one thing I should mention is the securities that they have to put up in order to access the discount window. Those regulations have been loosened as well. Now, this is where it starts to get a little bit more confusing with all of the acronyms, and that's why I referenced the Brookings Institute. They've done a great job in outlining all this, and so I was going to try to put it in my own words, but a lot of this you can just access right from their website. But I thought I'd share a lot of it with you. So they're backstopping the money market mutual funds. When we had, when the pandemic originally hit, I mean, think about all the people that started, liquidating their mutual funds, trying to access capital. Well, that put a strain on the system. So the Fed launched the MMLF, which lends to banks against collateral they purchase from prime money market funds, the ones that invest in short-term IOUs known as commercial paper, as well as Treasury securities. So again, this is another action that the Fed's taken. They have their repo operations. We've heard a lot about the repo operations, but this is where, the Fed has vastly expanded the scope of its repurchase agreements. And this is to funnel cash to money markets. And now this is key, essentially offering an unlimited amount of money. And you heard the Fed Chairman Powell say today, even today, he's like, we're not going to run out of money. Running out of money is not the issue. This is where the Fed is basically supporting the financial markets, making sure that it's operating fluidly, all right? All of these different actions that you see here. And like I said, it's quite amazing. Now, they're also encouraging banks to lend. They're encouraging banks, sorry, my alarms are going off here, through the discount windows. And that's direct lending directly to banks, making sure that they have funds available to them. Also, they are temporarily relaxing the regulatory environment. So they're encouraging these banks to lend, and all the bigger banks, the community banks, and they really have relaxed the collateral that banks had to use to access the monies from the Fed. And again, this is just to say, to make sure that banks are out there getting money out in the system. Now, they've also supported corporations and businesses. Now this is where you start to see some of those acronyms like the PMCCF, the Primary Market Corporate Credit Facility. And, when I see these headlines come through on Bloomberg, and I see, oh, well, the Fed has reestablished this, and then I move along. I'm like a lot of you traders. I have a bit of ADD when it comes to trading. You hear something, you process it, and then you're moving on to the next thing. But when you go through it, you realize all of these programs that the Fed's incorporating. Here's the Commercial Paper Funding Facility, the CPFF. Right, so this is a $1.2 trillion market, which firms issue securities, unsecured short-term debt to certain money market funds and others to finance day-to-day operations. Again, this is how they're supporting small businesses. And then we also got this is supporting loans to small and mid-sized businesses as well. And by the way, going back to the last slide, I actually had a friend of mine, a good friend of mine, that accessed those funds as well. You know, I said, "Oh, did you access the PPP?" And he's like, "No, I accessed this other liquidity measure from the Fed." And this is the Fed just helping support businesses and corporations. And what I'm trying to illustrate to you here is the Fed has taken on a massive amount of, you could say, liabilities, but massive amount of action to really support the markets. Then they're even supporting state and municipal borrowing as well. And I'm running short on time, so I don't want to go through all of these. I want to move through them rather quickly, but I want you to, you know, stop, read up on them, and then, you know, move along. So supporting bond market liquidity, and also cushioning money markets from international pressures. And this is big because so many central banks are accessing money from the Fed, and so the Fed had to provide that liquidity. So what is this all, you know, where is this all going? Is part of the argument is the balance sheet of the Fed is getting too large. Confidence is going to be lost in the dollar because the Fed is making all these unprecedented moves. And more arguments towards the bearish argument of the dollar. The bounce back in the U.S. global economy means less need for U.S. dollars. As you guys know, as the market bounced back, people will sell their dollars. They're gonna reallocate them into different currencies and in different places. And so this is, again, part of the bearish argument. A bounce back in stocks, we just mentioned, will ultimately lead to the U.S. dollar lower. And as the economy has that reflation environment, the reflation trade, the U.S. dollar is going to head lower as well. And yields will continue lower, thinking like, you know, the 10-year dropping to 0 or even negative, some people have argued, will take the dollar with it. So these are the predominant dollar bearish arguments. And I really want to talk about the dollar bull arguments. Okay, so the bull arguments are, you know, the dollar is still the least dirty shirt in the hamper. You always hear that term. The positioning in the market is that everybody is short the U.S. dollar. Everybody positioning. So being short the U.S. dollar, it's going to lead to you know, people covering, and it's going to be, you know, make it a very bullish dollar environment. The deployed dollars elsewhere is going to have to come home. You know, as Adam Button mentioned a little bit earlier, you know, dollars are everywhere, and he even mentioned that half of those dollars are not on our shores. They're elsewhere. They're deployed elsewhere. They're going to eventually have to come home. So that's going to strengthen the U.S. dollar. And because the U.S. dollar is a reserve currency, there's going to be a shortage. So, you know, that's going to be that rush to dollars. We kind of saw the beginnings of it at the beginning of the pandemic. We saw that rush to dollars, and everybody, you know, sold the euro, sold the Aussie. The Aussie dropped to 55 cents. The cable dropped to 115. Okay, so that's, again, this is part of the dollar bullish argument. And safe haven assets will come back into demand, which the dollar being the ultimate safe haven currency, and a deflationary environment will be dollar supportive. So, and there's more arguments out there. You could throw a couple other hot topics in the dollar bull, dollar bear argument, but I just wanted to bring up the major ones that I've heard. Okay. Oh, and then also a wave 2 will usher in a stronger dollar eventually. Now, when I say a second wave, that is not referencing the virus, and I'm not a medical expert. I have no idea what's going to happen with the virus. All I can hope is that we don't have a second wave in the virus. But when I talk about a second wave, I'm really talking about a second wave in the economy. I think the economy is excited to get back to work, but the argument is, and this is where you start talking about behavioral, you know, our job's going to come screaming back. I doubt it. Are people, like, you think about people like me, I've got a family. I'm married with kids and dogs. Am I going to be traveling anytime soon on a plane? People like me, maybe, maybe not. Maybe I'll drive somewhere. I don't, is life going to go back to normal? And I think there's a lot of arguments that would suggest that we're in a new normal and the economy is going to take a long time from an L-shaped environment to recover. So therefore, a second wave of dollar buying, if you will, is probably going to come back, and we're going to see, the stocks come down and the dollar come back into demand. So that's what I'm talking about as far as a second wave. But then you have to ask, is it all about the US dollar? And the answer to that question is no, it's not all about the US dollar. The dollar, when you take the dollar index itself, is weighted heavily to the euro and less to everything else. And so that's why when you look at the dollar index, it's a little skewed. When you look at it, I don't look at the dollar index and I haven't for years, as much as some people do, but I know it's still very commonly followed. So therefore I have to follow. And that's why on Forex Analytics, we use the dollar index because it's followed quite a bit. All right. So one of the tools that I use, having Bloomberg, is I use the Bloomberg dollar index. It's a more evenly weighted dollar index. And if you use like Gain Cap, is it Gain Capital? No, FXCM. I think they have a similar type of index called the US dollar. But using something more equally indexed is more powerful for me on an intraday basis. And I consider myself a swing to very active trader. So, when I try to look at longer term views, like you can see this weekly chart on the Bloomberg dollar index, I look at it, I glance at it probably once a day, and I note where those levels are. And what I'm, showing you here is, yes, we are actually threatening on a more equally weighted basis. We are threatening a dollar breakout. Now, one of the instruments that Mark Chandler talked about yesterday, which kind of this is the problem with when you're one of the last in line to talk and to present, you don't always get to don't always get the thunder here. Somebody else is will use it, or they get to it before you. This is a trade weighted real dollar index that I look at from time to time, and it's you can't even get candlesticks on it because it's updated rarely or less frequently, but it really can give you an overall feeling of the dollar. But you notice that the dollar is not too far from breakout territory, and on a broad trade weighted index as well. So since the dollar index is made up predominantly of the euro, all right, we do have to discuss the Eurozone and the euro currency itself. And the question that I always ask, and I think a lot of you probably ask as well, is the euro a valid currency, or is it just a project, and will the euro go away? And there's a lot of debate there. I'm not here to say what's right and what's wrong, and I'm not here, I don't have time to debate with you back and forth whether you believe in it or whether you don't. But one thing that I'll have to say about, is the euro is it a project? One of the things that I've believed for many years, and if you follow me daily on the FACE webinar, I talk about having a fiscal union. And one of the things that was not displayed recently is, and the ECB is engulfs the Eurozone, but having a fiscal union of some type is what would put the stamp of approval for me that the euro should be bought in mass. It'll be more of it's here to stay. And the problem has been that you can't get every Eurozone or every Eurozone country to commit to that. And I understand the reason why. It's kind of like the United States. You've got Texas, New York, California, and then you have the rest of the United States. And those are the states that probably produce the most, income. But you know, in you know, different regions. It's like taking Germany and France and Italy and then everybody else, or, you know, something like that. And we as Americans, America was formed, you know, obviously a long time ago, but the Eurozone's trying to form in today's world, and that's where the disconnect is. It's like, okay, I'm Germany, and, you know, do I really want to, you know, be responsible for what happens in other Eurozone countries that aren't doing as well, or vice versa? And so because of that, you know, if there was some sort of fiscal union, I would feel a little bit different about the euro as a whole. But if you look at what the ECB and the European Union's actions have been over their COVID-19 response, you can see it on the screen. You can see what the ECB has done. Now, obviously, the ECB today, I think they added another 20 billion to their a month, and that they adjusted their LTRO program a little bit. So I just added that this morning because of, you know, some of the actions that the ECB has taken. But what you'll see here is it's substantially less than what the Fed has done. And same with the Euro group, and they put out a couple of weeks ago that they're going to have a package of 540 billion, and I'm sure that's going to expand a little bit, but you can see it's dwarfs in comparison to what the Fed has done, you know, has done as of yet, or as of now, excuse me. And so that's where you have to start thinking, well, am I looking at just the dollar, or do I have to really focus on other countries and what they've done? And that's why, you know, I have to say that the US dollar, you can't put it in, I'm buying the dollar, I'm dollar bullish, or I'm dollar bearish. I tend to be dollar bullish against certain pairs and bearish against certain pairs. It depends on the country that I'm dealing with. That's why we have to look at different currencies and understand what the specific relationship between the dollar and that specific currency is, versus just kind of blanketly saying I'm a dollar bear or I'm a dollar bull, because I think that's a cop-out, right? Overall, it's a cop-out. You have to really say I'm a dollar bull, but against the euro, or I'm a dollar bear against the, you know, against the Aussie, or something like that. We also have to take a look at the global equity markets, specifically the S&P, but I think that the correlations will not lie that you know, that we have to pay attention to that correlation. We have to obviously look at gold, and we have to look at the bond market. That's really important. So that's where I'm going to, first and foremost, I'm going to take, I think I can do it this way. Can you guys see my charts? Dale, can you see my charts?
We can.
Yes, sir.
Okay, all right. So I just want to make sure if I overlapped them like that, you could see everything. Now, let me give Forex Analytics a little bit of a plug here, just because Forex Analytics, we cover like so many different instruments and so many different markets. It's important that you understand that it's not just currencies. We cover, you know, the DAX and the S&P. We cover Bitcoin, and we cover the bond market. So it's important to understand that. And also, like when you're looking at the dollar index, it's not just basic technical analysis, which tends to be my forte, but, you know, we have harmonic analysis, which you've heard from Andre today, you know, and his looks. And then you have like the Elliott wave analysis, which is from Gregor Horvat, which you heard from yesterday, which talks about, you know, different Elliott wave counts and how he feels about the dollar in general. So I just want to mention that about Forex Analytics. It's not just about currencies, and it's not just about basic technical analysis, although that's what I'll be covering here, all right, at this moment. So what I did is I wanted to show you all of these major currencies, and I want to talk a little bit about where things have changed and kind of what's happened in the market. And if you're looking at the euro, like just as the euro in general, you can really argue that the euro is in a, you know, in a consolidation of some sort. Okay, it's very messy, and I've outlined the reasons why I think it's pretty messy. Is that you know, there's a big bull and a big bear argument that's going back and forth. So you can see why we're flip-flopping a lot. And then you throw in lack of liquidity, you throw in month-end flows like we saw today, it's going to muddy the picture a little bit. All right, so overall, if you look at the euro like on a weekly basis, it is moving lower. And you have to take that into account. You have to say, well, you know, as long as the euro is below 115, you know, I've got to continue to be a euro bear or a dollar bull, at least against this particular pair. That doesn't mean that the euro can't strengthen. And, you know, one of the things there's a lot of things that I wanted to mention today, and a lot of things that I don't think I'm going to get to because of time. But one of the things that I like to explain to people is I may have an overall bias of like the euro. Like, for example, I'm a euro dollar bear. Does that mean that I'm bearish the euro all the time? No. But if I'm a euro dollar bear, whenever I have a bearish setup, I'll be more aggressive to the downside. But if I've got a bullish setup, I'll be obviously less aggressive. And this is where I think Adam mentioned it this morning, where size matters. Size does matter when you trade, and it's not only the motion of the ocean either. That was a joke. I got some of you guys to laugh, right? No one's laughing, maybe?
I am.
Okay, you laughed. Okay, that's good. I figured somebody was going to laugh at that one. Not just the motion of the ocean, it's the size. All right. Anyway, like today was a perfect example of, you know, I was telling everybody in the chat room, look, we have an inverted head and shoulder pattern with the euro. It should target 110 if we break out. I think you might have heard it this morning. You know, we came, you know, pretty close to 110. Now, is it over and should you fade it here? I mean, that's up to you. But I'm just saying that, like today,
was a great call, Blake.
I was obviously focused on the presentation and on our event, so I wasn't really if I wasn't spending a lot of time in front of the markets today.
That's okay. Everyone else caught it.
Yeah, I'm sure everybody did. I mean, before I was coming on, before the fix, I was like, hey guys, you know, the euro's pretty big. I'm like, wow, you know, and we had gone from 40 to we were trading at 80, and obviously the breakout, you know, ushered in a lot of buying there too, along with the fix. But the point I'm trying to make is, even if I traded the euro on the long side today, it would have been in a smaller position size because I'm more of a euro bear than a euro bull at this point, right? And it's really comes down to like the longer term chart showing you that, you know, hey, you know, I think the euro is at risk of continuing lower, you know, towards parity and beyond. And
wow,
the one thing that would have really changed my mind about the euro dollar in general would have been at the Euro group meeting, if there was some sort of euro bond issuance, I would have said, wow, fiscal union, Eurozone fiscal union, my attitude may have changed quite a bit, but it hasn't. All right, cable, you know, you know, I think Mark Chandler said yesterday, you know, the cable shouldn't have been at 115. That was, you know, clearly a, you know, place to be long. Arguably so, because it was a false breakdown. But overall, you know, the trend is still lower. Until I see some of these longer term trends change, I have to, you know, I have to continue to believe that the cable, you know, even as long as it's below 130, it's probably a short. Now, that doesn't mean it's, you know, a short right at the moment. Today I was saying, hey, we break above 125, we're probably going to go to 126. I think we're trading above 126 right now. We are. And if you read the Forex Analytics analysis last night, that's what it said too, is, you know, looking for possible move to 126. Now, this is the dollar yen. And this one is the chart that kind of changed my opinion on the yen, and rightfully so, because we've seen the way it's reacted as of late, especially through this whole pandemic. And, you know, I have to kind of go backwards and take us back to the point where we broke above 110. And when the dollar yen broke above 110, I was like, wow, the correlation actually broke where, you know, or is playing catch up rather. And it was a breakout, it was massive. there's a lot of institutional buying, mostly from Japan, and a lot of pensions buying, post office, the government agencies were buying. So I knew what a lot of long-term buyers were in the, selling yen, basically buying dollars. But also at that point is when we, started to think, okay, the correlation, and we talked about this on the FACE webinar at that time, that the correlation between risk on, risk off, and how you treat the yen we might start to see a longer term change. And we have seen that a little bit, although during the pandemic, you saw the yen really strengthen, but it came back quite aggressively. And if you look even now, I mean, the dollar yen is holding up pretty well considering where stocks are. Now, that's not to say that when stocks come down, the dollar yen won't come down with it. I just think that the way the yen has been used as a safe haven type of currency, I think won't be quite like that moving forward. It's still, it's not like and I tell our listeners all the time, it's not like a switch gets flipped and it's like an on and off switch with a light that all of a sudden the yen's not a safe haven currency anymore. It takes time in order to make that change. And I think that's what's happening right now in the currency market. And I think you're going to see that continue as we move forward. Even if the S&P does drop back to 2,500, how's that going to impact, the dollar or the dollar yen? Now, if you take a look at the dollar Swiss, by the way, this is another currency that is extremely messy, and you're not seeing the Swiss franc act as well from a currency risk on standpoint. But and I could go through all of these pairs, but I know I'm running over time right now. But I really wanted to take you over to like the S&P, and I want to take you over to specifically like the dollar. And let me compare the dollar. And this is much easier than me doing it via Bloomberg, because what I can do is go through Bloomberg and run through these charts. But these charts, I'm not as fluent in using these charts. I don't think it's as user friendly. So therefore, I love using TradingView. So you can see I use them both. But you'll notice that the dollar, under extreme stress of the stock market, the dollar does act as a safe haven currency, and that's one argument that I've brought to the table for our Forex Analytics subscribers, or not just that, for our FACE listeners on a daily basis, is that the dollar may act as a safe haven only when the market feels extreme risk off. When I use the term, when the poo hits the fan, people drop everything and say, I'm going to buy dollars. That's it. I just want to own dollars. It's a reserve currency. Get me back into dollars. And that's exactly what we saw as the pandemic hit. The dollar started to strengthen. Prior to that, even when we had little blips lower, you can see this one right here. We had a little blip lower in the equity markets way back in the end of 2018. The dollar didn't do anything. It didn't strengthen. People weren't panic stricken. What has happened today or in recent months is a crisis. This pandemic is for real and people are concerned. So if stocks start to move lower from here, I would expect that the dollar reigns supreme. All right, and that I do not doubt. The question is, which currency do you sell? And that's when you start to break them all down into, I'm more excited to sell Aussies versus the Kiwis because of the exposure that Australia has to China, and the New Zealand dollar, or New Zealand has less COVID cases, whatever your argument is. Or I'm going to sell euros because I think that the European Union is toast, so therefore I'm going to buy dollars against the euro. So it's not a one size fits all, and that's the point I'm trying to make here regarding the dollar. Now, obviously, we look at gold and we look at yields as well. Again, I'm running very low on time, so I need to go through this really quickly. The one point I always try to make with people is if you do see the dollar and you do see gold moving up at the same time, that's usually a sign of, the market's pretty stressed. When the market's buying both gold and dollars at the same time, that's usually a pretty good inclination of risk on or risk off. So what I wanted to do is really quick is go through, my thoughts on the dollar. And, when you talk about like the balance sheet of the Fed, look at the Bank of Japan and look at the difference between the Bank of Japan, the ECB, the Bank of England, the Fed, and where the Federal Reserve is at. I think that the balance sheet exploding, I do think it's a little overblown, and I think we have more to go. So when you hear the Fed Chairman Powell say we're not going to run out of money, and I've got plenty of ammunition here, he's not lying.
What a great chart, Blake.
Yeah, and this comes from the Financial Times, but it really, the Fed can do more in relationship as percent of GDP. We can. So I think that those fears are a little overblown. Europe is a mess. And I think Europe is gonna continue to stay a mess until we see some sort of fiscal union. And therefore the US dollar is the place to be near term. I meant to put animation in here, so you didn't see them all at once, but yeah. All right, so I missed it. The world is near ZERP. Years ago, you could go back 3-4 years ago when we were on FACE, and I said, mark my words, guys, everybody's going to be at ZERP soon. We're getting there. We're almost there. There are obviously some emerging markets where their central banks are making their way lower still, but for the most part, all the G7, G10, everybody's going to ZERP. The reason why that's important is because I don't think currency volatility is here to stay. That was my next point. Volatility is here to stay, and you can see it in the here's euro. By the way, this is euro 1 month implied volatility. You can see that big spike up, obviously, because COVID. I think volatility is going to be here to stay. We want to see volatility above 5 in the euro. You can look at the dollar yen too. It looks very similar. I think volatility is here to stay, but I don't think currencies are going very far because everybody's at ZERP. So if you're in the camp of, oh, so the euro is going to 120 or the euro is going to 88 cents, I'm not in that camp, because I think while everybody's at zero, the longer term trends are going to be fairly muted. But that doesn't mean that we're not going to get action in the markets. That just means that you should be very weary of overblown moves in the market. Okay, as far as the dollar goes. Now that doesn't mean that you won't see outsized moves in crosses like what we saw in the euro Australian dollar or the euro New Zealand a couple of weeks back. Those outsized moves may happen. Euro Mexican peso, same type of thing. But in terms of the dollar, when everybody's at ZERP, until you start to see moves off of the floor, it's probably going to wait. Hold on. Okay, sorry. I was Germany's Merkel was talking about something, and I thought she might have been. Whenever she talks, I'm like fiscal union. That's the first thing I look at, and it wasn't. It was just a headline. She was talking about travel restrictions, so it's nothing big. And the last point I want to bring up, and I know I'm way over time, but the last point I wanted to bring up is election risks. Now, I don't want to. I don't like bringing politics into the market. I have my views, you have your views. They're irrelevant as far as the market goes. Our views are, but what happens is relevant. And, I think, and I know Steve has a lot to say about this, and I'm going to echo kind of what you would say, Steve, is that, if Donald Trump comes in, I think the dollar could still, kind of act what it the same way it is. But if a Democrat gets elected, you're probably going to see the dollar weaken some. And just because I think Democrats tend to be a little bit more loosey-goosey from a monetary standpoint and fiscal standpoint. So you might see the dollar come under a little bit of pressure, but that's something that you have to keep in the back of your mind as we head into the fall, not necessarily things we're thinking about right at this moment. But like I said, I was running a little late on time, and I wanted to say thank you guys for bearing with me. I know it's not the most exciting presentation, and there's a lot of currencies that I didn't even get to that I really wanted to get to, but...
Would you like to tell the people where they could find you, Blake?
Right here.
If they want to follow you.
Hey, just so you guys
Pipzar.
know, I'm Pipzar on Twitter, but that name was given to me by a client or a customer of Wise Trader MB Trading back when I was chief currency strategist there in like 2005 or 2006. Just as I joined Twitter, just before I joined Twitter, so we were giving each other, it's when they did the Karzar, and we were giving each other pip handles, all of the clients, and people were like, I'm the Pip Indian, I'm the, Pip Slayer, Pip, everybody's like, and somebody said, you're the Pip Czar instead of a Karzar, you're the Pip Czar. And it kind of stuck, and everybody just started calling me that. And that's how the name came. So don't think it's like, oh, I crowned myself the Pip Czar. No, it was actually given to me by a client, and I just kind of ran with it because everybody just said, hey, Pip Czar, so it's kind of, they called Steve Dingleberry. Just kidding, Steve. I love you, man. I'm just kidding. But Pips are on Twitter. But you guys know I'm one of the co-founders of Forex Analytics, and you can find us on the Face webinar every day, every morning for free. And then obviously we have paid webinars, or I say paid webinars. They're webinars that are included with your subscription. If you're a member, you get like the daily roundup, the European crossover with Polly, and I do the daily roundup, and you'll find me every morning here.
Blake, I just added on chat the Traders Summit offer link also for people to take advantage of.
Thank you very much. And I want to say, thanks everybody for being part of this event. And if you had any questions that came through, because I'm not going to be able to address those questions right now, catch me in the mornings. I'll be there tomorrow morning. Tomorrow, Friday?
Yeah.
TGIF, bro.
Woo-woo,
yeah.
It's Friday tomorrow. All right. So I'll be on tomorrow morning.
I also put the link. I told people that they can find us every single day on the Face webinar. It's free. They can sign up and they can ask as many questions as they want there.
Great. Okay. Well, hey guys, thank you so much for being here. Thank you so much for your support. And all of our sponsors, our wonderful sponsors, thank you to them, because without them, this wouldn't happen. And without you as well. So stay healthy, stay safe. I'm out.
See you, Blake.
Bye-bye,
Stay
Blake.
hunting the rest of the day.
Thanks, guys.
So stand by for Steve.
Hey, Steve, I've unmuted you.
Okay. Hey, guys. How you doing?
Welcome. Sorry,
Steve,
you know how it is.
I'm fantastic.
We ran a little bit late.
Yeah, I see that.
Steve, thank you so much for your patience, buddy.
Yeah, no problem.
I appreciate it. And what an interesting topic, for especially, I think you're going to cure people that have FOMO, because Steve's presentation is, can you watch paint dry?
That's right.
Trading commandments you need to know. So Steve, really looking forward to your presentation here. As you know, you can share the screen.
You can share your screen, and you can use your camera as well.
Okay.
Hey, Steve, I didn't get a chance to meet you. I just want to say thank you for being part of this. I've never met you in person. I've actually never met you. I just want to say thank you.
Yeah, thank you, Blake.
All right.
Okay, this is the dollar. This is one of the setups I have. I'm bullish the dollar. You see this upper band here. This is proprietary, but these bands are very lethal. And when the setup's there, a high probable setup, which is long right now, it usually matches the upper band. And I have a T target here, which matches the upper band. And when they're flush, it's a very high probability that the target will go there, especially if it gets over this L pivot. This was an entry you could have taken, but this was just mapping it this morning, and this is an entry. It hit my lower band. We're getting a bounce now. We probably hit 98.76 to the tick because it usually does hit them to the exact number, which is impressive when you do a counter trend trade or you bid, you put a stink bid lower, and when it hits it to that exact number, it feels good when it bounces from those areas. Actually shows you know what you're doing. But just with any other bounce, managing your trade, of course, is important. And something like this, where you were to take a position and it moves against you, a lot of traders I find don't move to entry. They tend to not manage their trade well. And managing your trade well, just because you get an entry and it's moving up as a counter trend, as you can see right now, you have to definitely be able to get those swings, because the dollar it's volatile. And so as long as this holds, this is what I'm looking for. I know, if we go back in time here, we'll see. Oh, I have to refresh.
How many years, Steve, would you say it took you to get from point A to point B with all your proprietary indicators and things that you use to live up to your handle Pivot King? And I've seen you make a lot of great calls.
5 years? Living and breathing
Okay.
it, though. Just like anything in life, right? When you live and breathe it and you love what you do, you'll be good at it. But you don't give up. I took my shots back in the day. I admit it. I blew my account twice. This was 12 years ago. And it's those sort of things, listening to the wrong people, which I did. I just find that there's a lot of garbage out there, and you have to listen to the right people, the right mentor, and someone who's been through the trenches, because it's that misinformation that could lead you in the wrong direction, and then you get hurt. So, and you know as well as I know, just throw up Twitter and look at everybody behind the keyboard. They use fake names. They don't, there's a reason why they probably want to use their name. It's probably because they have something to hide. But other than that, if you put a lot of work into your homework and you journal and you find someone that is sincere, and a mentor such as yourself, Dale, because I respect you as well.
Well, thank you, buddy.
And you just stick with it and just don't trade right away. If you're getting into these markets, don't just get yourself in, this guy made 50 points, this guy makes 60 points. Who knows if they're actually even making that? But besides that, don't let other people's trades discourage you and say, hey, look, this guy's doing it, so I can do it. So I think a lot of traders these days expect to get into these markets, especially now because times are tough. They have a little bit of money and they're like, hey, I'm going to get into this market. I'm going to follow this guy. This guy's going to make me all this money. And then they find out that, you really can't follow someone. You have to actually know how to trade yourself, because, someone can give you levels like I do, such as you as well, Dave, Steve, and anybody that has a forum. It can give you levels, but you're going to have to know what to do with those levels, especially with this volatility. If anybody was following anybody with this volatility all across the board within the indices, you would have probably blown up your account. When you get 100 point moves in 10 minutes, that's dangerous.
So this one right to your pivot, and there's a low of the day, and you talk about that's just part of the process. First of all, you have to be patient to wait for the entry, right? You want to talk about,
yes.
And I think that has a lot to do with your title, that you have to be willing to sit in front of the screen and do nothing at times for quite a while.
It's good you brought that up, because when I first started out, and like I said, this is the sort of the part where there's a lot of misinformation. You see people making trades every half hour. So, that's very stressful to do that. You can do that, but you're going to be living a very stressful life. What I found that worked for myself and where I started to become profitable is when I said, look, if I wait for this, there's a break. You could even short there, but if the trend is up, you don't want to short. You want to buy the dip. If the trend is down, you want to short it. But if you wait for price to come to you, and usually when you map, and if you're a good chartist and you map a lower price, for example, oil, I called the oil. I know many people here know I called the oil at $5.93 when the $21 level broke. I had lower pivots. It broke. I got out right away, which is crazy. But I bid $5.93, which was $12 lower in oil, and it hit it, and it rocketed. 693, sorry. And it rocketed. It was all documented too. You could, and a lot of people even took it in the forum. I got over at 12 and then I let it ride. But what I'm saying is, if you map something and you wait for it to come to you, and when it does, because I like counter trend trades, and managing your position, I find that the profitable traders are the traders that have the patience to wait. If you constantly want to force yourself to make a trade, and when the setup's not there, a high probable setup, you know, you're not going to do very well. I find, that's just my opinion. I find by waiting and waiting for a clean setup, a very high probable setup, in the end, you can even do one trade a week. It's up to you, right? You have all year, you have quarters, you can look at your account, see how you're doing. But I found my account steadily growing when I was very patient. I would stay in front of my computer. Even today, I didn't even make a trade. I'll stay here in front 8 hours a day. And if I don't make a trade, some people are forced that they stay in front of their computer for 8 hours, that they stayed there and they didn't make any money and they feel down. Well, I look at it as, you know, the setup wasn't there. I saved money, because you can get yourself into trouble. But that one setup that you can get a week can make your paycheck for the week. And that's what people don't understand, is that this game, patience to me is number one. Of course, you have to be able to chart well, but along with charting is patience. And if you're overly aggressively trading, anybody I know that overly aggressively trades, they don't do too well. Yeah.
Maybe the issue, Steve, if you thought about it, is that people need to make money, and the market doesn't care about your needs to make money.
Oh, for sure.
And you know, if, for example, you know, if you're undercapitalized and you don't have other revenue flows coming in that you feel the pressure to trade, and do you discourage people or tell them to keep their day jobs for a period of time so that they don't put that kind of pressure on themselves that everything has to come from speculation, because the market doesn't care how much money you need a month to live on. The market's going to offer what it offers.
Absolutely. And, you know, everybody thinks they're smarter than the market. Well, you know, they could be, look what just happened, right? With the move. And this was just, I've never seen it before. The breakers going off 10% down, up 10% up. Like, seriously, if you really need to know what you're doing, and anybody that came into trading without, you know, experiencing such high volatility, because we haven't had it in a long time, they just got a wake-up call. So that's one of the things. Like, look, when the market's moving like that, what's wrong with stepping aside and letting the dust settle, which is right now. It's calmed down. You know, if you're not good with volatility, some traders do very well with a lot of volatility. It's stressful because you're getting moves, and big moves all around, all the indices, the currencies, everywhere, gold. So everything was moving, especially oil. But I'll go through gold right now, Dale, and okay. I've been bullish gold since the 1450 area, which we nailed actually in the forum. But you know, as we know, we take profit off, you get your pullbacks. I'm still bullish oil. I like my BAMs are up here. We're getting a correction, which I like actually. But this is one of the areas I would actually put a bid, 1696. My L pivot's strong, and I'm looking for 1815. Why? Well, it matches the upper band as well. You know, this is the level here. As long as this holds, this is live. If this breaks, we're probably going to get below the 200. But, you know, I look at charts. I know a lot of people make comparisons, you know, just like oil and ES, the S&P. And I tell people these comparisons, even with the dollar and gold, and as you know, they've been moving together. And people, these comparisons that I find, it's good. It's a piece of information. It's just like the COT report. You know, you get the professionals every week, and, you know, it's a week late, but you get their data. When you compare the dollar to gold or oil to ES, and some people just trade within when it's together. Oh, we're getting a dump in gold right now. Yeah, it's coming here now. Anyway,
I wanted to ask you about when your bands pinch together, because I remember talking to John Bollinger, and he had a theory for his bully bands that when they compress like that.
That's silver. See it?
Okay.
You see
the
it?
first move out is
It's
the
big.
first move out of the band is a fake out. And then
Yes.
back inside the band, you go with it. Do you use that
No.
for your stuff?
No.
Okay.
It's something like this. Do you see how it closed below my band?
Yeah.
Get the hell out.
Okay.
Because that's what
Would
happens.
you short it? Or because
It
you're long-term
depends.
bullish, you wouldn't?
Exactly. It depends. If I did do a short, it'd be intraday, but not something that I'd be out of it quick. I like to go with the trend, but I like counter trends too for because when I do a counter trend, especially when it hits my levels, it reacts to those levels so good. For example, today, someone on the forum had a bid at 29 on ES, 29.02. It hit it dead on and went up 15 points. They took down half. Those add up. When you get levels that are very good levels in the reaction, that was a short covering. They're just nice green candles, kind of like here, right? You just get straight moves. But this short, yeah, that would have been a beauty. No, I did not short.
You take partial profits and trade with multiples, Steve?
Right away. I take 50% down off the bat. I know a lot of people take 25, hey, to each. I take 50 off the bat. I move to entry. Sometimes, depending on my charts and indicators, sometimes I'll take my entry off because it's just one of those double pumps where they come and they stop you and go, and I'll leave it and I'll manage it. And sometimes it works, sometimes it doesn't. It breaks, and then I get out. I take a little hit, but I don't like my losses to accumulate, and that's why my levels keep me in check. I use strictly levels, and I find that works for me. I keep it simple, and I find that simple works. Trading.
What are you using at the bottom of your chart, partner?
That's stochastics, but manipulated into my fit. No, it's. What are you talking about? This?
I'm kidding you. So
No.
the crosses are meaningful to you?
Oh yeah, I use them for sure. Yeah, I use everything on here. I use. There's a story behind everything, but it's tweaked into the way it's tweaked into my levels, especially the bands. But the bands keep everybody in the right direction, which are lethal. And everybody, yeah. If it wasn't for those, I probably won't trade. But anyway, they're good. They're good. They give me a direction. It's basically the framework, and everything inside that is yeah. So just like any.
I'm going to pepper this with some questions that we're getting from attendees. That be okay with you, Steve?
Sure. That's what I wanted to do. Actually, I want to take questions.
All right. So, what do you recommend to new traders that want to start trading, looking to start trading, and would love to hear your thoughts on where I should start? And that's from Mike Arthur. Where should someone start? With a demo account?
That's a very good question. First thing, do not trade. You could sign up. Look, what I would do if I had to turn back time, trading's like a tuition. And I've told you this before, Dale. A lot of people that start trading, it's like you're going to be a doctor operating on a patient. You're going to operate on the patient within 2 weeks, a month? No, you go to school, you figure it out, you test, you have dummies, you're operating on dummies, those mannequins there that they're, brain surgeon or whatever. They're operating on, a demo. Would you want me to share my camera? Probably be better, eh? I don't even know how to.
Let's make it like CNBC. They're all from home now.
Yeah.
They're all broadcasting from home now. So.
Okay, Dale, I'm trying to share it here and show grid.
You just turn on the camera.
Start video. It's the button.
Video.
Yeah, it's the button that says start video. Steve, there you go.
All right. Okay. Hello.
Hey, buddy.
See the haircut? See? Just did a good job.
Oh, good one. Yeah.
I'm going bald over here, though, but what are you going to do? I got a couple of gray hairs, too. I'm 43. I don't know.
Oh, you're
whatever.
a pup.
Anyway. Yeah, so, look, you're starting to trade. Be careful. Number one, what I would do if I had to turn back time, I would listen to the right person. I would ask the right, there's so much information out there. I would join a forum. I would join someone that you respect, but I would not trade. I would ask questions, and I would probably practice and work my ass off and chart, ask questions, practice, journal a lot, look at your account. Remember, this is not gambling, it's trading. There's a big difference between gambling and trading. And then when you see your account successfully grow in time, which will take years, not months, because you don't have to know how price moves, I would start trading, especially the screen time that you have to put in watching price. I like to trade securities that I'm used to. So I like gold. I like the S&P. I trade strictly futures, but I like to trade securities that I like to trade because I know the times they like to push price around. So you have to get familiar with what you like, and you have to be familiar with watching paint dry, which is one of the things, one of the sayings we used for this, Dale, which was, can you watch paint dry? And if you can watch paint dry, you're good for a trader. If you can't watch paint dry, well, then you're going to be a gambler, and you're not going to last long in this business. And that's why 90% don't make it in this business and 10% do, because the 10% are getting the right information, and the 10% took their time, were patient. Just like, you're in university studying for something, you want to learn everything in a boot camp in 2 weeks. You're not, especially in this business, because there's sharks out here, and those sharks want fish like you. So all those retail that come in, consider yourself fish in a big ocean, because there's sharks out there. They're going to tear you apart.
Steve, you're getting some acknowledgement for some of the great calls you made lately, like that one you talked about on gold. And you have Jason saying that you called that low in the S&P at 2177, called for a massive squeeze, and you're dead on. Where do you see the S&P going by year end? I'm guessing that's not your style, trying to be a forecaster out 8 months to try and figure out where, that's for fortune tellers.
Yeah, but you know what? It's funny that you say that. Yesterday I got a signal. Here, I'll show you.
Okay.
Which is something that I couldn't believe that they did, but they did it. Here, I'll show you quick here if I can get it. I see it going higher, Dale. I'll tell you why. Number one, that 2177, that area that we had, which was a very deep stink bid, I got a lot of attacked on that call. And I said, you can even go on Twitter, you'll see it. I said the $4 trillion that the Fed has just pumped into the market, well, they just put in $4 trillion. They don't put that money in unless they want the market higher. And that's what I was trying to portray to people. Guys, they don't want this to fall anymore. That's why they put it in. Consider this target, high probability it's a bottom. Well, it's mapping up with a T, and it was matching my lower band, but I'm trying to get the...
Yeah, your chart's up. You got to hit the share screen green box again. Yeah, green box that says share screen.
Oh,
drop down menu.
Here, I might as well. Oh, I have to share the screen again, eh?
Yeah.
You know what? Don't worry about it. Everybody knows. It's on Twitter. You'll see the video that I did last. Anyway, I gave that call 2177, and you can look, and I got a lot of replies saying, no, this market's going to get killed. And you have to use common sense, because this whole time the market was going down, the bad news was coming out. And how the market works is the bad news gets factored in. So the worst has already happened. With that $4 trillion, see, a lot of people always tend to look at the news, and when the news comes out, you basically got a bottom, because the market factors in already that news. That news coming out, you got all these hedge funds, institutions, they know that before everybody else anyway. They're already making their positions. But that $4 trillion, I said, you know what, you're going to get a squeeze in this market to the likes, these are my exact words, that you've never seen before at the low.
Till their eyeballs are popping out.
And we got a squeeze to the likes that you've never seen before, because it was common sense still. When the Fed is putting all that money into the market, they're telling you, here's this money. And you know what? If you're a trader, you get that money. You should be happy because it's coming to us. All that money is coming to us. And if you're trading, they're saying, here's $4 trillion, go long. And That's what happened.
You know that cartoon? It's like the buy the dip cartoon that was going around for years, Steve.
Yeah.
BTFD cartoon.
Yeah, the BTFD.
Where someone's going, well, we have coronavirus and everything shut down, and the guy would just say, buy the dip, right? That cartoon.
That's it. That there is telling the market, every hedge fund, guys, we got your back. Here's the money. Take it and start buying things. You know, buy a new car, buy a new house, buy a new whatever you want, buy a yacht, whatever. Here's money. I know it's bad, but that's how this market, that's how it's working. That's how the economy works now, Dale. You know what, it has to fix itself, but, you know, I don't like that. But, well, if you're a trader, that's why they want more and more and more. It's free money.
When you get your questions, fire them out to me for Steve. And Steve, your Twitter handle is @ThePivotKing.
That's right.
Okay, so there you go, Venka Tramana. You could follow him on Twitter. People are saying they want to see your screen. Some questions for Steve to everyone. Don't trade unless you know what you're doing. People still talking about your... Okay, how about this? I want to first start off by saying thank you, Mr. Mark Antonio, for playing a part of my success and certainly assisted my future day and swing trading. Can't thank you enough. Having said this, gold, you're one of the best traders, if not the best I follow. Do you see gold getting to $4,000 to $5,000 longer term? Do you?
Well, there's that $4,000 or $5,000 again. I think a lot of people have been calling $5,000 for 10 years.
5,000 years.
Look, okay, maybe some people are going to take this the wrong way. You don't want gold to go to 5 or 10,000. I'll tell you why. What's happening?
Well, you're not a survivalist, Steve? Exactly. You don't want to live in a Mad Max world?
You just answered. You just said it. That's not good. That's not good. So a lot of people want that 5,000, but that money that you made on that you're probably not going to be able to enjoy that. I think with gold going to those levels, there's going to be some chaos, a lot more than what's going on right now, and that includes the dollar. Dale, I know a lot of people. The dollar, it's going to go. Look, the people in the United States, listen to what I'm saying. You want the U.S. dollar to be the reserve currency.
Yes.
You get a lot of special deals with that currency running the world. Now, these China and everybody wants to drop the dollar. It's going to be very tough. There's dollars. I don't think they can. They're trapped. There's no way they can. I know a lot of people are saying it could happen, and if that happens, maybe that we're going to get that Mad Max scenario, Dale. And I don't think it will happen. I think they'll go to war, because when there's one thing that the U.S. government will protect, you can bet they will protect that U.S. reserve currency.
Yeah,
there's no way. It's an act of war. Anybody trying to
and we proved
that currency.
Yeah, Saddam wanted euros. You know what? You're a tough guy, Steve. And out of hardly anyone I know, you could, and I've been asked this question a lot, okay? I'm sure you have, and I know you could handle it. And this is the toughest question of our 2-day event that you're going to field right here. From Alex GH. I have a question for Steve. It might sound bad, and if it does, I'm sorry, so he's already apologizing. Steve is apparently a very good trader. Didn't know him before this. Why, if you're such a great trader, are you selling courses and signals?
Okay, I've talked about this 10 times. First of all, I don't sell signals. I just made a video yesterday that you should never follow anybody. That's my opinion. You're not going to last long in this industry. Second thing, when you stay at your computer for 10 hours a day, which I've been part of forums that a lot of them actually booted me out because I guess I was butting heads with their analysts. I don't know. I know some of the people are probably listening know what I'm talking about. But when you're, first of all, I just filled an order, 1697 gold. Did you hear that?
Yeah.
Oh, that was pretty good.
And your ES intraday bid got
Did it bounce? Guys, is it bouncing at least? Because I'm having this thing. Did it bounce from 1697? Anybody see it? I don't know. We're at, okay, let's.
You know, Peter C. just gave you, Peter C. gave you the answer. You're a businessman with everyone wanting to be a good trader. Why would
No, I'm not done yet answering that question. I got to answer that question.
Go ahead.
Number one thing, when you're at a computer 10 hours a day, the first thing, I have web design experience back in the day. This is about 25 years ago. When you have your own forum, number one, it forces you to chart. Number two, anybody in my forum that trades knows I don't hold their hand. I pound the table. You hold your own hand. And there's a lot of people that thank me for that. Now, if you go to any other website, they'll gladly hold your hand. But I'll tell you something. You won't last more than 3 months in this business. So, Alex, my question to you is, wouldn't you want to be part of a forum with like-minded traders helping each other? Wouldn't you want to be part of a forum where you're sitting at your desk for 10 hours a day and sometimes you don't even make a trade? What are you going to do? There's only so much you could read. Why not build a forum and teach people a strategy that I use that works, that's been proven over and over, and not get conned like I got conned 10 years ago, listening to riffraffs out there that will blow up your account. So as I just said earlier, you listen to the right people, you do very well. But don't get conned into the amount of misinformation out there and bullshit that you see everywhere, especially all over Twitter, because you'll fall into the trap that following someone's signals will blow your account. And I'm sure, Alex, it's probably happened to you. So if you want to trade with the best, come to thebesttraders.com, where you can help other people trade, not just yourself, and share your knowledge with other people. There's no forum, and I know, Dale, you're part of a forum. Your forum's excellent too. I've heard good stuff about you guys, and but there's not very many sites out there where, you know, where I'm telling you to hold your own hand. So this course is to help people not get into what I got into a long time ago. Now you could say, hey, do you honestly think that course makes me enough money than what I trade? You're in la la land. Trading comes not even close to the amount of subscriptions you'll make per month. So anybody that has a site, everybody always says, you're in it for the subscriptions. Let me tell you something. People don't even last 3 months in this game. 3 months. Yeah. They don't last. So you can throw your subscriptions out the window, because anybody who has a site, if you see, they close down in 3 months. They close down. True. So when you say it's all these guys, that's the only thing they got. They'll go to you and say, hey, why do you have a website? What do you do at your computer 10 hours a day? What am I going to do? Throw my fingers? You think I trade every 30 minutes? You think I trade every hour? What are you going to do?
I tell
so
you,
a lot of these guys, like, they think you make a killing on subscriptions. I haven't charged a member for 2 years per month. Wow. My member, 2 years, they've been getting it for free. Blocks on charts, market internals, not $1. Find me one site that hasn't charged per month for 2 years. Do you know why? I trade for a living, my friend.
Okay. I tell you, you said it all. I tell you what, Steve, I'm glad that you're my friend instead of my adversary.
I'm glad you're my friend too. We've always got along. We always have good
I'd rather have you as an ally any day. So Steve, thanks so much. And, a lot of your people came to join our 2-day summit event. I hope they, were edified by the other people that were here. And I want to thank you for taking time out of your day, for coming to face on a few occasions, and for the nice things you say about us. So we're, laying it out on the floor for people. I know you do.
To your sponsors too, the Dale IG, CMT Association, I know them quite well. CMT Association. Those. I'm glad that those sponsored you guys. It's a big show, this Trader Summit. And
Yeah,
thank you
it
for
was
doing
great.
this.
It was great to have you part of it, Steve. So good hunting, my trading warrior brother. Thank you so much for being with us here today.
Thank you, Dale.
It was really, I always have a great time when you're on camera, buddy.
I have a great time with you too, man. Always.
Thank you, Steve.
Buddy.
Thank you, Steve. Nice name, by the way.
All right. Thebesttraders.com, and plenty of testimonials to back it up. I believe our next speaker is my trading warrior brother, Peter Goodburn.
How's that?
There you are, Peter. You're live, man.
Good.
Looking good. All right, buddy. Take it away, bro.
Woo! Okay, no stress, okay? Yeah. Well, I thought, yeah, it is an end game scenario. And first of all, before I kick off, just again, thanks for inviting me today, because it's really quite special. I've been watching some of the speakers yesterday. I thought it was a great presentation from everybody. And I just want to thank you, Dale, for inviting me, Steve, and the gang.
Our pleasure.
It's really great, and a lot of great subjects coming up. So I hope I can sort of titillate you a little bit further before you all sort of break off for the day. But this presentation, which I've put together, is really just to go through what we've seen post-coronavirus. And my impression, just to summarize, really, is that the overall declines that we saw in the major indices, the sell-off, the coronavirus sell-off, basically was a de facto low. It was a correction which for many indices actually started back in the January 18 high. That was certainly relevant for the S&P 500. And for some of the European indices, the correction actually began in April 2015, like Eurostoxx 50 benchmarks and things like that. But I can say from an Elliott Wave perspective, one of the most amazing things about all of this is the fact that we have seen a very good confluence of signals all coming at that March low. So that third week of March was a de facto low. And I've put together really some slides today to show you exactly how those work. I mean, of course, I'll try and simplify it because not everybody's interested in Elliott Wave or is a practitioner, but I'll try and make it as simple as possible, because I think overall, if you get what I'm going to tell you today, you'll be able to sleep at night resting assured that the markets are going to sort of trade into new record highs before we get the pop, which is the inflation pop bubble being burst. So, well, let's begin. This is a risk disclosure. You don't want to see that. So this is the aftermath of the coronavirus sell-off. Now, just a bit of track record before we get into this, just to show you that from an Elliott perspective, you can actually forecast well ahead of time. But it takes a little bit of ingenuity to try and figure out what patterns are potentially viable going forward. Not all patterns are easily identifiable. There could be some extraneous events which cause distortion sometimes, and therefore that's why you often find people that are practicing Elliott Wave coming up with maybe one or more two different counts. But basically, you can narrow down the field if you do a lot of cross-correlation with indices like we do, and you can also work with cycles to get some idea of timing. Now, this is an old track record which I've had for yonks, which for anybody who doesn't know the lingo is a long time. But on the left-hand side over here, you can see a forecast for the Dow Jones Index, which dates back to January 26, 2004. And we were hypothesizing, after seeing all the 9/11 fiasco and then a major low in October 2002, how the Dow was developing to the upside. Now, there was a probability that we could have developed a straightforward five-wave advance and started off the final sequence of advances in the secular bull uptrend that goes back to the Great Depression lows. But in this scenario, we said, hey, there's going to be something more complex going on. Let's look at that scenario. And we forecast this pattern, which is actually called an expanding flat. It's a 3-3-5 sequence. Wave A was the actual decline from the dot-com peak down into the October 2002 low. So that was 71.97 on the Dow. And then we run up in three waves. In this case, we've defined a zigzag to 14,169. And then a huge 5-wave collapse down to 6411. Now, those numbers aren't arbitrary. We've used fit price ratios, and this is something which I've developed over the last 25 or more years to try and augment Elliott waves so that we have something to aim for, which is, of course, a very important strategy. If you're ever taking anything tradable, whether it's short-term, intraday, a 60-minute chart or whatever, or something where you're planning a pension fund or for your 401k, whatever it is, you need to understand what to aim for. And so from this in mind, we've used fit price ratios in a very particular technique. Here, what I've done is, in order to augment where wave B of this pattern finishes at 14,169, I've extended wave A, that's the vertical decline from 2000 to 2002 by 38%. So everybody knows Fibonacci ratios, that's a 38% ratio. So that produced the 14,169 number. And then basically I've extended to the downside the same measurement, but or the same amplitude decline for wave A, but by 23% to get to 6411. And here you can see the results. We got to 14,198. So we got within 30 Dow points at the top, and then 64.70 down to the low. And that was pretty special at the time. So we can actually go forward in time with a certain degree of certainty and plot our course with certain eventualities. Now, there's been a lot talked about recently about a 90-year cycle. But in fact, I think we can stretch that to 94 years. And this is a generic 94-year cycle, which goes back to the 1760 period. And you can see the cycle tops. Now, of course, normally, you would ideally in a cycle like this, you would like 5 or 6 repeating cycles. But because this is so long term, we just don't have the data. It doesn't exist, basically. We're going back to the 1700s, but that's about it. But here you can see that we've got 2 cycle appearances at 1835 and 1929. And if we just roll that forward, we get 2023. And I think that's our target date for the end game for the inflation pot peak. Now, if we go to this chart, this is a track record from December 2017. We were preparing this chart for our annual 2018 report for stock indices. And it depicts the S&P 500 moving up from the 2009 low in this 5-way sequence. Now, we've labeled it in intermediate degree, 1, 2, 1, 2, 3 up here. Now, we were saying at the time that wave 3 was coming into a completion and that wave 4 would actually trade down to about 2170. It would sort of rest upon this minor third wave high within the larger third. It'd stop around that sort of area. And then, of course, it would range trade, consuming time. It was important to consume time in this case because wave 2 was a very simple correction. Here we needed to expand more time. And then eventually it would result in a final push up to our eventual target. So how did it work out? Well, remember the 2170 number. And here we have, of course, our recent low, our coronavirus low at 2196. So we got within 20 S&P points, making that forecast ahead of time. The only difference was that the triangle pattern, which is a sort of a default picture for a complex pattern in wave 4, turned out to be an expanding flat. And an expanding flat pattern looks something like this. This is a typical expanding flat. You come down in 3 waves and you go up in 3 like this into a zigzag. And then eventually you come down into a 5-way pattern. You can see I've added a couple of fit price ratios in there. So that's what an expanding flat pattern looks like. And that's what's happened here. And the target that we have into 2023 is around 4,400, just a shade below. If we work with some of the monthly charts, we can even go a little bit higher. But generally, it's minimum 4,400 to new record highs. Now, we can that, I should say, was derived by extending wave 1 by 1618. So that's a generic fit price ratio that we've tried and tested over the years, and it works. This is the weekly composite cycle, and the intervals are about 7 intervals to make up this. But you can see that the the peak coming in for intermediate wave 3. It was a little bit early, and then it drops down here into the March lows. And here's the movement up, Jan, Feb. It's towards the end of 2023, early 24, that particular cycle, that's a weekly cycle, comes into fruition. So we've got a fairly good idea of where price is going. We've got a pretty good idea where the cycles are giving us the time indication for that too. Now, this is a track record of March 23rd, because we sent our subscribers at the time a buy signal on the S&P saying that the last sequence of that expanding flat pattern had finished at 21, around that 2174 level. And we had the measurement at 2151, and we could see that this downswing on the Monday, it was a Monday morning, was a bullish divergence, because actually we'd already given a buy signal in the Euroland stocks the Thursday before. So they actually bottomed a couple of trading days before the S&P. But this is just a track record, and you can actually see this on Twitter at the time that we posted this buy signal, that the end of the coronavirus, I think it was that title, that it had completed a major low for intermediate wave 4. And this is another composite cycle. It's a daily. And interestingly enough, we're topping out at the moment on the S&P. We had a reversal signature today, and we've sent out to all our subscribers a sell signal today on the S&P. But the reason is that this data I took about a week ago, but it's subsequently traded up to 29.65. And you can see late April, early May, the cycle turns down for a bit before it starts turning up. So that's another indication that we should have a bit of regression in the short term. And this is what the S&P looks like with the expanding flat. So we've got 3 down, 3 waves up, and a 5 wave down. And interestingly enough, for those who are familiar with fib price ratios, if you extend this upswing to 29.54 by 61.8, hey presto, you get a target of 34.05, which was just, well, basically, 12 points away from the actual high. It's a fingernail difference, basically. So you're on high alert for a reversal signature.
What told you the market was breaking down, Peter? I remember last time we were on, I don't think we were talking about this type of sell-off manifesting. What was it that tipped you off to the potential of it going back down towards 2,200?
Well, I'll tell you what tipped us off, this break here. See this low here?
Yeah, 3,200?
Yeah, it was, I'm not sure, yeah, exactly. And okay. That was definitely breaking the uptrend as soon as it broke below that. And we sent out an alert that day it broke saying, okay, we're isolating 3 waves up now. This is not basically a perpetuating bull market already from this low. And it's completely broken down because we measured this number and we said, okay, a break below that really changes the dynamics of this.
Did the speed and the magnitude surprise you at all?
Yeah, oh yeah, absolutely. I mean, look, okay. it just crashed, and we actually picked up the first 5-wave sequence down here. You can see at 28.55. And we sent our subscribers saying, well, it's 5 waves down. We've got another 5-wave picture coming down. We didn't know at the time whether it would end up as a triangle, which means that if you extended that by 61.8, you would have had initial targets about 2,500.
Okay.
But it crashed down, and then we could extend this number, this downswing, by 38%. And that's where we suddenly realized what was happening, that it was an expanding flat pattern. And that's when we posted the low eventually on March 23rd. It has been a remarkable scenario. Now, I have to say that if you're studying Elliott Wave, you wouldn't just look at something like the S&P and come up with a conclusion like this. You'd be checking across various indices. And I think it's very important to say that you've got to try and attempt to look at various. It's no good looking at this with a comparison to the Dow, because the correlations are too high and the patterns are going to be almost identical. What you're looking for is something that's generically a different pattern altogether, but is resulting in the same signal. We get a lot of questions about biotechnology recently because of what's going on with the coronavirus, and Gilead Technologies trying to produce a serum for that. And there's a lot of companies in the race to find the right coronavirus serum. But this basic chart of biotechnology, this is code symbol NBI. And what it's done is it's generally an incomplete 5-wave pattern from the financial, well, not from the financial crisis lows. Actually, you go back here, which is rather like the NASDAQ 100 index, because that bottomed in 2002. It didn't start its secular bull uptrend, the NASDAQ 100, from the financial crisis lows. That was a second wave correction, the same as here. And so we're missing a fifth wave. But over the last few years, in fact, the last 5 years, since the end of 2015, this biotechnology index has been underperforming. And it's been a real dog, and but it's suddenly coming alive. And it's in a fifth wave. And we've got a target at 97.50, which is huge if you consider, I took this, when was it, a week ago, 3,900. So we've got huge upside potential in this. If that's going to perpetuate things, then the crowd are going to be on the hunt for this coronavirus serum, perhaps. And maybe that's a good driver that's going to come through. This next chart is the, I'm sorry, I'm talking very fast because I've got quite a few charts to show you. So if you want to jump in, don't
go ahead.
Excuse me, but
doing fine.
This NBI technology index, this is a spread between NBI and the S&P, and we've had this running for quite some years because of our clients watching whether the performance would eventually come back, and we could identify a 5-wave pattern from here, and this was a third wave for those who know the Elliott wave lingo, and this was a corrective 4th wave correction, and we could see that we were going to continue the uptrend, which means that the spread is going to widen, but that also means that NBI biotechnology is going to outperform the S&P. So if you imagine that if you fixed the two and NBI is going up, the spread is naturally going to widen. So this is really great, and it's actually been widening since September. When we had the coronavirus sell-off, the NBI index dropped as well, so directionally it was still positively correlated to the S&P, but it didn't drop as much. It actually widened the spread somewhat during that time. So this is a great affirmation that the secular bull uptrend is still intact. So if you hear anybody saying, look, there's going to be a major collapse, the $4 trillion that the US government and the Fed and the Treasury are putting in to try and prop up the economy, that's going to be a disaster down the road. We're going to see a collapse. Still the rallies on the S&P at the moment, because we're going to collapse below the March lows. No way is that going to happen. I'm absolutely convinced it's not going to happen. We're instead going to start seeing a major secular bull uptrend. Now, we come to something which I said about earlier about cross-correlation and verification. This is the Eurostoxx 50 index traded in Europe. This is our major benchmark. From the financial crisis lows, we've had this amazing zigzag pattern going up to the 2015 high. It was April, where it was trading at 38.36. And the coronavirus sell-off, which you see here, is again another expanding flat pattern.
Yeah, it went nowhere all those years.
Sorry?
Now it's time for outperformance?
Well, I think it will outperform.
Is that because I know you're also thinking the dollar has peaked? Could that be part of the equation?
Well, it's an interesting thought, isn't it? Because we're going to look at the dollar in a moment and all the currencies. And but I'm going to
stop interrupting you.
No, I like it because I think it's very relevant what you're putting in there. I think it will outperform, but the main essence of this is that the coronavirus sell-off created the final C leg down, which is the third and final sequence of an expanding flat pattern.
Okay.
And it's unequivocally telling us that we've got a new uptrend developing. And I would bring everybody's attention to this upswing from the December 18 low. Whereas the S&P moved up in a zigzag from that, we know now that did complete into the high that we saw just below 3,400 in February. This also developed into a zigzag A, B, C in the same manner. And we can measure this 100%, wave A to B, and add that to C, and we come just about short of that target. And we nudged slightly above the old high, which is the qualification for an expanding flat, and then we can extend wave A here by 38%. And that would have come out at 23.28, and we got to 23.02. I think that's pretty good going considering where we are now. So this is really very, very important indeed. and why I think that the inflation pop, or at least the secular bull uptrend for stock markets is still undergoing. Now, we come to something completely different again, but giving the same signal. This is Deutsche Bank. Well, you probably heard a number of times over the years how Deutsche Bank has struggled. It's basically closing down its investment bank activities in the US. It's completely withdrawing.
BK, yeah.
I mean, you've heard of all of that story. But look at this chart. This is amazing. We go back to this high. Now, don't forget, 2007 is the pre-financial crisis highs. That's when a lot of commodities also topped out. And it's dropped down into a beautiful ABC zigzag. A down, B up, and C. And how do we verify that? Well, first of all, the devil is in the detail. First of all, we must have 5 waves in wave A, and we must have 5 waves in wave C. Wave A, financial crisis decline, down to 1370. We extend that by 61.8%. Here's the fire symbol. And we get to a target of 388, 389. And we're almost there. And I believe that we bottomed out. Actually, this was taken on April 10th. And I noticed that yesterday it produced its quarterly earnings, and the share price has gone straight back up. So we're getting nice reversal signatures for this pattern. Now, if there was going to be a secular bear downtrend and the markets were going to collapse below the March lows, as I know consensus analysts is still saying, then you wouldn't get this triggering a major buy signal here. This is going to be a multi-year rally, which will be a percentage retracement of this. I've got 50% retracement going up to something like 21. Wow. So it's going to basically, from the low, it's going to do, its big percentage is still going to triple, quadruple. So this is really big news. And now we come to Deutsche Bank, which is the blue chart, and we come to platinum. And the amazing thing about this is they look very similar, don't they?
They do. Steve, Volgi, platinum.
Oh, I mean, really interesting stuff. Okay.
Yeah, and from a fundamental perspective as well, Peter, platinum is extremely oversold, and even from a fundamental perspective, I think expecting a recovery there makes sense.
You think so? Yeah. I follow platinum a lot, and I'm in touch with a couple of PhD professors who talked about platinum versus stock market, and the fact that historically platinum versus gold, you would only see a major peak in the stock market when platinum has peaked above gold, not the opposite way around as it is now. So this is interesting. I mean, two ounces of platinum to 1 ounce of gold. What's going on? This is crazy. So we're going to take a look at some commodities briefly. This is platinum. And you can see that, again, like Deutsche Bank, it's a beautiful zigzag. We have wave A down, B up. And if we take 100% correlative ratio, so measure this vertical down, subtract from here. By the way, this is a log scale chart. Very important to do that. Otherwise, you're not going to meet these calculations. Then you can get a target at 610, which we had at the beginning of January. Never thought we would drop down in so quick a pace. But of course, it's correlated with the stock market. That's one of the key issues here. So we're getting a really amazing synchronization of stock market declines plus platinum also as a fringe commodity bottoming out in perfect timing to Deutsche Bank. So that's giving us another big signal. And if this is simply a 50% retracement from 2304 down, we're going to make 1360 to 1400 over the next couple of years or more. That's great. Now, here's platinum. And what's it look like with silver? Whoa, that looks similar. Well, they're both industrial metals. Yeah, that's really great. So we link Deutsche Bank to platinum, platinum to silver. Let's look at the next chart. This is silver. What's going on there? Well, we've got a big buy signal at the March lows when the stock market's bottomed at 1164. Silver bottomed. And why can we be assured that silver's bottomed there? Well, if we go back to this high here, this is the high that we saw in July-August 16 at 2078. And that decline encompasses initial downswing, a triangle pattern, and then another downswing here, which is a zigzag. The triangle pattern is really important from an Elliott perspective because it confirms that this downswing is a zigzag. And then a 3 price swing event up into September last year to 1966 is an X wave within a double pattern. And the secondary zigzag then dropped down into this low. And if we use, again, fib price ratios in the same exact way, repeating over and over and over again, we extend wave A, which is this movement here, by 38%. We get exactly 1164 on the button. Amazing. And since then, we've noticed that the upswing to current levels is a 5-wave pattern to confirm that the bigger uptrend is still valid. So over the next few years, we're going to get silver going to 22 to 25 bucks, depending on how much we extend wave A up to the top side. Now that's significant. And it also gives us a bearing on what gold's going to do in terms of its amplitude as well. Now, this is gold GDX. And I really love the mining stocks on gold because I think they offer huge multiple returns, much more than, say, gold bullion would do. I mean, we can see that platinum's hit a low. And at some stage, platinum is going to outperform gold. And admittedly, yes, gold is always going to attract. But I would be a buyer of gold mining stocks over gold bullion. And probably I would be a buyer of platinum stocks over gold mining stocks as well. But this gold miner, GDX, we had documented this chart in 2015 as an expanding flat pattern. You come down in wave A, B up, you extend that by 14.58%, you get this high, and then you come down in 5 waves. And in 2016, we were going online to a lot of webinars saying, watch out for around the $12 mark on the GDX, because once we get down there, it's finishing this pattern that dates back to 2008, and there's going to be a massive advance into new record highs. And we got it. Here in 2016, we saw this big swing up. This is labeled wave 1, or perhaps wave A at 31.79. That's the high in 2016. And then here's the flat pattern again, 3 down, 3 up, 5 down, perfect low. And the only amazing thing about this, which did really amaze me, was that we got down to this 1618 low for GDX.
On the crash.
And then, yeah, it crashed and then did a V-shaped recovery, didn't it? I mean,
yeah,
I never caught that. I was waiting to buy this thing and I never got in.
It was hard to react that day. I was interviewing someone who said he liked it. I said, well, why don't you buy it? It's, you know, 16 bucks, and he bought it.
If you've got the time, pick up the phone or press the button to do it. I was busy with clients, so I sometimes have to sacrifice trades in order to look after them. But
so we get a little pullback here, Peter, and then we're in 3 of 3 to the upside, huh?
Well, I think it's done. I took this screenshot about a week ago. I think it's traded up a little bit. I suspect it's going to have a pullback at some point. So I don't think too much. Don't be greedy, because this thing is strong. You can see the way the V-shape's recovery. But if you got back down, you know, if it pulled back down $5, buy it, you know, and don't leverage too much. You don't need to. I can tell you that if we go to the next screen here, this is my favorite mining stock. It always has been. Now, the same expanding flat pattern that I just showed you from 2008 is this sequence down here. Look, this is the expanding flat. It's a correction to the preceding advance from 2000. This is going to do 5 waves to 166. You've got to buy it.
Wow.
Even on an unleveraged basis. It's mind-blowing. You've got to do that. So
it's a triple from here.
And don't be greedy. Don't over-leverage, you know, is my say to everybody at home, you know, trading, because you don't need to leverage. This is huge still multiple gains. I mean, I wish we could have, you know, brought down when it flipped down that time. But Newmont Mining, you can see, didn't actually break 29.06 here. Whereas if I go back to the, you know, this is the equivalent low here. We didn't break that low. But so it's outperforming even the GDX. So this is going to be, but 166 doesn't look so unrealistic when we were back in.
You made that call down there, Peter. I remember it.
Yeah, it was, I mean, really, you've got to do that. So this is gold bullion. This is my preferential bullish count. A lot of Elliottians I know are talking about this upswing being a zigzag, but I think if it had been a zigzag, it would have already turned down in a bigger way from slightly below this number. If we extend the initial upswing to 1375 by 61.8%, we would have hit something like about 1628. And okay, you might say $100 on on this chart is not too much of a break. But I can tell you, these numbers are really important, especially when you're using the golden ratio. And if you're not familiar with using it as much, convert your charts first of all to log scale and start experimenting with the golden ratio. Extend certain things by 6018 or multiples 1618 and see what numbers you get. Historically, go back and test things. If anybody's not done that, it's going to be a eureka moment for you. Please do it because it's a life-changing event. Once you see it, you can't be, it's impossible not to be humbled by some of the numbers that come up. But anyway, the main point to this is that the fact that we've broken above 1628, I think probably lends towards the idea that we will break new highs. And furthermore, I mean, look, if GDX is going to make new highs, so is gold bullion. It's not going to stand by. And don't forget, silver has a very succinct pattern that's going to take us up to 22.5, 25 bucks anyway. And it might start to narrow the gap, the gold-silver ratio gap. I mean, record highs. I think I heard you yesterday, Dale, say that, gold-silver ratio has gone to new record highs. I had to look at it again this morning, just in case someone gave me a question on it. But I tell you, it's very difficult to predict what's going to happen there. But apart from saying the obvious, which at some point, silver will catch up and probably start to narrow the spread.
Thank you.
I'm running out of time, and I think, how much time have I got?
You could go over a little bit here, Peter. Go ahead.
Okay. This is oil. This is a very long-term chart going back to the Great Depression lows. I think where we've hit 650, which is, of course, a major low. This has gone back to wave 4 preceding, but it's setting a range. But I think what's going to happen is over the next few years, because of the inflation pop scenario, we're going to probably end up at $61, somewhere up here. I'm going to speed up a bit. I've got a couple of charts on interest rates, that's all. This is the long-term 60-year cycle on corporate AAA bond yields. Goes back to the 1700s. It's a generic 60-year cycle, but you have to give some tolerance, maybe up to 3 to 4 years, sometimes 5. But generally speaking, it's a pretty good indicator of the major peaks and troughs. So you can see the major peak here back in 1981, which was our last inflation pop peak. Yeah, I think you traded that as well, Dale, in those days.
Yes, I was only 40 then.
Oh, God, really? Only 40? Wow.
Yeah, I was in my prime then. Yeah.
Yeah, God, 7 kids and 40 years old. Anyway, okay. This is overshoot. This is basically bottomed out in July 16. We're well past that point. But you can see that the effect is basically up. This is the 10-year generic yields. Labeled the whole decline from 1981 as a zigzag down to 38 basis points. There's zero chance of breaking below that anymore. And the upswing that I'm basically prescribing is this big movement up to 6.5%. And I think we're going to have a credit crunch, which will probably occur somewhere in wave C here, which will basically, be at the time when the inflation pop, we get to our upside targets on the S&P and all of these biotechs and we'll probably sort of have a new high on gold and all that stuff. And
Peter, if I may ask, how does a credit crunch in a very indebted economy like the U.S. economy, an explosion of yields higher, because with current data and what's happening today, 5 or 6% yields is huge, and gold appreciating can go along with
a bullish stock market.
A bullish stock market, with the only exception being extremely high inflation, not just a pickup in inflation.
Disintermediation.
Well, my thoughts on this are that generally speaking, if the economy is ticking along nicely, you tend to get tightening, right? I mean,
sorry, say again. If the economy is ticking,
is ticking along nicely and starting to recover, we should start seeing at some later date, not immediately, but some later date, the Fed should start tightening again. Okay.
I'm waiting for that day.
Well,
my beard has grown, white, and I'm still waiting for central banks to become hawkish.
Well, what are the news? What are the fundamentalist guys going to say to explain the first wave up in yield, say to 2%? What are they going to say is behind it? Economic growth is stabilizing.
Growth stabilizing. Yeah,
growth,
that's the story.
Okay.
Yeah, I think so.
All
this
right.
is the next chart I want to show you. This is the tips. This is the break-even 10-year, and this is a perfect what I call inflation pop pattern. It's a zigzag from the financial crisis low. So we go back here. This looks like copper prices, and it looks like the MSCI Emerging Market Index and various other things. You can template them over, and they all look the same. But it's a very typical zigzag. We've got wave A, and you can see that inflation started to pick up after the financial crisis collapse. So as growth started to come back, monetary accommodation was there from the central banks. We developed 5 waves up, hit this number in 2011. 2011 was when the commodities all started to pull back, if you remember. Silver peaked, gold peaked, we saw copper peak, aluminium, lead, zinc, nickel, tin, all of those base metals peaked. And they all bottomed in 2016. This one has overrun into a double zigzag correction down into the coronavirus. And look, if we extend this downwards by 61.8 or 38% rather, we get into that low that we saw in March, and it's starting to squeeze up. So this tells us the worst is over. We've now got a 5-wave pattern up, and I think we'll get to 4.25% on this.
Okay.
I think we'll get to 4.25.
Yeah, I'm pretty contrarian. I've been fighting everyone with this narrative.
Do you think
that's possible, a lot of people talking zero rates right now on the 10-year.
No.
Yeah,
that's not going to happen. Okay. I don't believe it anyway. I don't think that's.
Yeah, I don't either.
There's too many things here pointing the other way around. Let's okay. Now our sponsors asked us to do currencies, so I'm going to zip through the currencies. This is the dollar index going back to 1660. Oh, okay.
Holy cow! I was just a kid.
You were just a bambino in 1660, Dale. I mean, you only had one kid at that time.
You know what? Peter's had this chart since I've known him on the Dixie. All right, for a while he's been calling for this.
Well, I mean, the thing is that a lot of people probably haven't seen this chart, so I wanted to bring it up today because
it's a great one.
It's a great one. I think the most important point here is the American Civil War, going back to this is 1865, 64.5, and there's a generic 5-wave impulse pattern after that. 1, 2, 3. There's a nice 5-wave subdivision in wave 3. You wouldn't think that you could even document that during World War I, World War II. This is really crazy stuff. But then eventually, if we measure waves 1 to 3 and multiply that by 61.8, then we can see that exactly measures the 5th wave to its terminal point. Now, this is the quarterly closing at 149.46. Of course, intraday, we got up to 160 something. But from a quarterly closing, which these measurements are based upon, it was exactly right, which is remarkable when you go back to sort of 150 years of data or 200 years of data. Quite remarkable. Now, we're engaged in a 3-wave correction. A down, B up, and C is derived by extending wave A by 61.8%, so we get to about 50, let's say. This is the cycle, which is attributed to the dollar index. Basically, it's a 15.6-year cycle, so we go up and down in what we call central translation, which means that there's an interval of that 15.6 years by 7.8 years. And if we go up and down in successive amounts, you can see that we're trending down for the dollar index to about 2023, 24. Well, that's a very interesting date, isn't it? Because
that's where the stock market peaks out. So a lot of these gains are going to be nominal and inflationary.
Right? Which comes back to the tips as well. So this is why I call it the inflation pop. It's the second phase. The first phase of the inflation pop was after the financial crisis lows, and this is the second phase that's triggering in now. So we're going to see, and of course, if you're familiar with Gann, and one of Gann's numbers was 42, we're about 42 years after the late 70s inflation pop. Interesting. This is the dollar
my
index.
win button out. Yeah.
Sorry?
Oh, my win button from the 70s. Whip inflation now.
Right, right.
Yeah.
If we overlay an Elliott count onto the dollar index, then that zigzag wave A down here produces 49.35. And we've been really sort of generically running up and down here for a little while, but this is burning time. I think we're about to collapse down on this thing. And I think give it another month or two, this will be substantially lower. And yeah, this is the short-term picture. And you can see how from 2018, we've rallied in a zigzag to that coronavirus peak, 102.99, and we've been gradually working our way down. I think I've got I didn't put a daily in that. I'll show you the euro. This is the euro. Yeah, this is a 16-year cycle. It's not 15.6, slightly longer, stretched slightly longer, but not too much. You can see the bottom in 2017, which was this low here, I'm pointing to now. And the next cycle peak is 2025. And here's the overlay, the Elliott wave overlay, 202. Now, I heard quite a few people saying, oh, the euro should be trading below parity to the dollar and maybe even lower. Never going to happen. Not going to happen. Why?
$2 euro.
This is euro dollar, yeah. Because this is basically bottomed at 103.41 already in early 2018. The cycle is already turning up. And if we go to this chart, you can see we've been in a 2-year regression, a zigzag, A, B, C. Here's the coronavirus sell-off to 106.35. And we're still lumping around the bottom. But I have to tell you, I've sold all my dollars. I've held them pretty well for the last 2 years, but I've sold everything out last week. And I wouldn't be long dollars in this environment at the moment. And here's the short-term daily chart, which we put in our bi-weekly reports. And this goes out to subscribers twice a week as part of our currency segment in the report. And you can see that we developed downwards from this high in late March into 3 waves. It's actually a double zigzag pattern for those that are familiar with Elliott wave. And this is starting to trend up. I think in the very short term, I think in last night's report that I published, I expected the euro to pull back a tiny squeeze bit, but other than that, it's trending up. This is sterling dollar, and the coronavirus sell-off produced a low at 114.09, but the outlook now over the next decade is very bullish indeed. This coronavirus sell-off to 114 has finished a huge expanding flat pattern from 201. I wonder how many times longer I'm going to say expanding flat pattern during this presentation. You can see I'm mentioning it quite a lot because it's such a repeating pattern. But anyway, this is the outlook for sterling dollar, and this is the short-term picture. Again, this goes out on our bi-weekly reports, and I'm expecting a little twist down, but then starting to really trend up again and continue its trend against the dollar. This is dollar yen, tricky this one, and I'm very sympathetic for anybody that says it could drop down to 90.30 immediately rather than going up to 21.80 first. The only thing that I was watching very carefully during the coronavirus sell-off was that it was positively correlated to the stock market. So when we got that drop to 101.18, here it is here, that was when the stock market bottomed, and since then it's trended up like the stock market. So I'm beginning I have got alternate bearish counts if we broke below 101.18, but my bias is towards the upside, because I think if we're going to trend up for stock markets, this will probably mean that people will liquidate safe haven yen, and even though the dollar's going to collapse, the yen will be a weaker currency because the stock market's going up. But I could be wrong about that, but that's my preferential count. So that's a bit of a question mark, that one. Aussie dollar, no question that it's going to trend up. Very conservative target to 83.60.
Yeah.
This has completed a 5 pricing event down from 2011, and we're going through a simple correction. So 61.8 seems to be an obvious one. Wouldn't surprise me if we did a lot more to the upside on that one. And here is the short-term counts, which again featured in bi-weekly reports. Looking for a little bit of a twist down there before we go up, as you can see on the inset chart. But that's dependent on really finding resistance around here. I think we've hit that number today. And if it's correlated to the stock market and that drops down a little bit, I think I'm looking for a 9% downswing on the S&P to about 26 38. Then maybe this can drop down. Let's see. This is dollar Canada. You notice that I'm emphasizing some of the commodities currencies. This is, as you know, somewhat loosely correlated to oil. When the oil price collapsed, this one shot up to 146.69, but interestingly enough, it didn't take out this high at 146.91, and it's subsequently trending down. I think this is going to collapse, obviously. That means the US dollar collapsing down and the Canadian dollar appreciating against, and that is consistent with a rising oil price. And here's the short-term Canadian dollar. You can see that this upswing up here is measured to its completion. It came a little bit short. We could have allowed it to 47.5, but I think this is enough. And you can see the dollar index is dropping down as well. So this is ready to start accelerating down the CAD. And this is dollar Brazil. Now, of course, we heard that Lula's been released and then rearrested, the previous president. And Bolsonaro is now firing his judicial judge. And everybody's gone crazy about the economy, and it's weakened the real. But I had this target to fire 72. It's a fifth wave measurement, 61.8 proportion of 1 to 3. And it's hit that so far, and it's reacted down from around that number. So do watch that if you're interested in Brazil. I have to say that I haven't got an updated chart for the Brazilian Bovespa. There just wasn't enough time to put everything in. But that's looking really bullish. And maybe if you do have access to Brazil, you could maybe buy some Brazilian stocks that look good. And you'll also get an appreciating currency. Sooner or later, this will start to appreciate against the dollar as well. So you'll get a double whammy there. And this is Norwegian kroner against the dollar. 5-wave pattern from 2008 finishing up here. I was looking to see if it could stretch a bit above the coronavirus high, but it hasn't. And it's subsequently dropped like the Canadian dollar. So this is heading down as well in a big way. And then you can take a look at the Russian ruble. Interestingly enough, the ruble has not broken above this old high here back in 2015. And it completed 5 waves down. I was thinking to myself, oh my God, look at this crazy ruble depreciation. The dollar's pushing up during the coronavirus sell-off. I thought, wow, could it actually break that 86 number? But it didn't. It stalled at 82 and it's dropped down since, and it looks like this. So I'm pretty convinced that that's topped out. And we can extend this by 61.8. Here's the golden fire ratio number. And it produced an exact high there, an exact high. Really quite remarkable stuff. So this is definitely going to decline. So that means dollar weakness, Russian ruble appreciation. So I think that's my last chart, actually. Yeah.
Okay, so great. Peter, what a great presentation on crystal meth. I've never seen Peter move this fast. So anyway,
Peter, I'm afraid you're my confirmation bias. A few weeks ago, I gave my favorite trades for long-term FX. 2 of them was long NOK and long rubles against US dollar. So you're my confirmation bias. I'm 100% with you. And what I like, I mean, Peter has a meticulous, obviously he's an expert in Elliott waves, but if you know fundamentals, the way he analyzed markets, everything makes sense with each other.
It's like a jigsaw puzzle.
Yeah, the puzzle is coming together, and I'm 100% with you. Probably I should stop following you because you make me feel even more confident in my thesis.
That's dangerous. So Peter, people could go to your website and check you out and take a subscription.
Thanks, Dale. Yeah, I mean, if anybody would like to subscribe to our bi-weekly reports, by the way, it's $39. I mean, if you can't afford that, you shouldn't be trading in the first place. But anyway, we try and make it as competitive as possible. I'll just pull up our website. This is the front page of wavetrack.com. And if you want to subscribe to the Elliott Wave Compass Report, just go to here to subscription and click on subscription. And here's the Elliott Wave Compass Report. And you can subscribe there. Just go to add card and you can put in multiple time periods for whatever, 1 month. You can subscribe, and we don't actually enforce you to sign up for an automatic renewal. I mean, we really do trust that, if you want to and like what you see, you can basically just let subscriptions expire. And we're even willing, if you don't like it whatsoever and it doesn't fit your time frame, then you can always contact my team at WaveTrack and the services at wavetrack.com and get a refund. So I'm quite happy to do that. So there's really a win-win game here. If you can, then please do. We'd like to welcome you.
There are no refunds for this 2-day summit. You know why?
I don't blame you.
You know why?
Why is that?
It's free.
Yeah, of course.
No refunds here.
That's
so Peter,
right.
thank you.
But Dale, I have to tell you, oil traded into negative territory last week.
Very true.
Thank you, Peter.
Thank you, Peter. It was wonderful.
What a great presentation.
Thanks, guys. Thanks a lot. I appreciate it. It's a great event, and good luck to all of you.
Same to you. Looking forward to having you.
Peter Goodburn, and you could follow him at Elliott Wave Track.
Thank you, Peter.
Peter, thank you very much.
Thank you, Dale, for being such a great host. You've been the marathon man the last 2 days. You've been doing a great job. And before we bring on Lydia, I wanted to make sure that everybody knew what a rock star you've been.
Thank you, Blake.
And so much so, you're still wearing a collared shirt. I actually had to put on the Forex Analytics clothing. I couldn't deal with the collar any longer.
I haven't done laundry. So anyway, thank you, Blake. Appreciate it.
Hey, have a great interview with Lydia, and she's awesome, and
she is
excited to have her part of this venue. So,
I mean, after these 2 days, Blake, everyone should know what to do the rest of the decade.
Yeah, no kidding. With every asset class too. That's awesome.
Yeah. All right. So Lydia, at Faith Might on deck. Great to have Lydia here. Lydia is one of my favorites. Lydia, how are you? Thank you so much for your patience.
Of course. No problem.
Great to have you here at the 2-day summit. And I know that you put your heart into everything you do, and you're one of the better currency cable people that I go to. The only thing I'm better at is Europound. But everything else when it comes to, and even look, I think it's bottoming here, Lydia, so I can't wait to get your take on what's happening here in cable. And your company is FM Investments, is that it? Group?
FM Capital Group.
Okay, and you're also an RIA, and you're also a mentor and a teacher that most likely has more patience than I do. So welcome to the summit, Lydia. Looking forward to your presentation.
Thank you so much for having me.
You know the drill for sharing the screen here, right? The green button.
And Lydia, if you can get a little bit louder on the microphone.
There we go.
A little bit.
Okay. All right. Perfect. Thank you guys for having me. So I know we're a little behind. So
also, Lydia, I have to tell you that the moment we announced that you're on, we had the person sending a question for you. So at the end, I have at least one question.
Okay. All right.
You. Okay. Enjoy the presentation, guys.
Thank you. So I am going to get through this part so we can get to the charts. But I am talking about market implications, but from the pound perspective. So I wanted to kind of lay out why I look at markets this way. I get a lot of questions as to why I only trade the pound. So I want to just kind of give everybody, if you don't know me, I have been trading Forex for about 14 years now. And I started off like everyone does, and I've traded everything. I traded all the pairs, all the crosses. I traded everything. And what I found, and I traded all time frames too. So not only choosing what resonates in terms of currency pair, but also with your time frames. I traded 1-minute charts. I traded weekly charts. I traded the gamut. And what I have landed on is the pound quite specifically, and I'll tell you why. It resonated with me because while I was trading, when I started out 14 years ago, I also traded all kind of indicators, trying to get a handle, just, like all of us, we are learning what system will work for us and with our trading style. And I really love Fibonacci. So if you follow me for any amount of time, you know that I trade Fibonacci, trade using Fibonacci levels. And I loved how pound reacted to Fibonacci levels. And so I decided to pare down from everything that I was trading. And I looked at the pound dollar is what I love. So, you know, that's my bread and butter. I also really like the euro pound, and I like the way they move. And if you trade those two currency pairs, you know, they move very differently. And I still really enjoyed both, how they both reacted to Fibonacci and technical levels, but Fibonacci in particular. So I chose that. Then I realized that I was not being successful on 1 minute charts. And so if you know me, I am a swing trader. That means I look at weekly charts, and I'll look at anything as from a weekly, and I drill down daily and a 4 hour. I will look at a 1 hour or 15 minute, but not to trade. It's usually just to watch price actions around news events that are volatile. So month of March, I was looking at, you know, equities on a 1 hour, 15 minute chart, just watching this thing crash, right? But when it comes to Forex, I typically start at a weekly chart. And I'll dial down to a daily and a 4 hour. Today, in the interest of time, I'm going to take you through charts from a weekly, then to a 4 hour, just so I'll give you, you know, the big picture view that I'm seeing in terms of swings, and then a 4 hour chart in terms of setups. But so that's how I chose what resonates, and that's what I stick to. I do not, you know, I don't day trade. I don't trade the euro dollar. And I just stick to what works for me and what really resonates with my trading style. So
have you ever been to the UK, Lydia?
I have not been to the UK.
I bet you're really going to resonate in London.
I don't know if I have enough sunshine for this California girl. So I say just always choose what resonates, and basically just trying to give you a lay of how I chose my trading style and getting an understanding of how best it works and how I make adjustments when we're in trending markets versus ranging markets. And then to show up every day. A lot of traders, those of us who've been trading for a while, we do this every single day, and we have a set time of day that we're doing this work. So a lot of newer traders are not, you know, they'll come in every other day, or they'll come in at random times of the day with Forex. It's really important that you just show up every day at the same time of day. So just kind of wanted to give you a lay of how I got into this trading style. And now I'll give you just a quick overview of what I'm seeing fundamentally. So the pound, ever since Brexit, through 4 years ago, Brexit has been the prevailing fundamental headwind or tailwind, depending on what's happening in the political atmosphere. And basically it's become the ultimate risk currency. When we're seeing times of risk off, when the market crashed, you'll see most cases we saw the pound crash. And really the impetus for that was earlier in the month. Trade talks between the EU and the UK had broken down, and we saw the pound rolling over. And when the equities crashed with coronavirus hitting U.S. shores and hitting Europe, and then hitting the UK, and then hitting the U.S., we saw the pound really crash, particularly against the pound and against the euro. So that's now that we're starting to see talks. We had some news of a possible treatment. If we look several months out, maybe a year or so out, we'll get news of a vaccine. As we start to get the economic, we're going to get back on view in Forex around economics. I think we're going to see Brexit talks. Brexit is going to continue to dominate the pound flows for the rest of this year. Coming up is the June 30th deadline, and then we have the 31st deadline, December 31st deadline, where some kind of trade agreement either will or will not be hammered out. So just keep an eye on that when you're trading the pound. The dollar is people are talking about it. We've called it a safe haven for several years now, since the last financial crisis. What we're seeing now with coronavirus is that it's actually beyond a safe haven. It's actually a liquidity haven. People are wanting cash. People are wanting dollars. So despite the extreme monetary easing that we've seen with the Fed, I think the Fed has gone the furthest just in terms of slashing rates and pumping trillions of dollars into markets. but we're also seeing this demand for dollars. And so while we feel like fundamentally the dollar should weaken in the long term just because of all the easing that has happened, there's also just a demand in the market for dollars from emerging markets, from other markets, just people wanting cash, at least here in the U.S. So we're seeing this tug of war, which is why we haven't seen the dollar sell off in the face of all this liquidity. The yen still remains a safe haven, but what I've noticed, and I think several of you have noticed, is that there's this divergence right now between the yen and the S&P. And the S&P is what I watch in terms of equity markets and when I'm looking at safe haven flows. And what we're seeing right now is that there is a divergence right now. When the yen diverges, we're seeing yen strength. We're seeing yen weaken. And we're seeing equities kind of based here and kind of rally, we're going to see the yen follow. And so we'll see, and I'll show you what I'm seeing there when we look at the pound yen. The euro, with the lack of the fiscal stimulus package, I think we're going to see euro continue to weaken here. We saw a nice rally, particularly against the pound. Remember, my view is against the pound. We saw a rally against the pound, and that did not last. It did not stick. So I think as long as the EU is unable to figure out what kind of stimulus, and they're going to be really leaning heavy on the ECB to come up with a lot of support for their economies, the euro probably is likely to weaken from here. And then the CAD. The CAD, all the commodity dollars, the CAD, the Australian dollar, the New Zealand dollar, have all joined the QE club, enacting QE in the last month in response to the coronavirus. The Canadian dollar, the Canadian economy has seen a double whammy with the fall in oil prices as well. The Australian dollar has saw extreme weakness because of its proximity to China and considered as out of the major currencies, is basically a China proxy. And then the Kiwi is our soft commodity dollar. And it's actually weakened tremendously as well, as they were one of the first countries outside of outside of China to get hit with the coronavirus, and now they're one of the first to reopen. So we're seeing that the New Zealand dollar is finding a little bit of strength here. And unlike other central banks, which might be a tailwind for the Kiwi, the Reserve Bank of New Zealand has mentioned that negative interest rates are not out of the question for the Kiwi, and that's likely in response to the fact that the Kiwi remains kind of strong relative to some other currencies. So that is just my quick rundown of what I'm seeing fundamentally. Let's go now into the charts. Okay. All right. So my look here, this is the Kiwi. I'm sorry, this is not the Kiwi. This is the cable.
Yeah, cable.
So cable going into 2020, we saw a run up right into $1.35 with a lot of euphoria around the Tories gaining majority in Parliament. Which looked like good news for Brexit, and we wouldn't get political gridlock, and we saw the pound rally. And that soon came off because of tensions between the EU and the UK around trade agreements and actually working out the terms of the Brexit deal. So we're seeing that come off here, and this crash here is the coronavirus crash. So we're going to see this pretty much across the board. These large moves down in a couple of weeks. This is the weekly chart here. And what we're seeing now is this bounce here and this recovery right into support. So what I look at is, we'll draw a Fibonacci here because this is great continuation, really. This rally into $1.35 coming right into the 61.8 level and falling to new lows. That's what we like to see as fib traders. That's what I like to see. And so when I take a look at this new bounce, clearly it's a correction, and it's a correction into or just past the 50% level into this support at $1.2634. And then we saw it turn over and kind of head down into about $1.22. But if we take a look at the 4-hour chart and kind of zoom into what's going on here, you can see like this rally never really corrected into the fibs. And when that happens, and really even starting from here, we had this nice rally. We had a bit of a correction into support, and then it took off into $1.2634 resistance. And we fell over last week, and we're right back at resistance again today, and not ever reaching these fibs. When we see moves like this, when we see trend moves that are having very shallow corrections, this is very good for the direction of the trend right now. So on the 4-hour chart, the trend is to the upside, and what we're seeing in the short term is actually still quite bullish behavior. So so the fact that we've come into support here, come into resistance again here is very bullish. I actually think that cable has a chance to return to $1.30 as the markets start to sell off the dollar just based on monetary policy, and in contrast to other central banks, which haven't pumped trillions of dollars. Most of them are looking at more like 300 billion. So there's billion-dollar packages. So they're significantly smaller relative to what the Fed has done, and has kept the door open to even doing more. So right now the market is just responding as fundamentally as it would, which is just negative when there's a lot of monetary policy easing. So I see this going into $1.30, and if we pull back out, $1.30 is up here. That's a return back to these highs. That's a return back to the start of this downtrend. So, oh, this is $1.30 here. I'm sorry. So if we $1.30 will probably be our line in the sand to see if we return back to highs, and the dollar actually has a sustained sell-off, or if this is just in response, and we have some other fundamentals that kick in with like with the news, with the economy, and things like that. So that's my view on cable. Taking a look at the euro pound. So euro pound, I will say this is where Dale says that this is where Dale had this call. He did call this out to $0.90 to 90 pence. And I thought he was just like getting way ahead of himself. So we spoke, and when he and I spoke, we're actually looking at this double bottom in here, this double bottom potential.
I'm always over my skis, Lydia.
I thought it would go to 88.50, which was a long call from 82, but Dale called it to 90, and I just thought that was too soon to make that call. But here we are. This is part of the coronavirus crashing here. We saw a crash in the pound, and it took us all the way to 95 pence. And here we are now back below. And I have to say I'm surprised by the pullback. I thought we would see continued weakness in the pound, and we haven't. So we've broken that 61.8, which to me signals a reversal back to lows. So we'll see what happens with the euro. I think the euro fundamentals actually support a move lower from where we currently are. We have a nice level of support here between 86, 86.50. A break below that will see us return to lows. If we hold above here, we can see a return to 88.50. We can see that this has become a point where we see a lot of bids enter the market because really until the EU can come up with a fiscal package, the market's going to be concerned that their recovery in the EU may not look like a recovery in the rest of the world, where countries are able to have fiscal and monetary packages that kind of support the economy while businesses and consumers.
Would closes back over 61.8 kind of change the tone if we recaptured 87.47 and closed above it a few times?
So good question, because now you set me up for, this is the view I wanted to show. So drill into the, I'm going to draw it here because it's easier, but then we drill into the 4-hour chart. And is that fib? What is this? Oops, sorry. this is the fib I want to put on here. Down to current lows here. So I think recovery of that 87.50, basically 87.47 that you're talking about, Dale, I think could be a catalyst, yes, to move higher still. And really, but really we need a close above this 88.50. So anytime we come into 88.50 from the downside, so far we've been met with sellers. So 88.50 would be more important than the 87.50 level.
Thank you.
To the upside.
I have a question for you, Lydia.
Yep.
From one of our attendees, how would you suggest beginning traders would try and trade FX markets given the current conditions? Is this a market for amateurs to stay out of, or just reduce leverage significantly? What would you advise, Olivia?
Well, I think for all newer traders in Forex, I think smaller size and a smaller account while you're learning is definitely how you want to approach the Forex markets, period. I started trading in 2006, 2007, 8. So, I mean, the volatility that you're seeing now is nothing like what we were seeing at that time. So I think it's actually a great time for you to get into a market that's, that's kind of more volatile than we've seen in the past couple of years. But I would go at it with a smaller account and smaller position sizing for sure. But it's not a time, I don't think it's a particularly special time that as a new trader you should be out of the markets. It's just the perfect time. Really.
Yeah, because if they can handle this, they can handle anything.
Yeah.
And I don't think things are going to quiet down like they did pre-coronavirus.
For like the last 2-3 years, really, as the last 2 or 3 years, I think we all agree that it was uncharacteristically quiet in Forex. Okay. So this is just a more volatile market.
This is what we be careful what you hope for, right? Here we got it now.
This is actually what we love. This is why we this is why we pay Forex. This is
what we live for.
This is it. So you should definitely get in. Be smart with your account sizing and your position sizing just as a new trader. That's
good advice.
Not a particularly special time in the markets at all. Guppy, I know you all love the yen. So this is what I found particularly interesting about the yen. First, during this Corona crash, we did not breach the lows back in 2016 when the yen strengthened considerably down to $1.23. We only made it to $123. We only made it to 124 yen during all of this volatility, all of this crash and sell-off in equities. Another thing is that the RSI was even higher during this coronavirus crash than it had been in the sell-off last year in 2019. So all of that to say that the yen could be done strengthening here. And you might, if you're looking at equities as well, maybe equities has a chance to stabilize as well. I actually think, I'm actually not surprised at markets or equity markets being so well supported right now. I actually did an overlay looking at let's take it down to the 4-hour chart. If you take a look at just the equity markets right now, this is today. So this is today. But when I was just looking at it, just studying all week, we've had quite a divergence as equities have moved higher. The yen has just basically just kind of stayed put. It hasn't moved. It hasn't really moved any high. It hasn't moved higher. Hasn't weakened until today. So today we're getting some yen weakness. And what I wanted to point out is when we see this divergence between the yen and equities, typically equities is leading. And what we'll see is the yen catch up and start to weaken as well. You'll see that a little bit in the past here. And so not too surprised that the yen weakened here. It happened on today, which is, nice coincidence. But, I think that we can see the yen actually start to move a bit higher from here, particularly with the divergence at the lows and the RSI. And I like the pound yen to kind of recover and get back towards $140.
Okay.
And then I'm happy to just finish it off with the Canadian dollar and take questions from here. Right. Just because the Canadian dollar, the pound CAD is probably the only market that I was looking at amongst the major pound pairs that is actually in a range bound market. So there's not much trend here on the weekly chart. We get moving in one direction and we completely retrace. So this has been the case, it seems like, for the past 2 years in the pound Canadian dollar. And then drilling down into a 4-hour chart, you can really see that, at the extreme high, the top of the range is $1.77. And at the lows, we have $1.73. And you're basically just taking a ride down from resistance to support and back up again. So back here, now we're up here. I have this dollar about $1.7550 kind of as an intermediary level. Sometimes where we seem to turn over if we don't get to 177, but right now we're pretty much range bound when it comes to the pound Canadian dollar. So just wanted to show an example of a non-trendy market, even during these volatile times in the market. Not everything obviously is going to be moving in the same direction.
Okay,
so I'm happy to take questions from there.
Okay. How did you get into FX? What was your background and how did you get into FX? From Randall.
So that's a great question. So my path into Forex is not a typical one. My mother actually introduced me to Forex. So I came back.
Wow.
I came back home from business school. I just graduated from business school at Georgia Tech. And I'm looking for a job. I was between jobs at the time. And she said, you should come with me to this seminar. And I said, okay, well, what is it about? And she said, oh, it's about buying and selling currencies. And I said, well, you can't do that. And as soon as I said that, I said, okay, I'll go, because I just realized that anytime you think there's something that can't be done, it probably can be done. So let me go and see how it can be done. And this is, I don't know if Blake knows this, but this is actually how I got introduced to Blake. So I went to the seminar for the company he was working at that time.
Wise Trade.
Yes. And was super compelled by how easy you could buy and sell currencies relative to stocks. I mean, at the time I was only buying mutual funds and stocks at the time, and you really couldn't sell stocks then. I mean, short selling wasn't really a thing like it is now. So I was just so taken with Forex because you can buy and sell, and
it's where it's at.
It is, clearly. And so, I mean, that was 14 years ago. And I have been trading, and so just started trading my own account. And from there, I got a mentor. Ilion Yoltov was my earliest mentor. I followed Blake as well for a long time, but really Ilion's approach to the markets is how I learned fibs, really got into support and resistance. And from there, just learn the indicators enough to be able to trade the charts on my own with my own analysis. And then from there, just got onto Twitter, and really it all snowballed from there. When I got onto Twitter in 2009, I made it a point to talk about Forex. And at the time, I had already decided I was talking about the pound, and that was very unique. People were like, why are you trading just the pound? And pretty much how I ended up here today with you all.
Because it resonated. Does your mother still trade, and what trading platform do you use?
Oh my goodness. My mom does not trade. My mom is just an investor. She just likes investing, period. She'd rather I trade it for her, and she gives me the money to trade on her behalf. She prefers it that way. She's just interested in just
why have
markets.
Kids? Why have kids if they're not going to trade for you? Right? Okay. What a great presentation, Lydia. Thank you so much for all your hard work.
Lydia, as I said earlier, we had a question that came in the moment we announced that you're going to be on. Actually, it's a triple question. How do you define success as a trader? What's the hardest mistake to avoid while trading? How do you feel your biases affect your trading? What are 3 things I can do to take my trading to the next level? All those came very, very early before the event.
It's a 12-part question, Lydia.
Yeah, but if you want to briefly, address those bullet points, I think we can close with that.
Sure. I mean, I think like any trader, I'm defining success by my P&L, but also if I'm following but above that is if I'm following my trading plan. So if I'm coming at markets with a plan, that's great. If I'm sticking to my plan and trading the plan, that is the mark of success. And then the outcome is what the outcome is. So I think it's super important to go into markets every week as a swing trader every week and have a trading plan in which you're going to look at markets. How to take your trading to the next level? I think you should definitely pair up with a mentor. So any of the traders here, Forex Analytics runs a great service. And if you're newer to Forex, I have a course actually that you can take. And if you're here now, I actually have a special for, I'm running this special right now for all of the Trader Summit participants and attendees right now. You can check out this course. It really is designed to teach you how to look at charts for yourself and learn just the 5 basic indicators that most of us have actually gone over in these last 2 days and use. And just to give you a basic foundational course so that when you're now then approaching a mentor, you have a background of knowledge to which you can build on and just accelerate your learning curve. So that's one thing I think it's really important. I think a lot of us were self-taught and we've gone through the gamut of learning, blowing up accounts, all of that. I will also say be comfortable with losing money. I actually spoke with somebody on Sunday who was interested in trading Forex and was just very concerned with not losing any money. And I just told her, like, you have to get rid of that ideal. You're going to lose money. And so the quicker that you can just embrace the fact that you will lose money, the better you'll do. And the key is to just, how are you approaching the markets? Which is why I wanted to kind of start off with how I come into the markets. That's the biggest thing. Do you have an approach to Forex that works for you, that resonates for you, and the current prevailing market environment works with that approach? I mean, those are the things that will give you a higher probability of success. Like Forex is not stocks. This is a leveraged market for us retail traders. So it's really important that we are much more systematic than just buying and holding something, and have a real approach to the markets. Lower part, did I answer? I only answered 2 of the questions. Were there more, Steve, that I didn't really touch on, or another part of the question that I could touch on?
Yeah, let me tell you, how do you define success? You answered that. What is the hardest mistake to avoid while trading? How do you feel your biases affect your trading? And what are 3 things I can do, the person that's asking is saying, to take my trading to the next level? These were the questions.
Okay, yeah. So definitely my biases, are probably recency bias. So if, when you're getting a win or a loss and you immediately jump into the market, either to revenge trade or either to, feel like you can recapture more money in the market. Also, there's a feeling of like not gathering enough pips out of the market and being remorseful with your wins. Please don't feel that way, but recognize feeling that way. I think a lot of us will feel that when we take profits and we see the breakout just continue to run, for another 100 pips, and you're mad at the 50 pips that you booked. So those are the different biases. There's a lot of psychology, I think, in Forex, even more so than in other, in stocks. I'm really comparing to stocks. I can't say to futures or options, but I think with Forex, there's a lot of psychology that you want to really be aware of within your own trading. I know I had to work through a lot of revenge trading. Like revenge trading was a big thing for me when I first started trading, and being remorseful for the winners that I was taking. I could capture 100, 200 pips and be upset because I didn't get the last 50. I mean,
That's
come on.
me, Lydia.
So, yeah.
You know, Blake Morrow says, don't live in woulda, coulda, shoulda land.
Yes, Blake is great for that. Blake is actually one of his early, kind of mantras.
I've been living there for 60 years. I finally came out of it because of Blake.
Yeah, it's tough to watch the market go when you're not involved, especially when you've been on the right side of the market. But Blake said a long time ago that if you're up more than 20 pips, there is no reason to take a loss after that. And so I've had to refine my approach to just kind of incorporate that that thought process is that especially in this market, just being careful, where your psyche is at any moment in the market, being able to walk away from the charts.
And Lydia, I mean, that was obviously a long time ago. The market's changed. There's just a point in your trade, because it really depends on your time frame. It's like there's a point in your trade that you like, hey, I shouldn't take a loss from here on out. I just shouldn't.
Right. Right. Absolutely. Yeah. And I'll say back then, Blake was looking at a 5-minute chart. So like you said, it absolutely has to do with the time frame.
Yes, it does.
Okay.
It totally has to do with the time frame, because when you said, Lydia, you shouldn't be losing money once you're 20 pips in the money, I immediately thought with my trading style, which is more, longer term, I would get stopped out probably in every single trade.
Many ways to skin a cat.
Right?
Right?
You have to know your time frame. And,
absolutely.
The last question, I think, was not for biases, but I just think that now is as good a time as any to get into the markets. And I will say, lastly, don't spend too much time on a demo account. So I think that's another really big mistake that new traders take. Use a demo account to learn the platform that your broker has set up for you. And as soon as you're comfortable with the buy button and the sell button, setting your limit and setting your stop loss, you should jump into a real account. Because the psychology around that is completely different. I mean, you're going to feel a lot different about losing $100 than you were about losing the $10,000 in the demo account. You're going to feel way different about that. And so you really need to get into, like I said, a small account with small position size as soon as you can to start to trade your approach to the markets and start to understand your psychology around trading so that you can get a handle on that as well. And so that's really what I would say for newer traders who are looking to get in one and then take your trading to the next level.
Thank you, Lydia.
Yep, absolutely.
You were the icing on the cake.
Well, thank you. I'm sorry for the technical difficulties there.
It's okay. That's television. That's live
TV. It happens to the best of us. And Lydia, I want to say thank you for being part of our event. This is it was really nice having you.
Thank you so much.
Thank you very much, Lydia. It was a pleasure.
Thank you. Happy to be here. Thanks again for including me today. Thanks, everybody.
Okay, Lydia. You can follow Lydia at FaithMight on Twitter and then get all the information. Also at her website. You want to give your website? There you go. Here. All right.
And again,
FaithMightFX.com.
Fairly quickly, I know people are asking for the slide. So this is the offer. We can jot it down real quick, everybody. And those are my handles, Twitter. That's the firm. That's my blog. And so you'll find those things there.
Thank you, Lydia.
Thanks, guys. Thanks, everyone.
Everyone.
Have a wonderful day.
Thank you, Lydia.
Is it dinner time? Yeah.
It's about
like dinner time to me, man.
Dale, I want to say what a great job you've been doing. And Steve, wonderful. The whole team really came together to put together this event. Lydia's the last speaker, right?
Absolutely, Blake. That was it. I think we wrapped up a quite long today event, right?
You guys have done an amazing job. Really quick, I'm going to show this just so you guys have it. Remember, if you're, oh, sorry, I've got my dogs. Excuse me.
No worries, Blake.
Of course that would happen.
I had my cats
Hold on one
earlier.
second.
Yeah.
They know exactly what I'm speaking. Okay. So what I wanted to say, guys, sorry about that. If I should have shut my door to my office. The Trader Summit, Forex Analytics, you know, I know we've talked a little bit about Forex Analytics, not a lot, but if you want to be involved and you want to take advantage of the Trader Summit offer, 75% discount on the first month, and then 25% discount thereafter, which is great because we don't do that normally on monthly subscriptions. So Steve or Stelios or one of you guys can
already done, mate. Already
okay,
done.
put it in the chat. And then I want to once again thank our sponsors, Forest Park FX. If you guys aren't happy with your broker, I mean, I know in the United States we only have a few, but if you're somewhere else, you might actually be able to get Forex Analytics for free if you join the reimbursement program, and you could even be with a broker that's part of that program. And all you have to do is go through Forest Park, and you can possibly be using Forex Analytics through your trading. So make sure you talk to them. They've helped hundreds and hundreds of our clients over the last several years. IG Markets, really wonderful brokerage firm. I haven't used them personally just because they're so new in the US, but if I traded retail and I didn't use JP Morgan for my executions, I would be looking at them because I know what's out there. CMT, Tyler did such a great job today outlining the CMT organization. And Steve, you need another 12 hours a day so you can finish up your designation. That's what I said.
Yeah, I'm eventually going to do it. Let's hope things calm down a little bit to give me the time.
All right, and then obviously FX Street, they've been wonderful to us over the years. We've mutually put a lot of stuff on each other's sites. They're a great media partner. So thanks to all of our sponsors, and thank you guys for your patience. I know we had a couple of technology glitches, but nothing we couldn't overcome. And Steve, you want to tell everybody about the recordings and how that's all working?
Yes, we're going to edit all the recordings. They're going to be uploaded, worst case scenario, within the weekend, by the end of the weekend. And then we're going to email everyone, you know, letting you know how you can watch them. So that's how it's going to go. Like,
great. And then I want to do something that I hadn't done. I meant to do it a couple of weeks ago. Then we got caught up putting together this event. If you like this shirt, it says Forex Analytics. Mine says Chief Risk Manager on the back. We've got a few different ones.
Like that one.
We do need to do a product giveaway where we have mouse pads. These are nice ones too, real thick, super thick mouse pads and coffee mugs and t-shirts. And we got to do a couple giveaways. So you guys tune in to the Face webinar next week. We're going to figure out a way to get a couple of winners for some Forex Analytics stuff that we have. So so this way you can have some. These are definitely the most comfortable shirts I've ever owned. Dale wears his like 8 times a week.
I have a couple.
Just kidding. It's called swag.
Swag. That's it. Swag. Yeah. Anyway, if there's anything that you'd like to wrap up with, Dale, I want to thank you guys for all being part of this last 2-day event. You guys have all made it a success. Our team, all the listeners, all the viewers, thank you all so much. So Dale, I'm going to pass it over to you. And Steve, thank you so much.
Thank you, Blake.
All right. I have one thing to say. No matter what, all these narratives and everything we've heard the last couple of days, I think Kenny Rogers was a traitor. What do you think, Lydia? You got to know when to hold them, know when to fold them, know when to walk away, know when to run. You never count your pips. When you're sitting at your platform, there'll be time enough for counting when the dealing's done. Don't just count your pips, count your blessings. Thank you, Lydia, Steve, partner.
Thank you, Dale. You were, as always, a wonderful host. So, you know, I'm thankful we were here. Everybody have a wonderful day, and we'll see many of you tomorrow on Face.
Yeah. Okay, everyone. Remember, you know, Money comes and goes. Time is gone forever. Make it count. Find people that resonate with you, as Lydia said, that have your same ethics, your same morals, and invest in yourself. When you sign up for education, you're not paying somebody, you're investing in yourself. And everyone we brought to the table is one of the best in the industry. So thank you very much. You have plenty of choices to make now. Steve, I guess you could end the meeting. Adios, everyone.
Adios. Bye-bye.
Bye.
Bye-bye.